need a lot of size to trade the S&P, probably size that once I would have been comfortable with, but as I get older, I think your risk parameters change, and what you can lose changes. So I think that's a market that you do need a lot of size to trade. So for me, bonds and stocks is where I sit. I keep an eye on everything. I think everything is correlated. Whatever position you're putting on today, you're trading the oil. Let's be honest. If you're buying Euro stocks today, it's only going up if oil rallies. That's how it is at the moment. Things come in fashion and out of fashion, and you've got to be very, very aware and fluid as to what you're looking at. So that's where I sit at the moment, bonds and stocks primarily.
Okay, so Dan, if you could speak to us about the importance of the price ladder for your trading approach, and maybe just take it back a step. What actually is a price ladder, and what type of information or insight does it provide you with?
The price ladders, it's basically your market depth, and it's how I would say 95% of the industry, trades with whatever their market is. And watching your price ladder and watching your price action should and will eventually either give you the confirmation that your ideas are correct, or it will give you the confirmation that you should stand out of the way. So you've got your market in the middle, you've got your prices down the middle of the price ladder. So at the minute, for example, the EURUSD is trading 29.30.31, and if through the middle of that price ladder you'll have prices going 20 ticks higher and 20 ticks lower that maybe you can visually see, and you'll have a depth of market that sits either side of that. So you'll be able to see, if the market's 29 bid at 30, you'll be able to see what orders are sort of running down the ladder to 19, and what orders are running up the ladder to about 40. And it's an amalgamation of orders, and it's constantly changing because obviously there's so many spread algorithms or just natural algorithms that price ladder is always moving, and the bids and offers are always changing. But it's really the significance of what you can see going through at the price that you want to trade. So you will have your predetermined plan. You will, for example, I don't know, if the EURUSD runs down to 80 today, you might be thinking, okay, I want to buy 28.80s. But as it gets there, you'll start monitoring the price action. You'll start monitoring what's happening. Are the sellers more aggressive? Are the sellers in control? Are people pulling their bids off of the ladder because they're too nervous? When it gets to your price, is someone reloading the bid? So, for example, he might start with a 200 lot, and as he gets hit on 50, he might reload it and put another 50 on and another 50. And there's all these techniques, and they take hours to learn. And really and truthfully, before, up until very recently, you could only learn these things actually on a live price ladder. Even the simulators, you can't quite see what's going on as well as you can on a live price environment. So it really is that last piece of the puzzle, that last sort of checklist that tells you whether you want to be interacting. And there's lots of tricks and there's lots of games that people play on the ladder, some of them legal, some of them in a grey area, some of them not legal at all, but they do still get played. And these are all sort of short-term price increments that you can take advantage of. Someone might move the price up by 4 or 5 ticks without it trading, and then pull the bids thereafter. And you can really, as a day trader, you can really take a lot of these smaller price increments out of the market, as opposed to as well as using that price ladder for your your really sort of major confirmation bias as you get near areas that you want to trade. And we focus a lot on that, as a company here, all of our grads that come through, the importance of just watching that price ladder and understanding that price ladder, can be the difference between someone who makes a great living as a trader and someone who doesn't quite make it as a trader. There's obviously lots of other things that go into it. Obviously there will be, but that actually will be one of them. And we focus. There's a lot of attention that we pay to that. And I don't want to head down the route of major sales, but some of the things that we're inventing and creating are primarily based around the price ladder to help people understand what they should and shouldn't be seeing and accelerate the learning, because the learning curve for trading is very, very long and very, very arduous, and lots of people haven't got the finances to actually sort of stay the course and learn how to trade. So we're always looking at ways to kind of accelerate their learning, and sort of help push them on their way to a successful career.
Yeah, I mean, I did notice it was very prominent on your site, the price ladder, that is. So, I mean, that's sort of why I wanted to ask you about it. And just a quick one, just so we're clear, does the price ladder differ from level 2 in any way?
Oh, good question. I mean, I look, I'm so used to price ladders, I'd have to be shown a level 2. As far as I understand, level 2 is your market depth, but I'm not sure how that gets displayed on every other system. Our guys work off of 2 systems. They work off of TT and Neon. So it would really, I guess level 2 is that type of data, but I've got no idea how that would be displayed on various other platforms.
All right, that's cool. I was just trying to avoid any of the listeners getting caught up on terminology differences, but that's cool. So in addition to the price ladder, how does the market profile and footprint influence your trading ideas?
Market profile, it very, very much I think it gives me, a major edge. That people need to understand that no matter what they're looking at, these markets may appear random, but they're not. And I think people really do need to understand that. There will be short-term price movements that, might seem random, but they're not. And what the essence of a market is that it's just trying to find value. That's all it's doing. And the key difference with these markets is the level of uncertainty. So if you think of a short-term interest rate, we pretty much know what value is. We can base that on the fact that something is really unlikely to happen in the next 2 months, and interest rates are such that that is value. And if you think in terms of whenever you go to a shop, we all kind of know what perceived value is. A Mars bar used to be 30 pence, but now perceived value is 70 pence. And all markets are trying to do is find value. That is the basis of a market. And sometimes it will overshoot value to the downside. Sometimes it will overshoot value to the upside. But that is what it's looking to do. It's trying to find balance. And then once it's found balance, it will trade around balance. And then it will either shift or remain the same. That's in essence what a market is attempting to do. So if you think in terms of what a market profile is giving you, and it's telling you where the market perceives value at any given time, where the majority of volume is going through, and that's where the greater portion of people accept that value is. And then it's telling you when it's shifting. And yesterday, for a short time, perceived value in the EURUSD, for example, was 30.08. And we traded there quite nicely. We did a fair chunk of volume. And we didn't really move for about an hour, more than 2 or 3 ticks outside of that. But then there was a shift. And the market moved, and the market started selling off. And then throughout the day, we were assessing where is value, where today does this market perceive value? And at sometimes it was 29.72, at sometimes it was, much lower. At the end of the day, our volume point of control, where the market perceived value to be, is 29.43. And we closed below that, but that is where the market perceived its value to be. And the context of what a profile gives you is where those value areas are, where the volume has been done, and where the market's attempting to seek balance. And if you can kind of get the idea that this is just one big auction, and this is one big auction where it can overshoot and undershoot based on participants' emotions and, fear or comfort, then you can start to understand the way in which the market flows and the way in which the market ebbs and flows. And that's the key to what market profile does. Anything within a candlestick chart or anything within a bar chart, it's giving you the price data, it's telling you the highs and lows and closes, and it's giving you a pattern, but it's not giving you value. It's not telling you where people are accepting a value area to be. And I think that's really, for me, the market profile or volume profiling, it's taking into account, time and volume and price. It's taking in those three things. A candlestick chart, it's not necessarily giving you all of that information. It's giving you the highs and lows, and it's giving you a time bias, but it's not giving you the volume and the value. You could have a bar that is a 50 tick bar, but what does that really mean? A 50 tick bar from high to low to back into the middle. It doesn't give you enough of the story as to that could be done on 2-1 lots.
Okay. Yeah. I think you summed that up really well. That was a really good explanation, Dan. Thank you. Now, I've kind of gone about this back to front. I know you said you sort of come to the market from a top-down approach. I've kind of asked these questions in reverse. But besides the price action and, the things we've talked about with the price ladder, the market profile, etc., you said earlier on that you take into account the big picture. So explain to us or just give us a little insight into what kind of macro events and fundamentals have an impact on how you trade.
Yeah, I think you have to be a rounded trader. You have to know everything that's going on, because if you sit here and, in the times that we're in now, if you sit here and you're unaware that oil's collapsing and that it's come down from wherever we were, $100+ down to $30, and you're still sat here buying equities, then you're a fool. And you have to absolutely know what's going on around you from a macro and a fundamental point of view. And it's so key and it's so important. And some of our, when we do prep our grads, and some of it we televise, some of it we don't, but when we prep our guys, the fundamentals will always override technicals, in my opinion, in the short term, because the market will overshoot and undershoot based on the significance of the event that is happening. And you can't tell me that, in today's day and age, unfortunately, with all of the fear and terrorism that's going on, that you're going to sit here and sell bunds because you've got a 5-minute trend line over another disastrous attack. You'd be an idiot. But above and beyond that, you're knowing what the ECB are doing, what the Fed is doing, what the Bank of England is doing, it's absolutely paramount. The moves do stem from that. At the moment, we are categorically, absolutely across the curve, pricing in negative interest rates. And you have to understand that, because otherwise the Bund looks like the greatest sell in the world. at the moment. You know, you're sat here and you're thinking, oh, it's gone up, it's got this, and this is where I got sucked in yesterday. I actually did go short bunds. I don't ever advocate that. I'm a perma bund bull, but you know, you can't. What we're doing is we're pricing in a very, very fundamental and macro situation where people are now expecting, in light of what Japan did, people are expecting negative interest rates. I mean, I can't quite believe it, but they're pricing in negative interest rates for the UK. It wasn't that long ago that we were talking about rate rises. So you really do have to be a rounded trader, and I hate it when people try and convince other people that there is this one system or there is this one technique that is the holy grail and will make you, you know, a multi-millionaire this time next year. It's just not true. It's just not. That it's a whole multitude of things, from, you know, as you point out, from the macro to the fundamental, all the way down to and every step in between, all the way down to your price ladder confirmation or your footprint confirmation. I mean, that's just the fact. Every trader I know and every successful trader I know is a very, very rounded out person. And some of our ECB discussions border on policy making. You know, sometimes I sit there and I think we're getting so in depth as to what they could and couldn't and should and shouldn't do that, you know, they might as well put us in charge. But you know, that's just what it takes. There's no one single silver bullet. It takes everything, an understanding of everything.
Yeah, brilliant answer. I'm glad I did ask that question.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved, now so has the way traders operate within them. Trade the Pool.
So I'd like to steer this conversation more in the direction of prop trading now. So I'd like to ask you, what are the advantages of trading with a prop firm? And I know it may be a little hard to answer this without some bias, but is there also a downside to prop trading too?
Okay, that's an interesting question. I think for sure prop trading is not for everyone. I think that's a fact. The advantage is, if I were to try and sum it up without being too heavily biasing, as you say, which is quite difficult, bearing in mind that I run a prop firm and we've got you know, sort of training courses. But I mean, look, we can. What we try and do is we try and give people the financial backing that they would not normally have to enter into this career. We try and give people the accelerated learning and point them in the right direction. I know that everything is available on the internet, but to sit with people who have been doing this for, in my case, 20 years, you know, my partner's case, 25 plus years, and some of the traders that we've had here are now sort of 10 plus years. To sit with these guys and to be able to be told what works and what doesn't work and what they should be looking for without getting sold anything or being given, you know, misguided influence, parting with their own money, to no avail. To be given all of this, I think, is an incredible advantage, and that's before you even start on the psychological and the mentoring support that these guys get. So for me, there are all of our highly successful traders that are here. They wouldn't be here without us, but likewise, as a firm, we wouldn't be here without them. So it really is a partnership that we try and develop, and that we try and, bring through. And I think in a retail sector, when you're sat at home, you've only got one pair of eyes on the screen, you're stuck with your thoughts all day that will waver from, this will work or that won't work, or I'm not going to hang on to this trade because I'm scared, or any of these things that you sort of challenge, is a challenge for yourself when you're sat at home. I think you can alleviate some of that pressure when you're in a prop trading environment. Now, the downside is that you're in a group of people that are hitting a higher end of trading. So we're not trading now for $100 a day or £100 a day. We're putting through thousands of round trips, and we're trading for, if not 5 figures, 6 figures. And that's not for everyone, because it takes a certain character, a certain characteristic to be able to take on that type of risk. And there are a lot of people that I'm sure are sat at home, are very good traders, who I do have respect for in terms of their knowledge and what they can impart and how they could maybe mentor, but they're just not cut out to trade in a prop firm, because their risk parameters, their personality just doesn't line up with what it takes to be in this type of firm. So, it's not all about the money. It's about the personality and what you want from life. It's a much deeper question.
So do you think that the risk side of things is something that can't really be taught or developed? It's sort of almost like something intuitive that you kind of have built in. I don't know if that's a good way of explaining it, but I think you know where I'm coming from.
Yeah, I know. Yeah, to a large degree, yes, I think it is built in, and I think you can't necessarily teach someone how to take on risk, or how to be comfortable with risk. I mean, the irony is we do have a couple of traders that are probably the most risk-adverse traders I know, and they will only ever be looking for 1 or 2 ticks maximum within the market over quiet periods of time, because they don't have the personality trait that makes them want to take on risk. They have a much different way of going about trading. So it's interesting. It's these guys have managed to find a way of trading without taking on any risk, but I think they're few and far between. I think they're pretty special traders. I think the biggest overriding problem most people have is being able to put on a trade and then deal with it going offside or coming back at you, or sitting in a trade and being patient enough and taking on that risk. I would say is most people's overriding issue. It's a difficult one. I mean, I've got to be honest. If I had the magic answer as to what created a successful trader, I'd have replicated it, and I'd probably be in charge of a firm bigger than Goldman Sachs. But it's really hard to pin what specific characteristic makes a good trader. And don't get me wrong, we have tried. We've looked into it, be it psychometric testing, be it personality profiling. There is no constant, and that's quite hard. It makes it hard when you're taking someone on to know quite whether they're going to make it as a trader.
Okay, so let's talk a little bit about the learning process that new traders go through when joining the firm, and how does the whole financial backing work? Like, how is it structured, and what's the process that traders go through to get funding?
Yeah, well, initially, there's kind of two ways in, I guess, to our firm. We have a certain amount of sponsored places that we will allot per intake. So at the moment, we're currently running about 4 intakes a year, and we look to, people apply. We obviously go through their CVs and we bring them in and do a couple of tests. But the reality is when it comes to the interview, it comes down to trying to get a read of the person and a read of the guy, and it's quite hard because obviously an interview is such a false environment of how a person really behaves. And on top of that, they're behaving without ever having really interacted in the markets these way, in a proper sort of environment way. And it will certainly teach them things about themselves that they didn't necessarily know before. So we offer these sponsored places on each course. The remainder of the places go to people who are willing to sort of self-sponsor themselves, so i.e. pay the fee and come in and train under the same sort of banner as our sponsored guys. And the way we structure it is the first 4 weeks, we really have sort of tailored the first 4 weeks to a lot of classroom theory, and it's a necessary evil, I'm afraid. There's not really anything you can do about it. I think it's probably their least enjoyable time and the trainer's least enjoyable time, because it's a lot of theory, but you have to go through it. It's like I was saying before, whereas I didn't know what impact non-farm payrolls or a rate rise had on the markets, and that was accepted back then, it's kind of not accepted now. So we have to train our guys, we have to teach them, we have to make them understand, and then we start giving them the techniques that we start to use, and we give them what we perceive to be the sort of charting armory that they need over that period of time as well. So that's the first 4 weeks. Now the second 4 weeks really is where we start to drill into the price ladder, and what we've invented and what we have is, it's actually probably the thing I'm most proud of at the moment that this company has done. But we have these what are basically price ladder drills, and instead of them just being a normal simulator, we've been recording data for many years and bringing it onto a platform where actually for the first time that I'm aware of globally, people can interact with. So it's not a simulator, it's not a live market, it's like a replay data of, say, the past 6 or 7 ECB meetings, but traders can actually get involved. Instead of just watching the data and instead of just watching what may happen in the market, we've given it the ability that traders can interact with that, and they can actually trade it, and they can have a P&L off it. And I mean, to me, this is the key part of the course. This is the gold dust, because up until this price ladder product that we've got, the only way you can get involved in an ECB meeting is to trade it once every 6 weeks now, and trade it either on a sim or live. And if I'd have been able to go back in my time and had a learning curve where actually I could trade 10 ECB meetings over the course of 4 weeks, or I can practice 10 ECB meetings or 10 non-farm payrolls or whatever the figure is, and practice that over the course of 4 weeks, that would just, would have sent my trading on an absolute stratospheric arc. I mean, it really is just something that those middle 4 weeks, and the price ladder drills are just so key. And to be able to go over and do these things, and it's not just the ECB, it's non-farm payrolls, it's Bank of England, it's whatever rate announcement there may be, and it's also techniques that we've identified. So there's certain bits that specifically tell you how to trade if there's a flipper in the market, or a layerer in the market, or all of these other things that we know shouldn't maybe happen but do happen. We've got the ability for people to actually interact with these things and actually trade these things. And that for me, as I've said, accelerating people's learning is really what we're all about and what we're really attempting to do. And the back 4 weeks is where we start putting them on simulators and actually start monitoring them at their desk and monitoring their progress and monitoring how they actually trade in a simulated but live data environment. And it's then that we start making decisions about whether we can put people live or whether we're willing to back people. We've had a couple of people who have actually sponsored themselves to come on the course, but have then gone on to want backing, which we have done. So it's not as if they pay for a course and then we just sort of send them back out into the wide world to fend for themselves. We've got 3 or 4 people off our last course, one in the States, that we were so impressed with how he was getting to grips with trading that we've actually backed him to trade from the States remotely. And that takes a hell of a lot of trust, because you're relying on someone to actually behave themselves and adhere to stops and risk management from where really the only control you've got over it is your first port of call is Skype. The second port of call is if they're not responding, you're blocking accounts. Can't go over and talk to them. So, that's really in a nutshell how everything works. We look to back people, we put them on a contract that gives them our backing, and it gives them our finances and our time. So instead of only being able to start trading a pound a pip or a one lot, we put people into the market trading bigger than one lot so that they can actually make a living. And obviously in return, there's a percentage that would come back across to us that scales up the more money that they make.
Very cool. So after that 12-week program, the initial kind of learning process that they go through, how long do you anticipate before newer traders to the firm actually reach a level of some consistency?
Well, consistency on the sim is very different to consistency live. I think everyone, I know that a couple of the Twitter guys like to call them demo ballers, which is quite an apt name for them. It's one thing taking a fake position and being able to run it offside and then see it back to a scratch and then see it offside and then take it to a profit. And I think gaining consistency on the sim is pretty straightforward. Unfortunately, it's the only benchmark we have. If there were another way to go about it, I would, love to know, and I would drop the sim. But, the majority of people around weeks 20 through to 24, so that's that 5 to 6 month barometer, should be looking to have achieved some form of consistency on the sim. If they haven't, then we need to really start questioning their techniques or their suitability to actually the career. And then that's when we'd look to put them live. And of course, that's when probably the biggest issue that any trader will ever have starts coming into play, and that's their psychology. And that's really where, unfortunately, we do try and help. We do, I'm not a psychologist, but I have got 20 years of experience attempting to help, people through it. We do employ someone who comes in and tries to talk to them, but, it's really where our control starts to get incredibly limited, and our ability to influence these guys starts to get less and less, and it starts to become about them and about their psychology and their hunger and their desire and everything else that comes into a trader's mindset.
Sure. So just generally speaking, what's the average kind of success rate of the traders that you fund? Because, everyone's heard the statistic that 90 to 95% of traders, retail traders, fail, they blow up, they, go out of business. I presume it's more weighted in your favor as a funded trader with a prop firm.
Yeah, it is, and I think that's one of the key advantages. I'm not going to say, it would disrespect the whole interview and make me look like a mug if I said that 100% of the guys that come to us go on to be successful traders. It's just not true. I think the statistics are slightly better and in our favour. I've never worked them out to put a number on it, but the reality is you're still not even looking at 50-50. I couldn't say that half of the guys that come to us end up making money, because it's just not true. What I can say is the ones that do make it make a significant amount of money. They're not just making the equivalent of a 50 or 60,000 pound a year career. They're making 6 figures a year and on their way to making 7 figures a year. That's really where the key differential is, that the guys that actually are successful and the money that they make is vastly in excess of what I would imagine the retail sector is doing. But yeah, I'm not going to sit here and say that we knock it out the park with everyone. The one thing that I would say is that most of the people that do leave us will acknowledge that they've had the best chance that they're ever going to have at being a trader within our firm, and probably 95% of them actually leave and go on to take a more stable and a more career-based job that they're probably suited to. 5% I know will go and attempt to trade somewhere else, but within 3 or 4 months I end up seeing a reference because it hasn't worked out at the other firm that they've gone to. So the reality is they go to another firm thinking there might be a holy grail there, but they find out that they're still the same person, they're still the same trader, and the markets are still the same markets. So that's really all I can say from a prop perspective is I think the people that don't make it have had the best chance that they have had to make it and just realise that trading's not for them and move on. I think our stats are better than 90%, and that those that do make money and are successful make substantial amounts of money and go on to achieve great success, not just, I hate the word mediocrity, but, a lesser degree of success. I think that's probably the fairest and most honest way of answering that.
Yeah, no, I appreciate the honesty, Dan. That was a really good answer. So let's just do one last question to take us out. And this is maybe just some, I guess you could call it parting advice for traders listening. So if someone is feeling completely lost and frustrated as a trader, they're perhaps not sure where to turn, what advice would you give to them?
Step away for a little bit, get some clarity. You need to, if you're really at a point where you're that low, you're not going to make money. You're not going to turn it round by sitting in front of your screen. I honestly think you need to get away. You need to take a mental rain check. Probably need to do something completely unrelated to the markets in any way, shape or form, and not push for an answer. I think the answer will come to you. I think man's thinking, although it's its greatest asset, can also be its greatest enemy, because we can all constantly overthink things that are very, very simple and straightforward. So get away, get some clarity, understand what it is you want to achieve, and if you do want to, come back to trading, then I honestly do believe you should seek professional, trusted advice. There's no holy grail. There's no single answer. It's a myriad of approaches from, as we've discussed, from the macro fundamental all the way down. And I do believe that having a support network is incredibly key. Whether that support network can be, your family to discuss things with, or other people in the industry whom you trust, or a firm. There are those options to sort of seek that advice and help you achieve your dreams. So if you are sort of stuck in the mud and you really, really are suffering, I think, pride comes before a fall. So, reach out to someone and get some help.
Brilliant answer, Dan. I really like that. Well said. So, do you want to share with listeners, just before we go here, where they can go to find out more about you and how they can connect with you?
Yeah, it's pretty straightforward. If people want to get in touch, they can visit either of our websites. There's a lot of information on futexlive.com. You don't need to part with any money. You can get yourself a 7-day trial and you can have a look through there. All of the guys that either stream on the live terminal are trusted, profitable traders, and they share their advice and they share what they're looking at in the market. You'll find me on there 2 or 3 times a week giving my take on the market. And for anyone who does know me or does follow me, my take on the market is not 100% accurate, but it's certainly closer than a lot of other people out there. So have a look around futexlive.com, see if it's for you, see if you like what's there. There's absolutely no commitment required, and then you can get in touch via there, or have a look around futex.co.uk. That's more of our sort of trade facilitation website, so you can get the gist of what we do there. And of course via Twitter. The prop industry is pretty rife on Twitter, and it's very, very quick and easy to find out who is legit and who knows what they're talking about, and who is not quite as legit and doesn't know what they're talking about. So any tag, you can just look up Futex Live, and my personal tag is at DMG_Futex Live. But any of the traders that are set up on there are professional proprietary traders. They're also profitable traders, and people that we kind of link with on there might be in the retail sector or abroad, but there's certainly a wealth of information that other people have got as well. So have a look around. I'm not here to give a hard sell. I'm not a salesman. That's not my thing at all. But I do enjoy helping people achieve their dreams, or at least making them realise that their dreams aren't quite what they think they are.
Very good. Okay, Dan. And guys listening, I'll be sure to include all those links at chatwithtraders.com/59 in case you want to find everything all in one place. Now, Dan, I hope you have a great trading session ahead. I know it's early morning for you. Thank you very much for your time and sharing your insight. Let's stay in touch.
Yeah, pleasure. Happy to do it again whenever you're ready.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations, this is the next level.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
What's happening, team? Thanks for being here. You're currently listening to episode 60, and my guest is the most photographed man on Wall Street, Peter Tuchman. Peter is a broker on the floor of the New York Stock Exchange, and he's worked there for the past 30 years. So as you could imagine, he's seen massive shifts in the landscape of trading, especially on the floor, and has been in the thick of it for many significant market events. During our interview, Peter shares some of his most memorable moments, reflecting on the crash of '87 and right through to what it was like to be there trading the Alibaba IPO. He also explains the role of a broker on the floor of the stock exchange today, and almost like a lesson in history, how this has changed over time. And of course, much, much more. Now, I had a lot of fun doing this interview. Peter has an undeniable passion and excitement for markets, which you'll pick up on straight away, I'm sure. So I hope you enjoy this interview. Couple things I'll mention quickly. This interview was recorded on the 11th of February, 2016. Now, I say that just because Peter references some recent market events during the interview, and the sound quality from Peter's side suddenly improves after about 10 minutes. So please don't panic if it sounds a little rough to begin with. All right, guys, let's get into it. This is the Chat with Traders podcast, and here is my guest from New York City, Peter Tuchman. Peter, it's such an honor to be speaking with you. How's it going, buddy?
All right, my friend. Peter Tuchman here. Good to hear you, Aaron.
Likewise. So tell us, good day in the markets today. What was it like?
You know what? I would have to say that today goes into the top 10 crazier days that I've experienced. We're seeing, look, since January 1st, we're seeing days of volatility that are powerful. We are seeing a trend that looks a bit like a broken market. We're seeing a lot of information that's coming into the market that is people are reacting to in a big way. We're starting to see some fearful trading, some fearful selling. The oil trade has really impacted the market in a big way. The Fed, yesterday we had these rumors, and in fact it was brought out by by Congress and Miss Yellen's chat, that she is requesting the banks to address a possible negative interest rate and a stress test with that, which is sort of it's a confusing idea in my mind. I don't understand what negative interest rates mean. I don't think the public does. I don't think Janet Yellen does. And then you've got the problem with the banks in Europe, which is a huge, huge problem. And so these are the most sort of overpowering situations that are really hitting the market over the last week or so. We've seen a sell-off. Are we in correction mode? Yes, it seems that way. Is this liquidation of some funds? Perhaps. Are the people who are in the energy trade getting eviscerated? For sure. Is oil broken down below every possible level we've seen in decades? Absolutely. Is the fear of failure in European banks a huge looming problem? It's been clear in the last week or so that that's kind of a new entity in this big mishmash of madness that's going on. So, and then we've got this whole Fed thing that, their decision to raise rates, which I think was a mistake. They waited way too long to do it. Is now they've said that it's going to be data driven, meaning that are we going to raise them again in March? Well, only if the economy is showing some lift. And a market that's down thousands of points since January 1st is showing towards, if we're going after data driven, then we may not be able to raise those rates, and then perhaps we may even lower the rates. So today we had a huge global sell-off last night due to these fear of default and a bunch of these they're called, I call them Cocoa Puffs. These European bond deals that they're using to try and raise money to support them. People are afraid they're just going to be blank paper by the time they come to fruition. And so we had a huge global sell-off overnight. We came in this morning down 300. Market proceeded to sell off even further. Oil broke 27. And then, it looked like we were going to maybe get some capitulation and a complete real puke, as it were. And then suddenly OPEC came out at 2:45 with a statement saying that they were going to consider restricting dumping oil on the market and production of oil. And the market rallied 280 points in about 4 minutes. And, it's from a day trader's point of view, people who are sitting on the short side going, okay, oh my God, what are we going to do? We should probably close at the lows here at 245. Suddenly you have a market that rallies almost 300 points on a blip of significant news nonetheless, but still just a blip of news in the big picture. And then, so people who were caught short got demolished. I don't think there was anybody who was planning on this news coming out. So if you hopped on board the long train at 245, maybe you made some money. But then it rolled back over once people started digesting and assimilating that news, saying, you know what? Well, oil needs to rally $50 before it's going to have a positive effect on this market. We are so deep down the rabbit hole that, a little blip, as big as OPEC is and as powerful as they are, a little blip in the production and restriction of distribution is not going to turn this broken market around. So the market proceeded to sell once off again, and we closed down about 270 points. So I got whipsawed a number of times. As I've been, my description on a daily basis is like a seagull being thrown around by a hurricane lately. Just when you get a sort of a handle on what you think is going to happen in the day, it does one of these 2 o'clock rallies, which, whether they're bear market rallies, whether they're dead cat bounces, whether they're, hitting a technical level, whether it's some guy, sitting in his pajamas who's got deep pockets, hitting buttons, buying spiders and buying futures. And, so all that being said, Aaron, it was a crazy, wild ride today,
Yeah, I mean, it sure sounds like it. So I think it's safe to say there's plenty action ahead. But Peter, let's take this back to the mid-'80s. So we're going to step back in time. I want to hear about how you originally found your way onto the New York Stock Exchange. So tell us, how did you get your start?
Well, I grew up in New York City. My parents are actually Eastern European. They are Holocaust survivors. They came to New York in 1950. So I grew up here on the Upper West Side of New York, went to high school, went to college, got a degree in agriculture. That was my dream, actually. And halfway through, I realized I was not going to be a farmer, and I decided to study international business. I graduated college, went and got an MBA in business, and started trading commodities in the early 80s. I opened up a record store in downtown in Greenwich Village in 1980, and then sort of my world sort of came crashing down a little bit. Commodity, I lost all the money I'd made in the market, and my life was I didn't have direction, and I ended up moving to West Africa for a couple of years, where I started learning. I worked for a Norwegian oil company, and studying computers, and ran the finances for the dictator of this West African nation called the People's Republic of Benin. And that sort of came to an abrupt halt in 1984, and I was sent back to the U.S., and I got a summer job as a teletypist on the floor of the New York Stock Exchange for Cowen and Company, My father was a doctor, and he had a patient who was a head partner at Cowan and Company. So May 26, 1985, I came down there, and it was basically open outcry, a lot of paper, a lot of screaming and yelling. And I had the thing about the floor of the stock exchange is there's really no training for any of the jobs down there. Basically, it's been a business of Irish, Jewish, Italian families. The grandfather started there. Then your father worked there, your uncle worked there. You got a summer job. You ran around as a squad. You started at the bottom, like a caste system in a way, and you worked your way up. It's not a job that's for the faint of heart. It's not a job that you can study for. It's basically a job that if you have certain characteristics, which are good people skills, good story skills, quick with money, good with people, and you thrive on stress, then it's basically the environment for you. So while I started as a teletypist for the summer of 1985, just typing in trades, you would basically have brokers who would go out and execute stock. The paper would come into the booth. You bought 100 shares of XYZ from broker, Bear Stearns broker number 985, and you were Cowan, and you sold them 100 shares, piece of paper, everything written up, and I would input this into a computer. It was sent up to the Cowan office, and it was the bottom rung of the job. But the atmosphere on the floor, I worked right under the podium in the main room of the New York Stock Exchange. I worked in a booth that was surrounded by Dean Witter, Cowan and Company, Morgan Stanley, and Ivan Boesky's company, who we can discuss at a later time. He was one of the largest corporate raiders back in the 80s. He was indicted for insider trading way on early. All that being said, it was an environment that I loved and I thrived on. And come September of 85, after my summer job was done, I love the environment. I love the people. I love the action. I'm a loud, boisterous, obnoxious guy with big personality and big energy. And so I knew that this was my job. It was my calling. And I knew I could never work anywhere else. And so I requested to get a regular job with Cowan and Company, and they liked me and they saw my potential, and they gave me a job as an option phone clerk in the same booth on the floor of the stock exchange. And option phone clerks at the time. So basically you have booths on the floor of the exchange that are connected to trading desks in New York, and then maybe in turn connected to trading desks all over the world. Basically, you've got an institutional trading desk, which is portfolio managers trading big institutional money, and private investing money. You've got a retail desk, which are the smaller investors. And then you have an option desk, which is where the option guys are trading, whether it's customer money, whether it's hedging the positions of the company and whatnot. And then you have phone lines going down to the floor where orders are entered, whether they're institutional big orders, retail small orders, and then what's called option layoff business. So the option desk is trading options, and to hedge themselves, they would enter small retail equity orders, buy 500 shares of Philip Morris, sell 500 shares of Disney, buy 200 of this, cancel 300, leave 100. And it was sort of a very aggressive, crazy environment. And I ran about 100 phones at the time. And I just thrived off it. I loved it. And it was really a wonderful place for me. And it was really the beginning of my path to being my path to stardom, as it were, my path to being a broker, because from an option clerk, you go to be a retail clerk, and then a retail clerk, you become an institutional clerk. An institutional clerk, you become a broker. Now, in the 80s, that path from teletypist to broker, which is, being on the floor of the stock exchange, one's goal is to be a trader, to be a broker, was often a very long road. It was possibly anywhere from 10 to 12 year path from the bottom of the rung to the top. And there is no fast track to it. You've got to do every job on the way there, right? You got to clean the toilet bowls. You got to chop the onions. You got to be the sous chef, and you got to be the head chef. So normally that path is a very long, arduous task. And it may take anywhere from 10 to 12 years back in the day for most people. It didn't matter really who your father was or your grandfather was, whether he owned the firm, ran the firm, or was a partner. You still had to pay your dues. And paying your dues meant really learning the business in and out. So I happened to be in the right place at the right time. I started as a teletypist in 85, and by late October 1988, after the crash, I got a seat on the stock exchange. Probably one of the fastest progressions they had ever seen down there. Possibly not necessarily a function of how wonderful and great I am. I'll be the first one to tell you that. But surely being in the right place at the right time. One guy left, one guy got fired, one guy became a broker, one guy moved on to another company. And I was good at what I did. People liked me. I played the game. And I went on to become a broker. So starting in 1989, I got a seat on the stock exchange, which was the right to trade. It was a huge honor. My parents came. We went up to the stock exchange luncheon club, to a big boardroom where everyone from, FDR, Franklin Roosevelt to, Alexander Hamilton signed the book to become a member of the stock exchange. So it was sort of like Santa Claus's big book. We went up there. It was a very, very formal proceeding. My parents came. There were photographs taken. They opened up this big leather-bound book that literally the first page of the book was a signing by Alexander Hamilton, one of the founding fathers of the United States from 1786. He was one of the first guys to sign that book. And then I signed the book, Peter Tuchman. So I was given a seat on the stock exchange, and I went on to become a broker. And I've been a broker ever since. I just celebrated 30 years on the floor of the stock exchange. I've been a broker for 27 years.
Well, congratulations, Peter, and thank you very much for sharing that story. That was really cool to hear. So, like you mentioned, you are a broker still to this day, of course. Could you paint the picture of what is your role as a broker on the floor these days? Because, guys listening to this podcast are probably very familiar with online brokers, but perhaps not so much with the role and importance of brokers actually on the floor of the exchange. So could you paint that picture for us a little bit and shed some insight into your role as a broker on the floor?
Absolutely. I will give you a little back history on it, because since the early 90s, I've had to reinvent myself a number of times. The role of a broker has changed many times. Okay, when I started, we had open outcry, which meant that you would walk into a crowd, there was screaming and yelling. Everything was done on paper. You executed stock. You traded with another broker face to face. You stood in a crowd. It may take you an hour to execute a trade. It may take you days to execute a trade, but you stood there and it was an auction market, right? Like you may know a farmer's market, it was an auction market. I came into a stock. There were two sellers. There were two buyers. There was a market maker. We discussed it. We came up with a price. We negotiated with my customer. Calls were happening back and forth. And we ended up, our goal was to consummate a trade. The trade was put on the tape. It was 1,000 shares. It was 10,000 shares. It was 1,000,000 shares. There were block trades. It was a different experience. And in the late 90s, the whole open outcry system started slowing down because they started coming up with computer trade. They came up with handheld computers on the floor. I would say probably mid-2000s. So I started out as a retail and institutional broker for Cowen and Company. I went on to a company called Lee Securities. So I was basically executing institutional business, right? Buy 1,000,000 shares, work it, limit orders, market orders, put together a couple of prints, That was how we traded. Then I left Cowen and Company in mid to late 90s. I went to a convertible arbitrage firm, which was a real specific art on the floor of the stock exchange. So convertible arbitrage are people who you're buying, preferred stocks and common stock. Preferred stocks have high yield, high dividend, and people who are in convertible arbitrage do what's called setting up positions, where they will go long the preferred stock and they will short the common stock at the same time and create a long net long position in a convertible arbitrage. in a convertible preferred stock. And this was an art that I worked on for a long time. It was a lot of crossing of stocks. It was a lot of mathematics involved in that, because you were trading millions and millions of shares, sometimes only for pennies, or sometimes for nickels, sometimes for dimes. But it was a fascinating part of the business, which I was happy to learn. And that sort of convertible arbitrage doesn't really, it happens now through computers upstairs, but it was a big part of my life on the floor of the stock exchange for a while. Then I went on to do more institutional business. Well, I'm called a $2 broker. So a $2 broker is, so you have firms like JP Morgan, Morgan Stanley, Goldman Sachs, who are called house. Those are the houses. Those are the big brokerage houses. And they have their employees who are their brokers. And then there's what's called overflow business, when their brokers are unable to do all the business. There are people since the beginning of time who were called $2 brokers who did commission business. They sort of roamed around the floor because of their specialty in a certain stock or a relationship with a certain market maker. They were given overflow business by firms, and they were paid a commission. Back in the day, they were paid $2 for every 100 shares they executed. Hence the name $2 broker. Well, at the time, in the 80s, there were about, in the early 1900s, 1,654 seats were created on the floor of the New York Stock Exchange, seat being the right to trade. They had value anywhere from $30,000 to $8 million over time. The value of a seat on the stock exchange was a function of how much money people were making, how busy the market was, and how the economy was doing. Okay? The market in seats, so you had to buy a seat or lease a seat in order to have the right to trade stock. Pre-1929 crash, seats were trading at $30,000. They went up to $180,000 before the crash because the market was really roaring. During the crash of 1929, the value of a seat went down to $15,000. And then from 1929 until 1990, I think, when the company went public, they went from $15,000 to $8 million for the right to trade stock on the floor of the stock exchange. So I've never been a house broker. I've always been at what's called a $2 broker. So I've always basically been trading for other people's accounts. I do not trade for my own account. That's actually illegal on the floor of the stock exchange. I'm not allowed to be involved in stocks that I'm trading for customers for 30 days. So in fact, as odd as it may be to you and to your audience, I, Peter Tuchman, have never owned a share of stock in my life. But anyway, that, for me, I learned from the great Gordon Gekko line from the movie Wall Street, never get emotional about money. If I'm trading my customers' money, I need to be solely focused on doing the best thing for them, and I cannot be worried about what my account is doing or what's going on with my portfolio. So therefore, I don't have a portfolio. All that being said, when computers came into the market, not necessarily high-frequency trading, but I'm talking computers came down to the floor of the stock exchange. And open outcry was not the way that we traded anymore. As your audience may know from the movie Wall Street, where you see people screaming and yelling, ripping paper and whatnot like that, sort of a trading places Wall Street type scenario. They brought handheld computers into the stock exchange, which meant that orders were not being generated by phone calls, but they were being generated by computers, by IMs or whatnot. They were entered upstairs on a desk. They were sent down to what's called a BBS system on the floor, and then they were sent into a handheld computer. And that I would then send the order electronically to the book, to the market maker, and then my order was engaged electronically with the contra side of the trade. So if I'm a buyer with a limit and I have 1,000 shares of Disney to buy, and my customer's instructions are a $125 top, then I get an order on my handheld. I send it out to the book being the market maker being the man who gets all the buy side and sell side interest from throughout the world, and he's the point of execution. So if I have a limit order, I send out an order to buy 1,000 shares at 125. It's then put out into the world, and if someone wants to sell 1,000 at 125, we are electronically connected. All that to say basically that my job as a broker trading institutional money in an open outcry situation was forced to change to an electronic marketplace. That changed my relationship to my customers, a different relationship to the market makers, and basically a different relationship to my job, because I'm somebody who thrives on the screaming and yelling. What made me a great broker was that I could read the sellers in the crowd. I could read the other people. I had relationships with them. And if I came in there to buy 1 million shares and I kept my cards to my chest, and I had an ability to, I sort of mastered the art of I became a pretty good trader because of my ability to read people, because of my relationships with customers and with people in the industry. So I was able to open people up, and we were able, our goal, your goal out there is to get your best price for your customer, but also to get stock on the tape, right? That benefits everyone. And so, in mid-2000s, when we started going electronic, things changed. My customer base, a lot of customers didn't really need to have, well, let me say this. The customers were forced by their trading desks to use the electronic system and not engage humans like myself, brokers, as much. It was cheaper. The market was trading at a much quicker pace, and basically people just wanted executions. Back in the old days, the average trade that went on the tape was about 10,000 shares. Now the average trade is 100 shares. Things are traded 100 shares at a time. So you needed a human interaction to put together buyers and sellers and put on these nice blocks of trade. So as time has gone by and we've become a lot more electronic, my job as a broker has changed a lot. The relationship of the trading desks to the floor of the stock exchange has traded a lot. The mergers that were necessary by brokerage firms, market making firms, due to the fact that it used to take one broker to trade 10 stocks, and now you've got one machine trading 1,000 stocks, made it that they didn't need 1,654 brokers anymore. They didn't need 500 market makers, and they didn't need 100 brokerage firms and 30 market making firms. They were forced to merge due to efficiency of cost, which for me has been a big disappointment because I'm not a tech guy. I still don't own a computer. I don't particularly like computers, and I don't like electronic trading. I like the personal touch. I like the human factor. So that being said, a lot of people have left the exchange, have gone on to other jobs. Those who have survived have basically had to reinvent themselves. Those who have survived have held on to relationships that they've had over time and have sort of cashed in on whatever thing made them a special broker. All that being said, what I've had to do over the last, so I would say, let's say in 2006, things were already very electronic. I will talk about the crash of 7 and 8 in a minute, but the long-winded version of your question to me about what's my job as a broker, and I think it's important that I gave you all this back history, is that right now I still have a job on the stock exchange. I'm still quite successful, and I still have a big presence on the floor because I have created a new business model that is a viable force that cannot be done electronically. It needs a human involvement. And that's basically reading the opening of the market, IPO markets, secondary markets, and the closing of the market. As you know, you're a trader, and I'm sure your audience knows that we open the U.S. markets relative to the futures are trading around the clock. A lot of stocks are trading around the clock. The New York Stock Exchange is not the only place to trade. So markets are being made around the clock 24/7. The futures, the spiders, all the ETFs and whatnot are trading actively when we are asleep. So, but the New York Stock Exchange, the floor of the New York Stock Exchange, which while we only probably maintain about 25% of the world volume now still opens at 9:30. It opens relative to supply and demand in the market. It opens as a reaction to what happened overnight, and it opens at a price determined by supply and demand. So what I've been for, and then the market also closes in the same fashion. Okay? When I come in the morning at 8:30, the futures are doing what they're doing, the exchange rates are doing what they're doing, the ETFs are doing what they're doing, and the geopolitical stuff is obviously running rampant all over the world. But, however, at 8:30 in the morning, my handheld computer on the floor of the New York Stock Exchange gets a feed of what there is to buy and sell in the market that will be executed at 9:30 on the floor of the New York Stock Exchange. Not what's trading in a way, not what's doing anything else. This is flow coming into New York, okay? Now, that flow will sometimes be, let's give today as an example. There was a global sell-off at 4 a.m. last night. The futures were trading down 300 points when I got to work this morning. The implied opening in the New York market was down about 280 on the Dow. Well, for the Dow to open down 280, you need all those Dow stocks and all those stocks in the S&P to open down to a level where the futures will coincide with where the stock itself is trading. Okay? So I've developed a business model, which I will share with you to as much as I can without divulging my secrets, where I'm able to develop an edge and trade the opening of the market. I trade IPOs. There's nothing like, the very few people in the world are able to get stock on the inside of deals. So, because the good deals are oversubscribed and the bad deals are undersubscribed, and the bad deals you don't want to be involved in. So we've got the third tertiary market, which is our market. When stocks go public on the floor of the New York Stock Exchange, there is a wonderful trade to be had by trading it in the aftermarket, which is our market, okay? The stock is priced the night before. They've done their roadshow. They come to New York. And I will go on in the conversation and explain to you some of the most wonderful IPOs, which I've been happy to be part of. But there is a market to trade. See, I need to find an edge right now, okay? Because the markets are pushing towards going all electronic. And I, as a human, as somebody who wants to maintain a presence on the floor of the stock exchange and give added value to my customers, have to find an edge in this crazy electronic world. So I scrape and I burn on a daily basis to find an edge. That edge comes in my opening market trades, my closing market trades, my IPO trades, my secondaries trades, and some intraday trading. So I've been able to hook up with a hedge fund who likes my business model that I've built, which is trading these trades I've described to you to a certain extent, and it works in with one of their strategies, and we're able to trade together. I'm on an open line with my customers all morning and all afternoon, and we build positions, and we are day traders. The strategy I trade is a strict day trading strategy. The longest I hold a position is probably 2.5 to 3 hours. So I've reinvented myself. That's my job. I walk in to the market at 9 o'clock in the morning. I get a quick run on what the markets, what the buy and sell imbalances are on the floor of the New York Stock Exchange. I see where the futures are trading away. I make a trade. I don't trade pre-market at all. I let New York open and I make a trade. I get involved in IPOs, falling into certain guidelines that I've built that work through historical data. I buy secondaries that were issued the night before, also by historic data. At 2 o'clock, I'm being given information about projected market imbalances for the closing bell, which is information that brokers are privy to. And I've built a business model to trade that information. So whether I go long some stocks, short some stocks, trade some spiders, I start getting involved in the market around 2 o'clock for my afternoon trade. And then these are all things that are done through the New York Stock Exchange, through my handheld computer, and through relationships I have with traders upstairs and hedge funds. And then at the end of the day, I close out my positions, at 4 o'clock with closing trades. Everything I'm long, I get out of. Everything I'm short, I cover. If there's a huge spike or sell-off near the close, I may put on what's called a reversal trade, meaning if the market closes up 500, I may get out of my longs and go a little short overnight. And same way, if the market sells off, I may go buy a little stock for a flip trade for the morning. But that's Peter Tuchman as a trader right now.
No, that's really good, Peter, and thanks again so much for giving a lot of detail with that answer. And props to you for being able to, having to reinvent and evolve with markets over time. I have no doubt that was quite a challenge. Just something I want to ask you, leading on from that, is just so that we're clear. To what extent do you have the decision to buy and sell for your clients? Do you have full decision on that, or are you somewhat following their orders to some extent?
Okay, so I've described to you a number of different kinds of order flow. So okay, it's sort of complicated. I have some discretion, absolutely. Each order flow has different restrictions to it. Our IPO trades have a business model built around them, which are restrictions relative to historic data, which I follow to a T, and they work a proportionally good percent of the time. Secondaries also. I am not a predictor of the market. I am not an economist. I'm a day trader. And I'm also somebody who cannot tell a customer what to do. But what I can do is convey information and feeling about what I'm seeing in the marketplace. Being on the floor of the stock exchange, which is something, I'm one of the big touters of the human factor in trading. I am one of those people that is fearful of what I call gorillas in pajamas hitting buttons, which are people who, without an edge, depending on how big their pockets are, who are sitting at home around the world, hitting buttons, trying to find volatility, trying to hit technical levels, and trying to manipulate a market, okay? I'm somebody who's trying to level the playing field, but offer the human factor into my trading. So therefore, me and my customers, and I only have a couple, because it's basically a around-the-clock, on open line relationship to my customers, because as you know, this market can trade on a dime. As I described today's market, we were selling off. It looked like the end of the world, down 400. And then we're part of this wild, crazy information highway, right? There are millions of more people trading the market than before. There's a lot more information that we're being barraged with on a moment-by-moment basis. There are people who are tracking Twitter with keywords about takeovers and rumors and oil production and this, not. And they are built into robots that are reacting to the market. So for me as a human being, it's like, I'm fishing for crocodiles here. I need to be able to use my ability as a human who's got a good sense of the market and who can feel the energy, okay? It's an amazing thing to be in a room with hundreds of brokers without the screaming and yelling and still be able to sense when something is happening, right? In the old days, there's that, I don't know if you know the movie Trading Places, I'm sure you've seen it, but when in the old days when this was all about humans and order flowing and screaming and yelling and clerks and phones clicking and phones ringing, when things got busy and news was coming out and people were starting to corner the market in the orange juice futures, as it were, everyone would run to that stock and you could feel it was palpable, the energy in a room. Well, what's changed is that I've got a bunch of, there's a couple hundred people less, and they've got these computers that don't make much noise, maybe a little beep beep here and there, but you're not able to feel that energy that we used to feel. So I've had to, once again, reinvent to figure out a way, well, what is my edge here? What can I do to make that difference? So each order type that I get has different discretion on it. There are certain ones where net at the end of the day, okay, let me go back. Certain order flows, certain order types have different restrictions. Some, my customer and I have agreed just to follow the instructions. Their instructions to me come from historic data. Okay? It's a hedge fund that works off probability, and all my thinking and wishing that a stock is going to go up or down is not as powerful as probability of what's going to happen historically. Historical data, as your traders may know, is powerful in this marketplace. It's because there's so many people in the market who trade off that information. It's like technical levels. Where's the support? Where's the ceiling? And how many people are going to trade off that thing? If 182 in the futures is a known support level, and there are thousands of people waiting for it to hit to that point before they buy, well, when it hits 182, it's going to rally. It's just because it's probability. So I have order types where I have more input and some I have less. Okay? I am not there to make up information. I'm there to be the conduit for information flow and market flow of order flow that I'm privy to as a trader on the floor. And I try to impart that. Okay? This market is way more powerful than what Peter Tuchman thinks is going to happen. I'm there to convey information that I see and not there to make predictions. That's really important. So the amount of input I have, if I say to my guy, I really don't think we should do that, let's not do it. He may say to me, Pete, I hear what you're saying, but probability shows us you should do that. Or he may go, thanks for that information. But more importantly, I'm there in the business model I've created, and this may change down the road, the way the market's changing, where what I'm seeing and how I convey that information to my customer, probability and percentages of buy to sell, dollars and dollar numbers buy and sell, percentages buy and sell stocks, to be able to convey that information in a clear and concise way so that my traders can react to it, right, is more important. So, that is a bit of a confusing answer, but it's not, because, some order flow has specific rules, some order flow has some flexibility to it, but net, I'm there to convey information.
Okay, got it. No, that's a brilliant answer, Peter. So yeah, again, thank you. A question I have for you, which I'm curious to know the answer to, is what sort of events lead up to you having your biggest days on the floor? Like, jobs numbers, interest rates, elections, like what sort of events lead to you having a really big day?
So there's two different ways of me having a big day. Okay, so I am a broker's broker, in that for me, I have two customers who I've developed really close relationships with. We are friends as well as business compadres. Obviously, I'm there to make money. I'm not there to make money at their expense. So for me, a big day is when we, and sometimes it coincides and sometimes it doesn't, that they have a big day and I don't. I am a commission broker. Okay, I do not share in their profits or losses. I'm there to execute stock, and I make a commission for every share. Okay, I do never know what they make or they lose. For me, I know if they win or they lose. Okay, so look, in different jobs, to win or to lose is questionable. So it's not always the case when they have a big day that I have a big day. Okay, because I may have had the right call, but it may not have translated into a lot of shares of stock executed by me. I don't know if that you understand that, but let's say this. Let's say it's sort of a quiet. The amount of stock I do on a daily basis is a function of how many shares there is to buy and sell in the marketplace in a given day. Okay, I'm able to interpret that flow and execute stock. Okay, so sometimes for me, I love when my customers make money. I love when I make money, obviously. I don't like it when I make money and they lose. That happens. Sometimes I do I do a lot of business and they lose money. We're on the wrong side of the trade. I ended up billing them for a lot of commission dollars, but net, it's a loser for them. That doesn't make me happy, okay? What makes for a big day for Peter? Okay, so we've had a number of years that have been very busy, very volatile. I make money in volatile markets, okay? I make money with big moves. As I said, I don't own stocks, so I don't really care if the market goes up or down. That being said, a big day for me are S&P rebalances. I don't know if you guys know what that is, but quarterly, okay, so, you have Dow stocks, you have S&P stocks, you have Morgan Stanley index stocks that are Russell stocks. These huge indexes, and funds and institutions have their portfolios weighted in these indexes, depending on the asset value of the stock and where the stock's come and where the stock's going and how their portfolio is acting. They need to maintain a certain presence, a percentage within those indexes. So therefore, sometimes on a monthly, within the Russell 1000 and 2000, it happens monthly. In the S&P, it happens quarterly. In the Morgan Stanley index, it happens 5 times a year. In a lot of these ETFs, it happens more often than that, where things are called rebalances. Rebalances mean there's going to be an inflow or outflow of shares into the index to rebalance everyone within their positions in the indexes. Those are big days for me. That means we're going to get a lot of flow. Those tend to be big movement days. They tend to be directional days. I make money when the market is directional, not when, if I'm able to predict through the information that I see on the floor that the market is going to go up or down in a big way. That's a helpful day for me. So these days happen, and option expiration days are big days. I make my money as a function of how many shares I execute. So, when I make a lot of money, it's obviously a good day for me. But when I make money in conjunction with my customer making a lot of money, and with me making a correct call, see, I sort of look at this as, this job for me is my mission. This job is something I love going to work. I go to work with a broken leg. Right now, I have a boot on my leg because I have a torn ligament in my foot. I have basically not taken a vacation in 4 years. This is a job I love. It's a job I love because I love the energy, I love the action, I love the people, and it's something I love to do. And as I say it too, I mentor a lot of kids, college students who come down to the floor, and I have a son who's studying finance at Bentley University in New York, that for me, the most important thing is to find something you love to do, something that you're passionate about. I've been doing this job since 1985. I would rather do this than anything else. So, for me, every day that I go to work and I get that adrenaline rush, that I'm able to, am I frustrated when when my signals are showing me that the market's going to go up and it goes down? Absolutely. Do I not like I don't like being wrong. I love when I'm able to, when all the chips fall in, and it's the perfect storm and it's a big wave and I'm riding it. I love that. There's nothing better than that. So, what days have been the biggest for me? It's really hard to say. We've, granted, we do a lot more volume on those days I've described, the option expirations, the S&P rebalances. The last day of the months are big days. The last day of the years are big days. Traditionally, our Fed announcement days, big days, they are volatile days for the market. Sometimes they're not as big days for me because the swings are so radical in the market that people are really are cautious on what flow, what side to be on for the closing bell. As I said, I'm a day trader, not an investor, right? So, the flow that comes to the floor on the end of a day on a Wednesday when the Fed has spoken, it can be a confusing spread because the market at 2 o'clock, the market was up 100. The Fed came out with some announcement that no one was able to digest. We went down 200, up 300, down 100, and closed flat. And by the end of the day, the flow was so confused, nobody knew what to do. So those days, while they are volatile and you would think they would be big days for me, are not always that way.
Okay. Got it. So, yeah, I like that answer, and I really like how you highlighted the passion there. And I mean, anyone who has seen your picture, and I presume pretty much everyone listening probably has seen your picture, seeing as you're the most photographed man on Wall Street can see straight away that, there's an undeniable passion you have for the markets. And, we can also hear it in the way that you speak about this. So another question I have for you, and I'm really interested to get your take on this. The way you see it, how significant is the closing price of the major indices?
Well, I actually think it's very significant. So let me give you a scenario, which is sort of something I kind of feel strongly about, and this has come through really me forensically analyzing what's going on in the market over the last number of months and years, actually. So what is different? Yes, we've gone from open outcry to electronic markets. Yes, there's a lot of algorithms being used, which causes big moves in the market up or down. Yes, there's all these other trading platforms, BATS and all these other ARCA and stuff where people trade, where are less liquid markets, where you can move stocks bigger up and down in a way than there used to be. Yes, there's high frequency trading, which is not something I participate in or endorse in any way. But what is it that has made the new normal of a market as yesterday, where the market actually moved 1,000 points in one day? Meaning it was up 200, down 100, up 300, down 200. Intraday, we had a 1,000-point move in the Dow. We had a 350-point move in the futures, and the market closed flat. So where is all of this coming from? For me, I find it fascinating. So I don't know if you guys get to watch it over there, but finance television is a big thing. There are a lot of blogs that you have. There's a lot of webinars about the market and learning how to trade. There's a lot of finance TV. There's the Mad Money Jim Cramer. I don't know if you guys know who he is. He's you know who Jim Cramer is?
I do, yeah.
Okay. So you've got Mad Money. You've got Fast Money. You've got CNBC around the clock. You've got CNN. You've got Bloomberg. You've got Yahoo Finance. So you've got a barrage of information and news services that are pumping information, Fox News, pumping information about the market, okay? You've got round-the-clock tweets and Instagram and Twitters and Schmitters and all the rest of that stuff, which is passing information around. You've got the internet per se, which is just, it's an information highway that's barraging the world with stuff. And then you've got, which I think is a function of all of the things I just described, that in the old days, before you were born and when I was a kid, people made money, and they put their money in a retirement fund, which went into a mutual fund, and they never saw it for 30 years. And they, if they needed it, they sold it. Otherwise, when they retired, they took it out on a monthly basis, but they were not involved in their money, right? There was a limited amount of people. There were people who were in the industry who were obviously involved in their money. There weren't all these hedge funds. There weren't all these ETFs and spiders and futures and all that other stuff. And there were not thousands and thousands of people like yourself around the world who were trading their own money. It just didn't exist, okay? There were, as I described, there were people, you made money, you put it in your 401k, it went to a mutual fund, and you never looked at it again, except if you were in the business. So as a function of all this information and the internet and all this education and all these shows, people have taken, and I think that's the main reasons that I see it. People have taken, and the volatility in the market perhaps, and people loving finance and loving the exposure that, everyone knows about Wall Street. Everyone knows about the stock market. As amazingly as it is, I'm sort of this, fun-loving, crazy guy who's been working on the floor for years and who's become really famous because of my picture being all over the world. And I do, a lot of news pieces. I was on This Week, CNN, Fox News, CBS. I mean, kids come up to me on the street and stop me and want to take their picture with me. I think it's hysterical. I get there are tourists who stop me on the street and saw me on TV. I'm on 1,000 front pages all over the world. So people are involved in this market and they love it. And they've taken their money back and, 10 years ago, there was no group of young people in Australia who were chat with traders. It didn't exist, my friend. Okay? So you've got tens of thousands of people all over the world who are involved in their money in trading the market, right? And that is really, that's an amazing thing, but that's really, that is a function of what's going on in the marketplace today, right? That you've got, and everybody, and what's amazing about the market is, for everyone who's buying it, thinks it's a great buy, there's someone selling it, okay? That person may think they're selling it because they think it's going lower. They're selling it because they bought it cheaper. They're selling it because they have to. But so, you know, the amazing thing about an auction market is that everybody who's buying it thinks that buy is a great idea. And there's someone selling it who also thinks that's a great idea. And now we have tens of thousands of more people in the market who are long or short stocks for any number of reasons. Everybody can interpret all this information differently, okay? We have a market selling off because of oil. We have a market selling off because of Fed fears, because of China, because of European banks. We have people buying gold and selling equities as a fear trade. We've got people who are long Forex and short bonds for whatever reason. We've got people who have been destroyed in the energy trade. Commodity funds are being blown up. We've got so many people in so many complicated trade, and then we have options. So this market is being tossed and turned like sand in the undercurrent of a wave, and everyone has a reason to be there. Everyone has the right to be there, but everyone's there for a different reason, and everyone has a different posture, and everyone is interpreting all this information differently, right? That's why I'm enjoying my place in this industry, because everyone else who's online or who's on TV, you know, giving their explanation, whether it's on CNN or NBC or whatever, about analyzing what happens in a day in the markets trading, are making believe they're economists and all that other. I don't purport to be any of these things. I'm a guy who's on the battlefield there, interpreting what I'm seeing and being very humbled by the fact that there's thousands of different interpretations to all this information. And that's what's making this market move and rock, right? And that humbles me because, you know, this is a market that's not for the faint of heart. This is a market that is moving billions of dollars in moments, right? This is a market that is thrashing and burning a lot of traders. This is a market that in 2015 has taken big fund managers who were, you know, traditionally up 30, 40% down the tubes. This is a market that is losing people billions of dollars, and on the other side, making people billions of dollars. But it's a humbling place to be. It's a dangerous place to be this way. But I think that what's so important is that the crazy, wild, volatile moves is a function of all this information we're getting and all the different interpretations of this information.
Okay, Peter. So just tying that back into the closing price and the significance of it.
I'm sorry, I went off on a tangent.
No, that was awesome. I really appreciate that.
Question, and I gave you a complicated answer. What I meant, well, what I said, I really feel was important, and and I will now finally answer your question. What goes on where a stock opens and closes on the floor of the New York Stock Exchange, okay, even though we only are 25% of the world volume, has an effect, a domino effect, on what happens around the world, okay? Yes, we react to what happened in the markets before our opening, and yes, everything in the world is affected by where we end up closing, okay? So the price and the directionality and the voraciousness of our closing prints, whether it's the S&P futures, whether it's the Russell, whether it's the transports, whether it's the price of oil or the price of gold, where we end our trading day goes on to affect what happens in the rest of the financial markets throughout the world, okay? It's just the way it is. We are no longer the biggest market in the world, but we are the most significant market in the world, okay? And that closing price is going to set the stage in so many ways. Now, there was a time where the closing price, you know, if you closed up 400, you were pretty sure that tomorrow the market was going to go down 100. But or if the market closed flat, it was not going to purport that much interest in the market in the next day's trade. But what ends up happening, if you look, you're a trader, right? You see that last 15 minutes of trading and that last hour and a half of trading in the New York market is significant every day. It's rare that you'll see a flat line from 2 o'clock on, because all the other markets that are closes, people are coming in. Here's an interesting fact that when New York time, 11 a.m. every morning is when the European markets close. Okay, inevitably, you will see a big reaction, whether it's a spike or a sell-off in our market when Europe closes. Now, is that people who can no longer trade in Europe and want to get out of their shares? Possibly. Is it a bet on tomorrow's trade? Very definitely. So wherever a market closes, okay, ours, the most important of all, is going to have a huge effect on what goes on in a domino effect throughout the markets in the world. Okay, short of and in accordance with all the other wild and crazy stuff that's going on. Is there going to be, we closed today down 252 points. That was after a 400-point sell-off, a 250-point rally, a 100-point sell-off, a 100-point rally, and a 50-point sell-off. Net at the end of the day, after a 1,000-point move, we closed down 250. Does that down 250 feel like a win, sort of? Yes. Was gold up 50 points? Yes. Did oil actually close down below 27? Yes. Are these significant facts? Yes. Did the Dow close down 255 points? Yes. Is that 150 points off its low? Yes. How is that going to affect tomorrow's open? Well, my feeling is that it closed in a weak posture, okay, because it did not sustain the rally we got by the OPEC news. So I kind of think that this downward trend is not over. Now, what's going to happen overnight in Europe, in China, with European banks? I don't know yet. Is that going to affect what happens tomorrow morning? In a big way, okay? So in answer to your question, does the New York close? Is it significant? In a big way. Is the directionality, is the intent of the buying or selling that leads into the 4 o'clock close in New York important? Incredibly so. Is what happens after we close and we go to sleep and you guys wake up and China wakes up and the Far East wakes up and Europe starts trading again, is that going to affect the significant open tomorrow morning? Absolutely. So, all a very long-winded Peter Tuchman answer to your original question, and all that I've given you is that the markets are trading 24/7. There's millions of people in the market. There's a million different interpretations to all this news that we're getting. And there's so many factors affecting this market, whether it's gold, whether it's oil, whether it's geopolitical, whether it's just a broken market, whether it's banks. Every market's close will affect those that come after.
Sure. Okay. Now that's an awesome answer, Peter. Thanks so much.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved, now so has the way traders operate within them. Trade the Pool.
Now, I couldn't have you on the podcast without asking you about some of your most memorable moments from participating on the floor. So I mean, let me just ask that. What are some of your most memorable moments from participating on the floor?
Okay, I'll go back to the crash of 87 as a clerk. Market closed down 660 points. That was probably the scariest I've ever experienced, perhaps because I was young and new, and the market was way lower than it was. It was all humans. Stocks were careening. You know, a lot of people went out of business that night. Black Friday, as they called it. Stocks, you know, I was trading a stock called Digital Equipment at the time. It was a $150 stock, and it closed down $68. I was clerking at the time. I was under a lot of stress, and I was receiving hundreds and hundreds of orders at a time. It felt to me what it must have been like in 1929 in the crash. It was just like, go sell them, just sell them, I don't care. And orders were just being sent in barrage amounts, and it was fear and panic. That was the first one I experienced. Let's see, what happened in the 90s? I don't remember the 90s that well. Very funny. I don't remember particular episodes in the 90s that, you know, there were some big exciting days for me where I crossed millions and millions of shares for a customer, and news came out and stocks were up or down. Nothing is really ringing out in my mind at the moment. I would say that, you know, the 2007, 2008, 2009 period were significant days, those down 1,000 days. That was sort of the beginning of my, where pictures started to be taken of me. My hair was at its peak of wild and crazy. Markets were moving radically. It was sort of our first experience of an electronic market moving in 1,000-point swings. And that was, those were kind of significant, scary days. You know, for me, a scary day are days where you're feeling panic, and you're feeling unclear of what's going on. I lived through 9/11 on the floor of the stock exchange. That I would have to admit, not from a trading point of view, because we never opened, but being on the floor of the stock exchange, walking out of the subway after the first plane had hit and seeing a piece of the fuselage on the statue of George Washington, being in lockdown on the floor of the exchange, being evacuated at 11 o'clock through 3.5 foot of ash and black smoke was probably one of my most unpleasant, traumatic days. I would think that once the market reopened after 9/11, which was a week later, was an exciting, uplifting day, that we had survived and that we were resilient and resolute and that they weren't going to get us. And so that was a significant day. As far as exciting moments on the floor, you know, if your audience looks me up on Google, you'll have 100 pages of fun, exciting pictures of me with celebrities and whatnot, as I'm sort of, as you said, the most photographed man on the floor of the exchange. I am somebody that's engaging and fun and humorous and you know, one of the big supporters of the floor, and the floor loves me and I love them. So that's kind of fun. I would say meeting Sean Connery and some fun comedians and some great entrepreneurs have been great moments for me. As far as trading goes, you know, I would say the last 2 months have been significant. They've been exciting for me. Intraday moves of 1,000 points are exciting. Big winning epic days for me and my customer when I'm able to pick the directionality of the market and be right have been great. Wonderful episodes on the floor of the stock exchange, I would say, was the year of 2013 and 14 in the IPO market. So you're a trader. I'm sure you've been involved in some of them, but you know, we've unfortunately the volatility of the market has sort of put a lot of these IPOs on hold. But 2013 was an extraordinary year. You know, we had Twitter, we had Facebook, we had Alibaba, we had a lot of these. We had LinkedIn, we had Tableau, a lot of these internet cloud companies and whatnot. And you know, if an IPO on the floor of the stock exchange is probably one of the most exciting places to be. Okay, for us as traders, it's exciting. because our value is at its premium, because we're able to convey the information necessary for customers to get involved. For me as a trader to be there to entertain the CEOs and the dream team, as we call them, the group of the corporate managers of the company, and to see them, their eyes light up when they go public and they hit that bell and that first stock, shares of stock trades, is a super exciting time. Have there been IPOs where I've made a lot of money in the first 20 minutes due to a business model I've built? Absolutely. I bought Alibaba on the open, up $40, and it went up another $40, and I was able to make great money for my customer. Twitter, another one. It was an honor meeting those guys. The stock has not done well since then, but Jack Dorsey and that group are an exciting bunch of people. Watching Shake Shack, one of the great hamburger companies of modern day hamburgers in the U.S., go public was an exciting day. So, for me, I love the fanfare. I love the celebrity. I love the energy. I love the action. I love crowds of people at work. I'm sort of a homebody from the other side of my personality, which you wouldn't think so. But, the adrenaline rush, the excitement of money, the excitement of trading, to be at the, I don't mean to, I was going to say ground zero, but ground zero is like the battlefield. I don't mean to demean people who fight in our armed services or the place where 9/11 happened, but to be at ground zero for information and for trading, to be at the bottom line, to be at the cutting edge, to be at where all the information trickles down, is a huge adrenaline rush. It's a huge level of excitement. And then to hop on that train and be part of the movement and make your customers happy is probably one of the greatest highs there is.
Yeah, no doubt, Peter. And I'm glad you brought up the IPOs. That's actually something I was going to ask you about anyway. So yeah, that was really cool to hear about some of your most memorable IPOs. Anyway, Peter, we should probably wrap this up. I just have a question. Where can listeners go to find out more about you?
Well, so if you want to know a little more about me, as I said, you can Google me and you'll be able to find, I've been on thousands of front pages with stories. There was a wonderful article which I would love people to read, which was by Market Watch, where they said there would never be another picture of Peter Tuchman on the floor again. There was sort of an article written by the haters who think that the floor are a bunch of clowns who don't really represent any significant added advantage to the marketplace, and we are just sort of cardboard cutouts and don't mean anything. And I wrote a rebuff which was touted all over the world as a significant piece of journalism. So I would appreciate if people read that. Picture-wise, there's pictures of me all over, and you will have fun with that.
Now, you're also on Instagram and YouTube.
I'm on Instagram as NYSE Einstein. I have a YouTube channel in conjunction with Wirtschaft Television out of Germany. It's called NYSE Einstein. Also, it's on YouTube. I do a market wrap-up every day for 3 minutes with different accents, with sort of a sense of humor, but with a seriousness of every day's trading. So that's available every night. You can look it up on Wirtschaft Television or YouTube NYSE Einstein. And I have a commercial. I do a lot of stuff on. I'm going to be writing for Barron's soon, I hope, and I do a lot of stuff on CNBC, Fox News, CBS, and whatnot. But what I'd love to share with your guys is, so I've described to you that I am not an investor. I've never owned stock, and that day trading for me is something that is a discipline, in my opinion, and that it's something that your audience are young traders who are day traders. And in this ruthless market, I would like to impart onto them some information that may be helpful. I worked with a guy on the floor many, many years ago who was a trader, a market maker, who got a big buyout and went on to lose all his money trading. And then he realized that if he learned the discipline of day trading, which is an art, which is a discipline, and which has taken down some of the greatest minds of the world, that you can actually make money in this market, whether it's swing trading, technical trading, or just market trading on a daily basis. So I work with a gentleman. He's at a company called T3 Trading. His name is David Green, and he runs a webinar, he runs a chat room, and he runs a trading school. And he's asked me to let everyone know in your circle, Aaron, that if they called 1-888-998-3548, or they went online to t3live.com, Trading Lab, that they could be part of his chat room. He's offering, and code word green, it's called the Green Room, code word green, that he will offer them a week of free trial in his mentoring chat room. And I recommend everyone to go online, look up T3 Trading, look up David Green, take his offer of a free week with him, because in my opinion, of all my years of trading, he is a master. He's somebody I use as my go-to guy. If anyone needs to contact me, NYSE Einstein on Instagram, they can contact me through you. I offer them the Green Room as an amazing, lifelong mentoring trading place, and I wish everyone good luck. This is a rough market, man. You know, this market has taken out everybody, and it's not going to get any easier right now. So any help, be humble, ask for help. Doesn't mean, you know, asking for help in trading is not assuming that you're a loser. It's a way to win in this market, and this market is ruthless. So I beg everyone to be humble and ask for help in this, and learn as much as they can about the discipline of day trading. These are new times we got going. These are new rules, man.
For sure. So I'll be sure to include all of those links at chatwithtraders.com, including the article you mentioned there as well, Peter, which I read prior to hopping on this call with you. And yeah, really great article. So that'll be in the links at chatwithtraders.com. Everything will be there, all in one place. Now, Peter, let's take this out with a bang. What 2 words are you most famous for?
Well, I'm famous for the word giddy up.
That's the one I was looking for.
Giddy up. All I can say is, guys, yeah, these are just amazing times for you guys to be young, fun traders. I just say giddy up, guys. Just, you know, this is, and I say booyah, which is a big mad money name. It's like you got to trade with energy, trade with exultation. You know, jump in. Don't get stubborn. Don't turn a reasonable profit into an unreasonable loss. That's all I can say.
I like that. I like that. Excellent stuff, Peter. Thank you so much. It was a huge honor to speak with you.
Honor to speak to you. I'm excited for you. I'm always available for you and your people anytime, anything I can do to help. I'm here to mentor anybody who wants to be involved in this market. It's the greatest place in the world, and I wish happy trading, man.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations, this is the next level.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Hey there, what's up? How you doing? You're listening to episode number 60, and my guest this week is Ari Pine. Ari has been trading for many, many years. I'm not sure on the exact number, but during this time, he's filled a whole range of roles and positions. Some of those include working at JP Morgan, developing risk management software, trading for a long volatility hedge fund, making markets in gold and silver options, and even giving presentations to the Chinese Stock Exchange. But moving forward to current times, Ari is now in charge of building out a quantitative trading group, approaching the markets from a scientific perspective. Our conversation includes all of the above, plus some really valuable info about positive expectations, the law of large numbers, and process over outcome. Now, guys, I just want to point out to you quickly, the trading group Ari is involved with, Tradeco Global, is a subsidiary of Trading Technologies. Now, even though TT were a recent sponsor of this podcast, this interview is completely separate from our sponsorship arrangement. So just so you know, I was not paid to do this interview. It was totally organic. All right, I think that's all for now. You're listening to the Chat with Traders podcast. Here's my interview with Ari Pine. Hey, Ari, what's up, man? How you doing?
Good evening. Very nice to talk with you. Thank you very much for having a talk with me. You're putting me in some pretty good company.
No trouble, man. Now, you're in New York. How is everything there? Is it all back to normal after the huge amounts of snow that came through the city?
There's got to be people that are in the Midwest that just look at us like, what a bunch of whiny kids. Because, it was a pretty good dump. We had 20 inches, but you'd barely know it now. We had quite a few warm days, and much of it is gone.
Okay. Yeah, because it was it was all over the news here. Well, not all over the news. It wasn't breaking news, but it was on pretty much every night for about a week. So
So you're saying you had no real news?
Yeah, pretty much, but as expected. So anyway, Ari, thank you very much for coming on the podcast. Let's start with the first question I have for you, and that is, what was your very first involvement with markets and trading?
So when I was in college, I was very fortunate. I was in engineering school out on the West Coast, and I'd been looking at computer and electrical engineering, and somehow I stumbled upon neural networks. And now I think there's basically, they call it deep learning now. But at the time, it was pretty exciting. There were some big hitters in the field where I was. And I got pretty excited about it. And another student and myself started to try to take a look at using neural networks to look at stock prices. And stock prices were really the only exposure that I had at that point. I didn't really know really anything else, or really had a sophisticated idea about either economics or trading or really even stocks. But beyond that, nothing. And I was also fortunate to get recruited to JP Morgan right from school, which I thought might be fun, even though I was going to leave the California coast. But I figured maybe going to Manhattan for a year wouldn't be so bad. So when I got to Morgan, I thought that, or I should say, I didn't even know what a bond was. That's how little I knew at the time that I came into New York and into Wall Street, is I really knew so little. And fortunately, they had a very good training program. And the moment I walked in, I remember it was Jeremy Siegel showing up with some slides from the Bloomberg bond quote. And something in my head clicked, and I said right at that moment, this is really what I want to do. I just loved it. I wanted to be involved with it. And it was really right from that get-go right there. And so that's kind of where I started. I began actually in a technology group and found that wasn't the path that I wanted to go down. So I requested to move over to the fixed income floor. And this was quite a bit of time ago. This was 92. And so fixed income was at that time was huge. It had just come off the time when, if you have listeners out there that remember the Michael Lewis book, Liar's Poker, this was really just after that. And it was kind of funny to put it all in perspective because it had quite a bit of reality of how things really, like people's attitudes at that time. So I ended up going to the fixed income floor right as equities were about to eclipse fixed income as the leading product of the time. But that was basically my start.
Okay, very good. So I believe before you went to fixed income trading, you also had another position before that at JP Morgan. Could you tell us a little bit more about that?
Yeah, that's kind of a probably a far too familiar refrain from either Wall Street or just big companies in general. So as I said, I had a lot of experience or a reasonable amount of experience in neural networks. I was literally writing software for some Intel chips that were supposed to be analog neural network chips, which is getting a little deep into it. But the point being that I had a pretty decent knowledge of this field by the standards of the day. And I came to Morgan into this advanced technology research group, which was supposed to look for new and exciting technologies and see what could be applicable at the bank, which is really quite a good idea. When you're talking about a bank like JP Morgan or one of the big banks, it's kind of it's basically sort of an incubator kind of situation. Well, at the time that I was there, they had a neural network group, but the irony was none of them had any background in neural networks other than what the software vendors had told them about neural networks themselves. In typical sort of corporate fashion, here I was on the other side of the fence, and nobody really wanted anything to do with me as far as neural networks went. And I guess ultimately that sort of fizzled out on their side. On my end, I was actually kind of fortunate because they had me working on data visualization, which I think is something in the way that we looked at it at the time is sort of underappreciated, I think. And it's something, it kind of gave me at that time, both the data visualization and my original interest in neural networks I'd always wanted to combine that technology viewpoint into a proprietary trading framework. But what happened in my trading career was both at Morgan and then when I went on to the exchange floors, I really spent much of the time making markets, which didn't really lend itself to doing that sort of research in either neural networks or data visualization or just, really hardcore data analysis at the time.
Okay, so let's just take a second to explain what are neural networks, just for those who are unfamiliar.
Well, basically, this is, this is pretty good timing. I don't know whether your readers are aware of a pioneer in the field, a gentleman named Marvin Minsky, who happened to have passed away 5 days ago. And there's some very nice things put up in his memory that are on the web that I was just reading the other day. But basically, the idea behind a neural network in a very simple, high-scale view is that it looks to replicate the way that the mind works. In other words, it tries to create very simple parallels to a neuron and then basically connect them in a myriad of ways to mimic the connections in the brain. And then it looks to, you train the neural network. You basically, rather than say, these are this is how it should all work, you have the neural network, quote unquote, learn by experience. In other words, you keep showing it new data and you tell it what it should learn from it. And there's an algorithm that feeds back into it and has it optimize the weights. From an analysis perspective, it is essentially an incremental regression. So if you're familiar with regression analysis and statistics, rather than doing everything all at once and getting your numbers in the neural network, essentially what's happening is you're going incrementally, and it can look at very complex nonlinear relationships as well.
Okay, so it's essentially machine learning. Is that another word for it, or are they two different things?
Yeah, that's the popular term for it now. Yeah, I probably should have brought that up when you first mentioned it. But yes, that's exactly right. So, yeah.
Excellent. Okay. All right, Ari, well, let's continue moving forward and jump back to your time on the floor of the exchange. So you mentioned that you were trading fixed income. Were there any other products you were also trading? And what was your experience like just in general while trading on the floor?
My first experience trading on the floor was going out to San Francisco onto the Pacific Exchange, where I traded stock options. And that's another situation where I really, even when I was at JP Morgan, I kind of knew that, I would talk to the CME to hedge in Eurodollar futures at times, but I didn't hit me that there were other people on the other end making markets and what their lives might be like. And so I didn't really get a sense of that until I went out to the Pacific Exchange. And, it's a very, different world. The people that you meet on the floor are, they often get a bad rap. And I happened to go when, in the 90s, when the stock market was going crazy, really a good time where there were a lot of traders that didn't really necessarily know as much about what they were doing as maybe you'd expect. But by and large, these were, very bright people who either weren't, looking or fit for your traditional suit and tie corporate kind of jobs. And but they are very bright and usually quite creative and can be quite aggressive at times. And that's one of the things from the exchange floor that makes it that it's not for everybody. It's a very, very aggressive place, even when people are, decent people.
Okay, Ari, so how long were you on the floor trading or making markets? And then what led to your decision to leave?
So I spent about 3 years on the exchange floor on the Pacific Exchange, and I was getting to the point. What I'd actually done was every evening I would come home and I would practice, in a sense. I created these sheets where I would write down all of the relevant market data from the day, in the sense that I would write down all the closing straddles and strangles and relevant sort of spreads to me as an options trader. And what that would end up doing would have me practice my fraction adding and subtracting. That sounds like an odd thing to want to practice as a trader, but it turned out that despite my years of school, hopefully some trading acumen, and overall trading experience, what really could pay the bills was if you could add and subtract fractions really quickly. And I was very fortunate that I was able to do that pretty quickly. But I would take notes and I would try to keep track of, how straddles traded. And I would at times go back and refer to them. So I would use this to look at when earnings would come up in, say, Microsoft, which I had traded for a while. And I would look at the range of the straddle, which would be the closest, the option struck closest to the current trading price of Microsoft, and look at how low it got and look for an opportunity potentially to buy into the straddle or sell the straddle if it got too rich, and use this as a basis for historical data analysis. And this was all done in writing. And so come around 1999, which at that time was when the exchanges started to list everybody else's products. So I need to explain that a little bit. But way back in the day, there were 4 options exchanges in the US. And each of those exchanges had their own products. If you wanted to trade Microsoft options, you only could go to the Pacific Exchange. Likewise, if you wanted to trade IBM options, those only traded at the CBOE. Well, what happened in '99 was everybody started listing everybody else's options. And this, unsurprisingly, was clearly having an impact on trader margins. At that time, I got more interested in using this historical data. And along with a friend of mine, what we did was we started collecting the data. We formed our own company, started collecting this data, putting it into a database, and calculating all of the implied volatilities on the 3,500 odd US stocks that were optionable, that had options that traded. Now, if that might seem like something that's pretty common now, there are sites like iVolatility and Option Metrics and so on, but at the time that we were doing it, nobody else was, at least not for external consumption. So I know that at least 1 or 2 of the banks had exactly this sort of thing. I know that others did not too, but it was not publicly available. And so we decided that we were going to focus our effort on that, partially because we thought that was a way for us to find edge in our trading. But it was also 1999. And for those of you old enough to remember, that was the dot-com boom. And we happened to be in San Francisco. And so our thinking went along the lines of, if some guy with a sock puppet can get a valuation of hundreds of millions of dollars, well, we've got a real product. It just turned out that people were more interested in the not so real products versus the sort of practical, down to earth, and potentially more niche products like option volatilities. So that's where he and I went next. And unfortunately, our timing was fairly poor, as soon after that, soon after the dot-com boom came the dot-com bust. And we were pretty squarely in that timing of the dot-com bust. So that didn't really work out. But what did end up working out is that one of the hedge funds that were using our tool called me up and said, listen, we really wish you the best. We hope you make billions on what you're doing. If it doesn't work out, we'd love to have you over here to trade in our long volatility fund. And at that time, which was 2001-ish, my wife was pregnant with our first child. We wanted to get back to the East Coast, and this sort of fit everything along with the whole not making money thing. So it seemed like a pretty reasonable decision. And so we moved back to the East Coast, and I was fortunate enough to join up with a couple of extremely bright and very down-to-earth traders in, unsurprisingly, Greenwich, Connecticut.
Okay. So what were some of the things that you picked up from those two long-time traders that you'd been put with?
Quite a few things, one of which is integrity. And I think that's, my saying that would make them both quite proud. They're both very, very bright guys. A couple of Greek guys. I really think the world of them. And so I started learning how to think about taking proprietary positions rather than merely being a market maker. So this was a long volatility hedge fund, meaning that they invested in long option positions. So they would own options rather than either doing some long and some short, or doing short options, or sort of picking. They were meant to be, at that time, before the VIX was tradable, I might add, they were looking to fill that role. So they viewed themselves as something that you could put in as part of your portfolio, and they would have a smart investment into options, and it would work well with the rest of your portfolio. So you start at that point, you start thinking about what causes volatility, about which positions should you get based on a variety of inputs. So you may not always choose necessarily the one with the lowest implied volatility, but there are multiple factors when you're trading options. It's one of the things that makes options trading so interesting and yet so challenging. And just overall, the difference between making money for yourself and doing the best you can for your investors. And these two gentlemen really focused on trying to deliver the best for their investors. So you'd think that a couple of guys that had graduated also from different Wall Street banks, so they had come from a couple of other top-tier banks, that they might be interested in structured products, complex derivatives, and so on. And they knew that that sort of structure was not generally accretive to their investors, that it tended to benefit the sell side or the professional traders that were selling it. And so they avoided that. And they went out of their way to do so, even though that probably would have made them more popular with the banks and with other order flow providers. We also happen to share a building with the Bayou Fund. And you probably have no recollection of the Bayou Fund, but what would happen is there was this hedge fund that was located in the same building, more or less, and they would come in, their accountant was downstairs, and every month there would be this huge argument over how to mark stuff to market. And I didn't really pay much attention to it until one day that one of the two partners said to me, he said, "There's something wrong. This shouldn't be so difficult to figure out how to mark to market things. If this is what's going on," he's like, "something's not right." I thought that was really significant for a couple of reasons. One, it means essentially what you might call, if you ever listen to, let's say, Strat4, is they'll talk about situational awareness. In other words, paying attention to what's going on around you and trying to find those things that just don't seem right. And so I started to pick up on that, and I started to think that that was a deficiency that I really needed to work on in my own both life and trading, is to start catching those things that don't make sense. So I thought that was very significant in and of itself. It also turned out that he was absolutely right. And in about a few months afterwards, if you go look up Bayou Fund, these guys had been cooking the books. They had been, it was basically one of the first Ponzi schemes that had sort of, not first, but around that time that it started to unravel. And it ended up, a few of them went to jail. So that had a big impact, at least intellectually, on me, and I have not obviously forgotten that.
Interesting. Okay. So you mentioned there was obviously a big argument every month about how to mark to market. What's that referring to?
So most of your listeners are probably familiar with the listed markets. And by listed markets, that means listed on an exchange. So if you're trading, let's say, Aussie stocks, I'm probably going to embarrass myself by thinking I'm going to name an Aussie stock, and it won't be, but I'm thinking Freeport McMoran. Is that right?
Not sure. Let's just say Apple.
Of course. So let's say you're trading Apple. When you're trading Apple, you know exactly where it's trading. You can see it. It's got a very tight bid-ask spread. There's a settlement price that's given by the exchange and generally agreed upon, and there's really no discussion on it. If you have your statement from your broker, it says Apple settled at $97.27. It's that simple. However, if you're trading something that trades OTC, something that might have a wide bid-ask spread, that is a convertible bond that may not trade that frequently. Generally, what's done is people construct a model and try to value it. Now, if you are what one of my later partners would say, if you invested in intellectual honesty, you will tend to mark that conservatively because you will naturally assume that if you're able to buy at a certain price, there's a reason why, or sell, there's a reason why, namely that somebody probably knows more than you. But nevertheless, these things are not very liquid, so you have to come up with some price. What they would do, even though their securities ended up going further and further underwater or going against them, they'd be losing money, they would try to mark them as much as they could to show that they were making money. And trying to figure out what assumptions that you put on your modeling in order to price these is where the arguments would come in. And so there was a level of discomfort between the accountant who had to file the documents, meaning the end of month or end of quarter statements that would go out to investors, and the partners of the fund that were looking to show results as good as possible to continue money coming into the fund. So I don't know the exact details, but the point being is that if you're comfortable with your trading, you shouldn't worry about where things are settling or where the mark to market is, what price you put on it. You should be comfortable with the value and how it's going to turn out over time. Did that help?
Yeah, so what are these unlisted products or securities that you're referring to, though? Are they bonds or are they something else?
I don't know the particulars of what they were looking at, but in general, it might be something like an exotic derivative. It could be a convertible bond that doesn't trade very frequently, or some sort of distressed loan or note, or some other type of OTC option that might not have transacted on an exchange or might be on a product that does not trade on an exchange. So if you could imagine that there might be an option that is on a bond that doesn't trade very frequently, you can imagine that the option itself would have quite a bit of leeway as to where it should be valued. So that's where some of the difficulties in actually coming up, the legitimate difficulties of coming up with a price that should be on the securities that you have in one's portfolio. So that's where it comes about. It's really anything that isn't on an exchange. The things that most of your listeners are familiar with, stocks, listed options, futures, these are all exchange listed. You can see right where the pricing is. There are definitely some futures products for which there might be a wide market. They might have perhaps a 10-year crude future. That might not have, that might move around quite a bit on their statement, but it's still relatively well known where a fair value is. There might be an OTC forward, which is the equivalent of a future, on some obscure variant of crude oil from a particular area of the United States. And for that, it's very difficult to value. So it really can be any sort of product.
Got it. Okay. So I'm not sure if this was your next move directly from the hedge fund, but I understand that you spent some time in China. What was it that led you over there?
Well, I had left, just by way of creating a segue, I had left the hedge fund in 2003 to go to the commodity exchange, which is where gold and silver futures and options are traded, amongst other things. But that was what I was interested in. And I traded there for about 9 years, until about 2012, till the end of 2012, when I just felt as though it was time to move on. I had left, and I'd actually decided that I wanted to leave trading and had become interested in writing some internet privacy software, when my friend from the COMEX, who I had traded gold options with for quite a few years, reached out to me, said that he had just returned from China, and explained that in China, there were no options. I mean, literally no options. And he said that they were going to be launched sometime in 2015, and that he was trying to negotiate to give a seminar to the Shanghai Futures Exchange. Would I be interested? Well, that seemed like an opportunity not to miss, even if the only outcome was getting a trip to China and seeing what this incredible country and what's going on in its financial markets was really all about. So I was extremely excited about that, and it blossomed into quite a bit of travel, and it was really been very good for me overall.
Sure. Okay. So what were you doing there? You were hosting a few seminars explaining options to traders in China?
Well, what the Shanghai Futures Exchange does is they have periodic seminars for their members, where their members can come and learn about different things, just like you'd imagine here in the United States, whether it might be new regulations, or in this case, it was about options. So we were very honored to give a talk. It was actually a 3-day seminar on options trading, options risk management, and how to hedge using the options market. And I think it was pretty well received. And it was, turned out to be quite a bit more work than I had anticipated originally. But it was very interesting. And the Chinese futures companies were extremely interested to get as much knowledge about options trading from what they perceived to be the experts from the United States, which ostensibly was myself and my partner, Paul.
Right. Okay. Very cool. Well, let's bring things up to speed now. So you've experienced a lot, Ari. You've clearly had many different roles over the years. Tell us about what you're doing these days.
Well, part of what came as the outcome of going to China was that the good people at Trading Technologies, a couple of which I knew, reached out to me and said, "Hey, I know you're busy with this stuff in China, but we have this trading group and we're trying to rebuild it. Would you have any interest in getting involved?" And so it turned out to be a really nice opportunity. I hope they feel the same way. But it's been very good for me. What we work on I run a subsidiary of TT, so it's not TT per se, but I run a company called Tradeco Global. And at Tradeco Global, what I am building is a quantitative trading group. And by quantitative, I don't necessarily mean fully automated or strictly systematic, but really disciplined and rigorous, so that we're going to use all of the tools that are available to us in terms of data analysis. I'd like to get involved in machine learning, but we haven't done that yet. And to approach the market from, I guess you would call it, a scientific perspective, that we're going to try to find regularities, try to make intelligent decisions, and just really be very rigorous about what we do.
Okay, and what's the size of that group? Just to give us a bit more context about what you're working on.
Well, in the past, it had been quite big because it was very oriented around having each person as their own business. I like having a smaller group. I like to have tight-knit and very research-focused. So we are a group of 5 and soon to be 6 once my new hire comes on board, hopefully this month. So we're not a very large group, but we're kind of divided between a couple of people that are dedicated toward research, a couple of people that are dedicated towards execution. The new guy is going to be primarily developer, so programming strength. And then my role is to synthesize it all together and try to take advantage of the experience that I do have to try to guide things intelligently and to blend it all together. So that's really what we're trying to do.
Okay, excellent. Now, in the past, we've spoken before this call. You've described this group as having an emphasis on a top-down and a bottom-up approach. Could you share a little more insight on what you mean by this?
Yeah. So thanks for bringing it up, because I think that is important for our trading group because we do have experience on the trading side, which I would consider sort of the bottom up, right? We are watching the markets. We are, trying to be experts in what we do, in how our strategies are working, what potential regularities that work or don't work. And most importantly, regardless of who's coming up with it, I always want to make sure that everybody is trying to ask good questions about what's going on. So that actually links back to that whole situational awareness that I started learning when I was at Beaver Creek, which is the hedge fund then. So that's the bottom up. The person who's executing, that's at the low level of the market and is making the observations and sees what's going on. So I would like them to come and ask good questions that as a group, we're going to try to answer probably from the research side. So we'll go back and say, oh, I noticed this. Does this actually hold up over time? Okay, so now we go research that. That's bottom up. Top down to me is, we think that there might be an opportunity in X. Okay, now we research it. We come up with something that you might think of as being somewhat academic. We might even take an academic paper and want to pursue it, right? That's from the top down. So then we come up and we sort of dictate that, hey, we should do the following strategy. This is what we're looking at. These are the instruments. This is how we should trade it. But ultimately, neither one of them is going to be the best route without the other. An observation needs the disciplined research as the follow-up, and the research needs the feedback from the actual execution to make it work properly and to turn what looks like a regularity into a profit.
Okay, excellent. Yeah, and I think we might speak more about that process side of things in just a moment. I would like to ask you that you mentioned with the group, it's not a purely automated or systematic approach to markets. So what aspects are discretionary and what aspects will be automated to some extent?
That depends on the situation, and that's a little bit of human judgment as we go along. So there may be some strategies that we run that might be fully automated. And it also depends, if you think about the different products that are out there. If you're trading something that is very liquid, such as 10-year note futures or Eurodollar futures, that's something that probably can be very automated, that you found some, hopefully you found some real regularity, you found a real edge, and you want to pursue it. It's relatively easy because of the liquidity in these products to execute, to provide stop losses, and so on. And the execution part of it, because bid-ask spreads are so tight, or you can buy on the bid or sell on the offer at times, it means that the value added by the trader or the execution person, there isn't that much added. As compared with, say, a far less liquid future, on the extreme might be that you've come up with a model for how milk futures should trade, right? And there, it's probably somewhere where a human being is going to have far more to add. Probably a better example might be in options. Some of my friends that are still on the Pacific Exchange, they don't go compete so much, at least in a market making sense, in Cisco options, which are super, super liquid, or Apple options, right? Apple options might be better because the dollar prices are large. But overall, there may not be that edge for a human being to go from eye to hand, or, to not intervene at some point, right? It may make sense to be very automated in what you're doing. On the other hand, if you're trading a deal stock or a biotech stock, these are things where there's either bipolar output, if it's earnings coming up, or an FDA approval, meaning a regulatory approval for a drug that might be coming up, or an approval for a merger or acquisition. These are things that machines don't really do well. They can't deal with some of these externalities or irregularities. So I view each particular situation as being somewhere on a continuum between where is it a algorithmic edge and where is it a more creative edge.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved. Now, so has the way traders operate within them. Trade the Pool.
Now, there's a few areas I'd like to explore a little more with you. Those being probabilities and process, trade management, and also some more about options. But let's start with probabilities and process. So one of the things you've expressed to me in past conversations is the process is more important than the outcome. Would you mind elaborating on this and maybe explaining why you feel that way?
Yeah, this is one of those things that, if you really do believe in process over outcome, you can feel like a long-suffering person trying to tilt at windmills. Most people will judge decisions based on the outcome. In other words, actually, there was I was watching, I don't know if you follow hockey or not, but there was the NHL All-Star game on earlier, and they were talking about a player, Ryan McDonough, who now plays for the Rangers. And I'm going to mangle part of this story because I like watching hockey, but I don't follow it to that extreme. And they said, and you know what? I even forgot what team traded him. I think it was Buffalo. The point being is some team traded him. He's a great defenseman. And, no, it was Montreal. They said, Montreal will look at that as the worst trade. Yeah, but you can't judge it based on the outcome. Nobody knew at the time. If they knew at the time that Ryan McDonough was going to be one of the great defensemen in the league, of course it would be a bad decision. But it wasn't clear at that point that he was. And so you have to evaluate your decision-making process based on how you made your decision, not on the outcome. Because if you think about it, you're going to end up with a box. And unfortunately, we don't have video here. And there's Michael Mauboussin has written a great book called More Than You Know. And he's used this grid from, I think, somebody else. But the basic idea is that you are either going to have a good decision or a poor decision. And then if you think about it as being a grid, then there's also going to be a good outcome or a bad outcome. So you can make a good decision and have a good outcome. And so they call that earned reward, right? You made a good decision and you got a good outcome, deserved reward. And you can also think that you can make a good decision, that you've got a 90% chance of making a ton of dough and a 10% chance of losing a little bit, and you can still lose a little bit. Okay? That's just the way that it goes. And I think we've all had trades where we felt that we've made either a good or a bad decision and had an outcome, either good or bad, along with it. And if you want, I can go into an illustration of two trades I happened to do at the same time where I felt like one was a good decision, one was a bad decision, and the outcomes were sort of independent of that. And that's really how you have to look at it, that there's a good way to make a decision and a bad way, and the outcomes are what they are. But you need to keep focus on making good decisions, and hopefully over time, the law of large numbers will work in your way. In your favor, I should say.
Yeah, that's a really cool analogy, and I think it actually helps to make that saying quite a lot clearer. Because I mean, we do often hear the process is more important than the outcome, but sometimes we can really just question that. So yeah, I think that actually made it a little clearer. So no, that was good. Thank you very much. Now, would you be able to share an outline of the process your group actually goes through to discovering potential trading ideas? Like from the point where you mentioned earlier that someone might ask, a good question, how do you go about finding the answer to that? What's your process for that?
Well, part of the idea of having a good question is that you phrase it in such a way that you have a shot at getting an answer. Right? Your question can't be, how do I make more money? Right? That's very vague. It might be that I notice that the market is 4 times more volatile on a non-farm payroll day than it is otherwise. Can I confirm that? How consistent is that? And let's investigate that further. Or you might, and I don't know whether this is true or not, but you might say the first direction I've noticed ad hoc, from watching stuff, it seems to me, which by the way, I should say that more likely than not, your observations due to behavioral biases, right? There's plenty to read about that, but your anecdotal may not be right, which is why you have to go and verify it afterwards. But let's say that you've looked at the past few non-farm payroll numbers, and you say the first move in 10-year notes right afterwards, you want to fade. In other words, take the other side of it. Rises, you want to sell it right away. Because eventually, like after a few minutes, it's going to come back hard the other way. Whether it's, first it goes up, then you want to sell it, or first it goes down and you want to buy it. So then you'd go back and you want to go find the data and verify whether in fact, one, does that in fact occur? Is this a real regularity? Is it a real observable fact? And if so, what can I say about it? And by what can I say about it is what is the magnitude? What are all of the factors? Think about all of the factors that might go into a trade. Do I put in a stop loss? Well, how does that figure into analysis? Well, what is the typical size? Does the size of the move after a number impact how it might react after? So you continually, even when you're doing the research, you should be paying attention and asking questions, and taking very careful notes. It's really one of the important aspects of trading is being organized and dotting all your I's and crossing all your T's. It's not really terribly glamorous. It just may seem that way sometimes because you'll see some people who, for some period of time just seem to be on top of it. But my experience is that the successful traders in terms of risk-adjusted returns are the grinders. Now, that might be because of my particular experience in making markets, but I tend to think that even in the sort of Stanley Druckenmiller crowd, and not that I have personal experience speaking with him or of the heavy hitters, but I would think that they spend a lot of time doing research. And if you listen to Warren Buffett or Charlie Munger, what they say, they talk about reading an awful lot, spending 5 to 8 hours a day reading, which, in the case of a quantitative trader might not necessarily be the same reading, but it might be data analysis, or it might be, in fact, taking, some course online to try and learn something else, or even, taking some sort of just learning something about a different field that might give you some insight about slicing data in a slightly different way.
Yeah, you hit on a lot of really valuable points there. I like that answer. So I think this probably leads on from the outcome. So again, referring to something you mentioned to me off air, you were talking about how you aim to be in a position of positive expectation. What does a positive expectation look like, and how would someone know if they have one?
I guess we can start with the definition of a positive expectation. And again, I happen to be reading Michael, and I'm probably mangling his name, so apologies to him because he's done a great job, and I think quite highly of him. Michael Mauboussin. The book is More Than You Know, and I'm not trying to plug his book. It just happens that I'm reading it, and he talks a lot about how great investors focus on positive expectations. And a positive expectation means that you're not merely looking at either the probability of gain or merely the magnitude of gain. It's that you take the probability of gain and you multiply that times the magnitude of the gain, and you do the same for the probability of loss and the projected magnitude of loss. And when you take the probability weighted gain less the probability weighted loss, if that number is positive, that's a positive expectation. In other words, based on the probabilities as I see them right now, there's positive expectation of a profit. Okay? Now, of course, the natural question is, yeah, but I don't know any of those numbers. And that's absolutely the case. We don't. So how do we go back and take a look at that? Well, we can start making pretty good guesses based on some historical either rules of thumb. So if you're investing in credit, maybe you have a pretty good idea of if something goes into bankruptcy, if a company goes into bankruptcy, that a certain type of payout can be thought of as being expected. And then you can figure out what the magnitude will be, which is fairly easy if it's a note, meaning debt, because it's either going to be anywhere from 0 to 100. On the other hand, it's much harder to figure out what your magnitude of loss might be in a 15-minute period for gold futures. That's rather difficult. But what you can do is you can make certain guesses based on And this is really where your research comes into play, is that you're going to make guesses based on your research, and then you need to take into account that you're not always going to be correct, right? There's uncertainty in everything that you're doing, and that uncertainty may play in your direction or against you. Often it tends to be against you because there's what is called adverse selection, but that's a different topic. So you do the best you can, and you try to have as many, like if you have a situation where you have a positive expectation, you don't want to bet just once, right? If you're the house at the blackjack table and you know that you have a 2% edge on your players coming in, you don't want to have just one player betting large amounts. You want lots and lots and lots and lots and lots of betting going on in small amounts so that you can reap that 2% on average. That's what you want. And that's what I want when I'm trading. I want to find these positive expectations games. I want to bet relatively small amounts each time, and I want to do it as many times as I can. I want to go continually having people coming into my casino. And, that is kind of how I look at the world, right? So, and it doesn't have to necessarily be as a market maker, although it's relatively easy to understand where a market maker obtains his edge. That's relatively well understood. As a proprietary trader, it's much more difficult to estimate probabilities on what the FDA might do or what other investors might do after an earnings release, even if you know what the earnings are going to be for a particular company.
So I was just going to add on to that. I mean, would you say it was trading options and your experience of making markets that actually got you into the habit of thinking this way and thinking in terms of probabilities?
Absolutely. That's one. I don't think it's an accident that Nassim Taleb is the author of The Black Swan. He's an options trader by training. And I think that, quite frankly, if you have that experience, either as a poker player or some other probability business, that it is extremely helpful in the way that you look at all aspects of your life and in looking at the world. So yeah, I think that being an options trader has had a very profound effect on me. I'd also say having a relatively long career has also done that. When we gave that talk to the Shanghai Futures Exchange, my partner said that one of his favorite slides was how if you look at the standard deviation, right? People say, "Oh, this was a 1 in 1,000 year event." They said, I'm sure you heard plenty of that coming out of 2008. We couldn't predict it. Well, if you go through and look, there's about a 1 in 1,000 year event that occurs in finance like every year or so. So it's not really that credible to think in those terms. And obviously, there's more to it than it merely being a 1 in 1,000 year event. There are fat tails in finance. And actually, I remember reading very distinctly in 1990, after 1998 and long-term capital blew up, that I think it was Lawrence Hillenbrand was quoted as saying, trading in finance is not, and selling options is not the same as selling insurance. The fact that you've written a lot of hurricane insurance does not impact the likelihood of a hurricane reaching ground. On the other hand, the fact that you've got a very large position in finance does impact your probability of gain or loss, right? Which is, I guess, linking back to a Heisenberg uncertainty principle, which is to say that the moment you're observing it or the moment that you're part of it, it changes the actual it.
Yeah, and you mentioned Nassim Taleb in there, and that's actually the third time his name's come up on the podcast. So I'm actually thinking he might make a good guest, and I might actually try and get him on. I haven't read The Black Swan or what's his other one, Anti-Fragile. I haven't read those books, but I'm actually very keen to. So yeah, he might be someone I reach out to in the future. But let's move on to the more of the trade management aspect. Share with us your rule for half, your rule of half, and how it's been helpful to you.
Yeah, I don't think that I'm unique in that, and it certainly isn't scientific. I should probably be embarrassed by it, but because it's kind of simple, and after all of my talk about rigor, my rule of half doesn't really sound that rigorous or disciplined, or I should say rigorous. But what I found is that when I do have a position that makes me particularly uncomfortable, that ultimately we are just human beings. And a certain amount of how we perform is impacted by our emotions. And so what I found is that when I've put on a position that even if I think is correct, I will find myself doubting it because the price action is marking it against me, or I just feel very uncomfortable in some way, that I will begin by taking off half or some reasonable proportion of the trade so that I can feel as though I've done something about it, which I actually have. I've lessened the potential for loss, even though I've locked in some loss. But it makes me feel more comfortable, and I can go back to doing what it is collecting those positive expectations. Because ultimately, that is actually the biggest lesson that I learned from making markets is I'm in a positive expectation game. You can't put yourself in a situation to end that game. Not every trade you're going to do or series of trades is going to work out, but you need to be in a position that you can get back to making those positive expectation trades. And so my rule of half is just a way of taming something that's going awry, making it more controllable, and allowing myself to feel more comfortable. And maybe, now that I felt like I've done something about it, that I can think more clearly about the situation that I'm in, and maybe even put it right back on.
Okay, and even with the rule of half, I presume you still know where you are going to exit the full position if things go bad.
Yeah, sometimes, like in what we currently do, sometimes it's a question of, just based on time, because that might be what our analysis is based on. It is what it is. It's up or down, and, we've done some analysis that's time-based, so just get the heck out. Now, when you're making markets, sometimes you don't have that luxury. There is where are you now, right? So you ask, what's your market in X? You give a market. They say, okay, sold all your size that you've got there. Where are you now? And so you're stuck in a position of obligation where if you wish to continue trading, you have to keep quoting. And in those situations, it can get particularly scary because you're a leveraged player, and you don't really know where your exit is going to be. So if I decide that I want to go long 10-year note futures and I'm a proprietary trader, I know that I can be limited to 5 lots or 50 lots or 500, whatever my limit is, because I can stop. But if I'm a 10-year note market maker, I don't know where I'm going to stop exactly. Now, it might be that the clearing firm will stop for me, but things can get pretty scary along the way. And I think that's a little bit underappreciated by the general public these days in many of the criticisms, but not all, of what people are vaguely calling, usually misunderstood, with a misunderstanding towards HFT. So I kind of went all over the map there, but I just wanted to address a little bit that as a market maker, you don't always get to choose what your position is.
Right. Okay. No, that's really good. Now, there's one last thing I'd like to ask you, and then we'll probably bring this to a close. But having spent pretty much your entire trading career in the professional arena, and you've traded many products, you've traded many instruments that the retail will never touch. Is there anything that independent retail traders could adapt from the pros, which would be beneficial, whether that's just how they view markets, how they view risk, anything along those lines?
So I think that one of the biggest, I guess, my perceptions of the difference between a professional, trader, from Wall Street is that you're really thinking as much as possible about those positive expectation trades. You're not, and you're and it's work. I mean, that's basically the difference, is that most of the time on Wall Street, people become experts in a certain relatively narrow field, and they parlay that expertise into their trading success. And I think one thing that also ought to be noted about, even on the professional side, is that for every trader that you do see that has been successful, there's, I'd say, at least a minimum of 99 bodies behind him, or her, I should say, behind him or her, that never made it. So it's often thought that, trading is very glamorous and so on. But many people just don't make the cut, either because they never are able to show enough to get into the seat in the first place, or because they're unsuccessful at what they're doing, perhaps because of the difference between process and outcome, or it may be just that they don't have what it takes to become a trader. I think the fundamental attitude of a professional over a retail trader is that a retail, in my mind anyway, tends to look, and I am guilty of this as well, tends to look at a single instrument and think that without a lot of research and effort, that they're going to have some edge over what they're doing, or that they have not put a sufficient amount of effort into verifying that they do in fact have an edge, and what their edge is, and how that translates into a positive expectation, let alone the probability distribution of that potential positive expectation. And I think that, I'm fortunate enough to have two great kids, and I've had my kids come up and say, "Oh, I want to learn how to trade." And so I sat my son down and I said, well, the first thing that a professional learns is arbitrage, right? We're looking at, can we make money by finding very alike things and, take advantage of making money there. The idea, meaning really essentially that the idea isn't to come up with a super great idea or to have something that's very, quote, sexy to look at or explain, or something that's very complicated. A professional trader is here to make money. That's it. If it's dumb and there's a very easy rote way of how to do it, then that's how you do it. It's not, and you don't have to do it in big size. A lot of money has been made trading very modest contract amounts. So maybe that helps a little bit.
Absolutely. I loved that answer. And I think that, really takes us out with a bang. So thank you very much, Ari. It's been awesome to have you on the podcast. Before you go, can you share with listeners where they can go to find out more about you? I don't know if you're active on Twitter. I know you had a blog at one point. Is there anywhere listeners can go to reach you and find out more?
Yeah, well, you can go to Trading Technologies and find my email there. It's pretty straightforward. It's my name, and reach out to me. And I guess, I have a website, pinert.com, that I haven't really updated that much. And I'm hoping to become more active on TT's blog going forward. And that could probably cover it.
Yeah, no, that's excellent. All right, well, I'll be sure to include those links to your own blog as well in the show notes at chatwithtraders.com. So again, Ari, thank you very much for doing this. It's been awesome to get your insight, and let's talk again soon.
You're very kind. Thank you.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations, this is the next level.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
What's up, traders? Welcome to episode 62. For this episode, I spoke with Tracy, otherwise known as Shy Girl on Twitter. Tracy is a technical intraday trader, but also tracks fundamentals very closely. She solely focuses on the energy sector and has an obsession with crude oil. Yes, obsession may sound like a strong word, but you'll soon understand. During our interview, Tracy shares her story about how she up and left LA to chase her desire of becoming a trader, and how she wound up at a hack shop brokerage, which is best described as a scene from the trading movie Boiler Room. We also discuss the bear market of oil, the impact falling prices have on a macro level, the skill sets that have helped Tracy to survive and thrive as a trader, plus much more. And last thing, Tracy has kindly offered to answer any questions that you may have, whether they're about oil specifically or just trading in general. So go to chatwithtraders.com/62, scroll to the bottom of the page and write your questions in the comments area. All right, team, here we go. I'm your host, Aaron Fifield, and here is this week's guest, Tracy, aka Shy Girl on Twitter. Hey Tracy, what's up? How are you?
Good, how are you?
I am doing very well. It's awesome to be speaking with you, and I think the timing for this interview is really good. Also, seen as oil is all the hype right now, and that's pretty much the niche that you focus on. But before we get into what it's really like to trade a commodity market like oil, let's talk about how you got to where you are right now. So Tracy, how did you get your start in the industry? And just for some added context, what were you doing before this also?
Okay, well, actually, it's kind of a funny story. I was studying international relations with an emphasis on Middle East politics. And I thought I wanted to go to law school and didn't end up going to law school. So I took a job in sales selling medical supplies. And although it was great, I was traveling all the time. I hated it. I was living in Los Angeles, which was great. But I decided one day I wanted to get into this business. So I literally quit my job and moved to Chicago, because that's the place to be if you want to start in the commodities industry. And had never been there before, sight unseen, had no job, just went for it. Pretty much I knocked on every possible door. No one wanted to hire a girl, for sure. I had to beg for my first job, which actually was, I started at the beginning. I started ground floor at a brokerage, which was pretty much your straight out of boiler room hack shop. In fact, they even got shut down by the NFA for something that happened long before I got there, by the way. But I had to beg for my job because nobody thought, nobody wanted women. I was the only woman my company had ever hired. And I started there basically, hacking away the 200 calls a day, asking mom and pop for 10 grand to trade options and futures.
Excellent. Okay, well, let's break this down a little more. So just backtracking a little, I actually understand that your father was also a commodities trader. Did this have any influence on, your decision?
Yeah, absolutely. Absolutely. I mean, I had said it that, I thought that with my background, with what I had studied, being that I didn't go to law school, that I could use that for I wanted to trade oil. So, that was a good background for that. So my father was in the industry, so I was familiar with the industry. So, I mean, it wasn't like I just had no exposure ever to the industry or anything and decided to chuck my job.
Okay. And what was the decision that led up to you chucking that job? And did you reach a snapping point where you just kind of felt like this is it, it's kind of now or never?
Yeah, I mean, I just felt like, I was still young, but I was traveling all the time. I was living in a great apartment that overlooked the ocean in Newport Beach, and I was traveling, 5 days a week, and I was tired, and I was selling medical grade plastics, which if I can't tell you what a more boring subject it is to talk to somebody about medical grade plastics all day, every day. And I just burnt out. Literally, I just burnt out. And I decided that, I wasn't using my degree. I wasn't using anything that I liked. I wasn't excited anymore. And I just wanted to make a change.
Yeah, and I imagine that must have been a pretty big decision to just up and leave LA to move to Chicago at the time. So that's very cool to hear about. And also on that, why did you decide to try and get a job within the industry instead of just trading independently?
I wanted to learn from the inside out. I didn't think I was ready to trade right away. I had no clue about trading. I didn't want to take a bunch of courses. I thought the best way would be to get in the industry, try to get as near traders as I possibly could, and the industry. And working at, the Board of Trade every day certainly was that, and exciting. And, I worked my way from a broker to actually working on the trade floor. So for me, that was invaluable experience. And I just felt I wasn't, having no experience in the industry, I just felt that I wasn't ready to jump right in trading. Not that other people shouldn't do it. And, not that everybody has the opportunity to be afforded to just move to Chicago and get in the industry. And this was also, at an earlier time. It wasn't this day and age where, brokers, you don't really need a broker anymore. Everybody's with a discount broker. You have to remember this was kind of a lot earlier when people still had brokers and whatnot. So it was kind of a little bit different back then.
Okay, sure. No, that makes sense. So from the hack shop broker, that as you described it, where did you go next? Did you go straight onto the Chicago Board of Trade? I think you kind of mentioned that there. What was the next step from there?
My next step was I moved to a broker that was actually a really well-known broker. And then from there, I moved to the trade floor, and I clerked for a trader who was in Fed funds. And then when the market crashed and rates went to zero, we moved to the grain floor because there was really no business left to be had in Fed funds. And then I was head of the trade desk there. So I kind of moved from clerk to head of trade desk in the grains room, and then we moved over to the bond room. Okay,
excellent. And I know you've got a very interesting story which you might be able to share with us, or maybe I should say a kind of a frightening story I'm not sure whereabouts it fits on your timeline, but I believe that you wrote the wrong order on a trade ticket one day. Can you tell us a little more about that?
Oh, that was at a brokerage. That was like one of my first trades. That happened several times on the floor, not by me though. But I had just started, and it was an options trade, and I had written that there's a specific way to write the trade. You send it, and this was before you really traded options on screen. Like the liquidity just wasn't there, so you still called down to the floor. Like I said, this is kind of back in the day. You'd have to write the ticket. You send it to the guy. The guy calls the floor, puts your order in with the floor broker. The broker executes it. And so I, being brand new, wrote down the order backwards. And it was my first crude. It was my first crude trade, actually. And this is when I fell in love with crude. And it ended up that the trade actually ended up becoming a $30,000 winner from a loser. And, I kind of just held my breath on that one. Not that it was probably a good idea, but I was brand new, scared to death to call the client, scared to say, I wrote your order wrong, because really writing the order wrong means you're responsible. That means it comes out of my paycheck. So I sweated out, and it ended up to be a $30,000 winner for the guy. So.
Okay, so lucky enough, it did result in a profit, but at how much were you down during the trade at the worst of it?
At the worst of it, I was down like $5,000. But you have to understand, it was one of my very first trades, and $5,000. I was thinking, how am I ever going to make $5,000 to cover this trade?
Okay, sure.
Literally, it was like right at the beginning of my career, and you're working on commission only, so I barely had any clients. I was sweating it. It wasn't the smartest decision to make in the world. It just, it ended up well. And then after that, I completely fell in love with crude, and I've been trading crude ever since.
Excellent. And we're going to spend quite a bit of time on that. I've got a bunch of questions that I'm keen to ask you around, oil commodity markets. So before we get into that, I'm keen to hear a little bit more about your role as head of a trading desk on the Chicago Board of Trade. Can you tell us a little bit more about that role, and maybe like any challenges you experienced going from the position of a broker to becoming a trader?
Yeah, absolutely. I mean, I was head of trade desk. So basically what we did is we were basically a floor broker. So we executed, but instead of for retail, we executed for hedge funds like SAS and whatnot. So I was dealing with not retail anymore, which is nice. So they would call us, we would give them trade recs, or they would call in with their own trades. I would give them then to the broker, who would execute them on the floor. So it was basically a foray. It was kind of in the middle between being like a broker to, sort of trading, because, we also had trade strategies and things that we had to give to these people. And you're on the trade floor, which is very exciting. Even when it started to dwindle down, I left in 2012. It's still exciting to be on the trade floor. I'm not going to lie. It was super exciting. Every day was a new day. Everything is moving so fast. There's so much room for error, but yet everything works like a well-oiled machine. It's pretty incredible.
Yeah, no doubt. I imagine it would be a very cool environment to be working in every day. So what actually led to your decision to go out on your own and trade independently like you do these days?
Well, the floor was kind of dying, obviously. And so I was trading crude on the side, just in my own personal account, like a small account, startup, because I, got more used to trading and more comfortable, and I, trading options, and started trading futures during, the downtimes on the floor. So then my actual next step was, instead of going out on my own, I actually got a job with a prop firm, which I highly recommend if you can get a job with a prop firm to any new trader. If you don't have an account large enough, or if you want to be a funded trader, it's a really good experience, because it forces you to be really focused and not to do stupid shit, really, because you're accountable to somebody else, and you're trading somebody else's money, and you have somebody always looking over you, and they're monitoring every trade you make. So I think it helps you become a little more disciplined in your trading if you're a brand new trader and you can afford, you have the opportunity, and you don't have the funds to fund your own account, basically. So after I outgrew that sort of experience, is kind of when I went out on my own.
Excellent. Okay, well, let's talk a little more about your actual approach to markets that you're trading today. So could you give us an overview of your approach and the type of methodology that you've adapted?
Sure. I'm a technical, I would guess what you would define as a technical trader. I trade technically intraday, but I also have a solid knowledge of fundamentals, because I think, and some people will disagree with me, but I think trading the oil market, I think it's invaluable to know, to have that fundamental knowledge of what is going on, and to be able to trade it, to either swing trade it or day trade it. Like I said, some people will disagree with me. They can just trade on technicals. They don't really care about fundamentals. That's fine. It also happens to be a passionate subject of mine. So I like to know what's going on in the market, who's doing what, who's saying what, because you hear just the best example of recently all these OPEC rumors. Oil is up not because of anything other than OPEC rumors, right? So it's kind of nice to know, like, what is going on, who is saying what, what's possible, what's not possible, who's producing what. So I kind of trade with a combination of both fundamental and technical analysis, although I do intraday trade solely based on technical analysis. Like, I have certain levels and things that I trade off of. I have a system. I make the same trades over and over again. What I tell my students is, here are the levels. What you want to do is you want to get in the habit of making the same trades over and over and again. Make it a system. Make it so it's a no-brainer, because your worst enemy is always going to be your head, right? Like, you're going to find a million reasons not to make the trade, and you're not going to make the trade, especially if you're new, right? Because you're scared. So if you come up with a system and you just make the same kinds of trades over and over again, even if they don't work, what you do is you're making high probability trades. If they don't work, they don't work. It happens. No big deal. You have a tight stop. Okay, move on to the next trade. But if they're high probability trades, you have the system, then you kind of leave like your brain out of the picture. Not that it's not ever completely out of the picture, not that you're not going to second guess yourself, but I try to have a system that I will always take this trade, period.
Okay, that's excellent. So what are some of the things that you actually look for? Like, what are some of the components of your system? Like, some of the opportunities that you're actually trying to capitalize on? Rotation
levels, Fibonacci, volume profile, and footprint is kind of how my system of trading. Because I pretty much want to know. I want to know where buyers and sellers are, actual buyers and sellers in the market, and that's pretty much a lot of that's coming from working on the trade floor. Where are buyers and sellers? Because you didn't have computers on the trade. You have a computer in front of you, but in the PIS, you don't, who is buying, who is selling, and that, reflected electronically. But, so I want to know who's buying, who's selling, where are their gaps, where is, if you follow me on Twitter, you'll see I post a lot of TPO charts where I say, here's our singles here. The market's going to go fill those, because that's what the market likes to do. The market likes to balance itself.
Sure. Okay. So what's the reason why you've decided to purely focus on one market?
I just fell in love with the market, in all respects, fundamentally, technically, and maybe I'm a glutton for punishment. Nobody trades crude for 10 years, right? Only. I do throw other things in there, by the way. I have, at one point or another, traded pretty much everything, like including oats. So I have traded everything at one point or the other. But my mainstay has always been crude. And I guess it's just because that's where my passion is. I guess you just have to find where you're passionate. Some people can trade a million markets at once. Personally, I find it impossible to trade more than 2 markets at the same time.
Okay. Yeah, no, that's a great answer, and it totally makes sense. So if I'm correct, oil futures trade, I think it's 23 hours a day. How do you trade this? Are you active during a single block of time, or are you up trading kind of around the clock?
It really depends. I don't trade Asia just because simply the liquidity isn't there. And you never know, somebody could throw a 50 lot in there and it's going to move the market. It's just too unreliable as far as, how it moves. Again, because the liquidity isn't there. A lot of times during Europe, you'll have some great, really nice moves. They don't have as many algos trading in that session. So for newer traders, I would say sometimes, that market can be, or those times could be a lot easier to trade. Not easier, but a lot of the noise isn't there that's in, say, the U.S. session. So sometimes if you want to trade a product like crude, which is pretty manic, right, and it moves really fast, my suggestion would be, start with Europe time or start with a mini contract. Is what I tell people, because it really, it's a fast-moving market. And sometimes, it can wipe out your stops. It's really something like, I've watched it for 10 years and I still learn something new every day in the market.
Okay, so how much time, just on average, would you say you spend in front of the screens trading oil markets each week?
Probably too much. Probably too much. I love it. You can be a profitable trader without spending as much time as I do. I'm kind of a market junkie. So, you'll see, I get up to see the Europe Open. I'll get up to trade it if I think there's a trade there. So I probably spend a lot of time in front of the market.
Okay. So much more than your average worker would during the week.
Yeah, probably. My work week is, 120 hours plus.
Wow. Okay. So would you say that's maybe partly the reason why you've been so successful at trading, is because it's almost like an obsession for you?
I think it is. When you have a passion about anything, and you really enjoy it, then I think that's going to make you successful no matter what you're trading or what you're doing. No, you don't have to spend this much time in front of the screens. I just happen to love it. And you really get a feel, if you watch it as much as I do, you kind of get a feeling of how the market's going to react, where, when, because you've seen it before, and there's really no explanation why. You just know the market's going to react that way. And a lot of that just comes from experience, which is why for newer traders to have a system is very, very important, I think. Have trades that you make all the time, keep the guesswork out of it. 10 years later, go with your gut. That's fine, but not at the beginning.
Sure. So, Tracy, I'd like to sort of dig in a little bit more about the fundamentals and the politics. So you mentioned that some people might not agree with you that, this is an important aspect to understand when you're trading markets such as crude. Why are the politics and fundamentals important to you, though?
Well, it's important because I like to know, especially as a day trader, what is going to make the market react. I'll just use the latest example, which was on Friday. We still have this huge glut of oil. Nothing's changed fundamentally. Everybody's still overproducing, blah, 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 yet the market goes up. Well, I followed my oil ticker. I knew the second that it hit that there were problems in Iraq and Nigeria, and they had pipelines that went offline, and then now it was, 2 seconds later, they were going to be offline for 2 weeks, removing about 800,000 barrels of oil from the markets for the next 2 weeks per day. So immediately I'm looking for longs. This market's oversupplied. So right now, I think we could get a squeeze. This market could go higher, but ultimately, the fundamentals haven't changed. So the higher we go right now, the harder we're going to fall.
Okay, that's interesting. So just a couple questions off that. Where do you get the majority of your information from? Like, do you find there are certain resources which are more reliable than others? And the second part, if traders new to oil were to only focus on just maybe a few numbers or a few types of fundamental information, what would you say perhaps has the greatest impact?
Literally, if you follow, Live Squawk, Squawk Box, or subscribe to any of those just for their oil, that is great. I know this sounds, if people don't believe me, but EIA and IEA, which are just the government websites, are full of so much information that people completely tend to think, oh, it's just a government agency. There's nothing there. There is so much information there. It's an invaluable resource, both of them, especially EIA. So it sounds, most people are like, government agency. There is so much information there. IHS is a good resource that you should definitely look at. All these people have things like refinery maintenance schedules, who's producing what, detailed about what refinery is refining what, how much is coming out of each zone, more information than your brain can possibly handle. So for new traders, you want to know fundamentals, start there. I mean, it's the obvious place, but really invaluable. Look at the information. Look at, I guess you have to be your own judge, but I mean, you should know what's going on within the market. And if you don't want to do that, you can just follow my Twitter stream, because I tweet every day and all the information, not to promote my Twitter stream. I'm just saying.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved. Now, so has the way traders operate within them. Trade the Pool.
Let's talk a little bit about, falling prices in oil. They've been falling over the last year or so. As we all know, they've been on the decline for quite some time. What do you believe has been the underlying reason for this?
The underlying reason is it's completely a supply issue. We're oversupplied and we have not enough demand. I mean, it's very simple. It's more simple than anybody thinks it is. It's really an oversupply issue. We're oversupplied. That's it. We're completely oversupplied and it's a game of chicken. Nobody wants to stop pumping, right? So you have the Saudis and OPEC, and you have the U.S. shale, and nobody's going to stop no matter what. And even though this rig count thing, which anybody that follows me knows, is my pet peeve of all times, because just because my theory is rigs don't produce oil, wells produce oil, right? So even though rig count's down, you can't, the price of, and the technology is so fluid in the shale market right now. Like advances are being made all the time with horizontal drilling and things like that, of that nature. And this is what I'm saying. You should know the fundamentals, and you should know rig counts, eventually they will matter. If we get to zero and nobody's drilling. But, as rig counts have been going down, it really hasn't done anything to production levels so far. And that's because you have to know that ongoing technology makes this number very fluid, and break-even numbers very fluid. So, that's another reason why knowing your fundamentals is really important, because normally you would see rig counts are down. How much? Shouldn't we, Shouldn't oil be skyrocketing right now? Shouldn't production be way down? No, you have to know really, how fluid these numbers are, especially in the shale industry. You have to understand that shale is a relatively new technology for the U.S.
Okay, so what impact would you say falling oil prices have on a macro level, and what's been the roll-on effect to companies that are involved in the oil industry?
Falling oil prices are good for the economy. Everybody considers them a tax break. At these levels, however, we're at dangerously low levels. They are no longer good for the economy. They are no longer good for oil companies. Right now, we have a huge debt problem. We have 40 bankruptcies last year. We have 175 bankruptcies possible this year. Debt reconsiderations are in April. So we have this massive debt problem. If these companies go out of business, what goes out of business with them? Restaurants, housing, blah, blah, blah. It affects all sorts of sectors of the market, not just the oil industry, when these companies start to fall. So it's a massive problem. It's no longer good for the economy. It's no longer a tax break. In fact, there are a million Fred studies that show that people aren't using savings in oil, to go spend on other things. They're using savings in oil to pay down their credit cards or save money. It's not, the theory was we have savings in oil. It's a tax break. These people are going to go out and, go buy more clothes and go spend it on the economy, and we're going to revive the economy, and it's all going to be great. But that's not what's happening in reality.
Okay, and as the speculation continues, are prices going higher? Are they going lower? Where do you stand on this? Do you speculate, or do you even care on where oil is headed in the long term, or do you just sort of trade what's in front of you here today?
I trade what's in front of me here today. I do speculate only to the extent that I'm never going to call a top or bottom on any market, because the market will just make you look stupid in the end. So I'm never going to call a top or bottom. Do I think that this market is done? Do I think we have a bottom here? No, I don't. Do I know where the bottom is? No, I don't. I don't even want to venture to guess where the bottom is. But knowing all the fundamentals of the market, talking to people that actually trade the physical, knowing, inside information, fundamentally wise, I would say that, we could have a squeeze here. Oil could go to 37, 38, and still I wouldn't call it a bull market until we break 44, 45. We're still in a downtrend. And as everybody knows, I'm still bearish on this market. Even if I will trade the long side during the day. As a day trader, looking at it, I'm trading what's in front of me. So I'll trade long and short, sometimes both in one day. But as an overall macro view, looking at it as, just speculating on the market, I would say this market is not done yet to the downside.
Okay. And what is it about the 44, 45 level in you that thinks if prices break those levels, then we are potentially in an uptrend from that point?
Because constructively on a chart, if you look at a 20-year daily chart, that's when you finally really start to see recover, when you really break the downtrend. Okay.
And just on this note still, what type of events or what do you think might need to happen for oil market to turn around to the upside? What would turn it around?
Well, let's back up a little bit. Okay, March is refinery maintenance season. So what we're going to see during March is a lot of builds in crude oil. That's why I think it's not done. If we are going to ever see any kind of price recovery this year, it's going to be, end of April, beginning of May, I'd say end of Q2, beginning of Q3, because at that point you have debt reconsideration. So, if these companies don't get more money, they're not going to survive. They're going to go bankrupt, which means that production is going to go way down. And then you have summer driving season where you have demand. It's a seasonal trade. Demand is normally up during summer driving season. So with those two happenings together, that could create a nice little spark to at least have some recovery in the price of oil. But, it's all depending. We've got to see what happens in April.
Okay, and just on that, with the debt considerations, do you have any numbers that you might be able to share with us to show or to help us understand maybe how serious this situation is?
Well, unfortunately, the banks have been less than transparent. And, we just had earnings season, right? And, oil debt is something that they have to talk about. However, they haven't been very transparent as far as how much debt, where, when, and how. They've been very closed about it. So I wish I had some better numbers for you, but it's been so. My gut feeling is these banks are trying to hide how much debt exposure that they have to these markets because they want to save their stock price. So I think they're afraid to sort of expose that. So they haven't been very forthcoming in where all this debt is. And, they keep saying, we've already considered losses up to $1 billion, but I think their exposure is way higher than what their expectations are for not recouping this loss. Not to be a Debbie Downer, but I'm just saying, if you're less than transparent about something, what are you hiding, right? So
yeah, absolutely. It does make you wonder. So are there any words of wisdom that you have for less experienced traders who are keen to start trading oil, just to kind of summarize what we've discussed here?
Yeah, if you want to start trading oil, do it. It's the most exciting, fascinating market ever on the planet. But, definitely talk to people, ask questions, ask people on Twitter. Twitter is an invaluable tool, I think, because, you can talk to experienced traders and, unless they're dicks, they're going to answer you. I try to answer anybody's questions. All of my friends that are, veteran traders do the same thing. So ask questions. You have an invaluable tool. You learn all you can. Find a mentor. Find a prop firm. Use all the tools that you can. I'd also say, sim a lot before you just jump in, and maybe start with, the mini contract, or definitely try to find a system that works for you, because crude's great at, any market is great at faking you out. So, and get used to losing money at the beginning. Don't be afraid to lose money, because it happens.
Absolutely. Small amounts of money, ideally.
Right. But that's what I'm saying. There's a lot of resources available. Don't go online to those schools. I know other people will kill me that they're selling their school crap. I'm not selling anything, by the way. I'm just here to, talk to you.
Absolutely. No, and that's great.
But yeah, ask people questions. I think Twitter is an amazing resource in the fact that, like I said, you have veteran traders there, and unless you're a complete dick, you could ask anybody anything and they'll answer. At least the people I know.
Yeah, I think Twitter is such an awesome resource, and I've been saying this for a while now. I think every trader should be on there really making the most of it, because you just have access to so many great traders. It's
right?
really cool.
And they'll answer you, and they'll be like, way cool about it. Even if you're, you're the guy with, 2 followers and, whatever. Nobody, traders don't care. You ask a legitimate question, they're going to answer you. Before, you didn't have access to traders like that. It's not like you could call up Ackman and be like, "Hey, dude," right?
Exactly.
On Twitter, you can.
Yeah. So, all right, last question just to take us out here. And I kind of asked you it a little bit earlier, but let's expand on it a little bit more. What skill sets have made you a successful trader? So you mentioned obsession. Is there anything else?
Patience. Here's what I find. People, people, especially new traders, they think, I want to get in trade. I need to be in a trade all the time. I got to be trading all the time. I got to be trading all the time. I got to be trading. I make 3 to 5 max trades a day trading. I have a swing account too. So, you don't need to be trading all the time. You don't need to be in the market all the time. You have to wait for the market to come to you. Have your levels, have a system, wait for the market to come to you. Trading is boring. Most of the time I'm on Skype, talking about the markets to people. I'm not in a trade all the time. You don't need to be in a trade all the time. If you're in a trade all the time and you're making 60 trades a day, you're over trading and you're not going to be successful, because at that point you're just paying your broker.
Yeah, great advice. And you hit on an interesting point there. You said have a swing account also. So do you have a separate trading account for your intraday trades and your swing trades?
I do. I have two accounts. So I find that I have one for swing trading and one for day trading. So I find that that's a great thing to have because I can, have a swing account, not care about the intraday swings, but yet then trade against my own position day trading wise. So once you get to that level, I would recommend if you want to swing trade and day trade, have two separate accounts where you can make swing trades. And then you don't really care and you have your in, your out, you're not worrying about it. And then you can do your day trade scalping, whatever, in another account.
Yeah, and I guess that would make things very black and white for, to track how you're doing with your intraday trading and how you're doing with your swing trading. It keeps them both separate and very tidy. So, now that's excellent, Tracy. Now, where can listeners go to find out more about you? You've mentioned Twitter, so what's your Twitter handle?
My Twitter at ShyGirl, BHIGRL, because I was from Chicago, so that's why.
Great. And Tracy, I didn't ask you this before we jumped on the call, but would you be open to answering questions that any listeners may have in the comments area of this interview?
Absolutely. I would be more than happy to answer any questions.
Cool. Okay, so guys listening, if you have any questions for Tracy, go to chatwithtraders.com/62, scroll to the bottom of the page and leave a question in the comments area, and Tracy will get back to you on that. So make sure you take advantage of that. Tracy, thank you so much for doing this. It's been a pleasure speaking with you. Let's stay in touch.
Thanks, Aaron. Yeah, definitely.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations, this is the next level.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Hey guys, what's happening? I'm your host, Aaron Fifield. Here we are, episode 63, and I have another brilliant and very experienced guest lined up for you this week. Her name is Nicola Duke, or at Nick Trades on Twitter. She's a professional swing trader from the UK, actively tracking 36 futures and Forex markets, who takes a technical and systematic approach to trading. Some of the highlights from our conversation would include hearing about how Nicola's typical trading day used to start at 1:30 a.m., learning that her mentor never showed her a single setup or gave her a single trade idea, the concept of preserving mental capital, and insight to how she trades with a systematic approach. But really, that's just a teaser, and we cover so much more during the interview. Now, you may also like to know Nicola is open to answering any questions you might have. So if there's something you'd like to ask, leave a comment at chatwithtraders.com/63. And the second link I need you to remember is chatwithtraders.com/iTunes. If you're enjoying the podcast, please leave an iTunes review. It'll take you no more than 2 minutes, and it helps more than you can imagine. So please do this just while you're listening. Go to chatwithtraders.com/iTunes. Okay, team, here's this week's interview. You're listening to the Chat with Traders podcast. Here is my guest, who I was thrilled to have the opportunity to speak with, Nicola Duke. Hey, Nicola, nice to be speaking with you. How's it going?
Hi, Aaron. Really good, thanks.
Excellent. Thanks so much for coming on. There's so much I want to ask you about. Let's just get started. So if you could, Nicola, share with us how you first got into trading. Where did this all begin for you?
When I was like a teenager, my mom gave me some money and that I could buy stocks with. So I've always had a few stocks and shares, and but I was an investor. I really wasn't a trader. And then I was in the RAF, and then I was a civilian air traffic controller at Heathrow, and I found out that they had conducted an experiment at Heathrow. A bank called Chemical Bank had recruited a bunch of controllers and tried to teach them to be traders. And the only one that made it was the woman, who did really, really well. And I was like, that was so awesome. If I had been there, then it would have been me, So I kind of had this little bug in my head, and I kind of always wanted to do that, but I really didn't have anyone in my family or any role models, or didn't know anybody who worked in the city. So I really had no one to help me go in that direction when I was younger. And I think that's really important for people. So, much later on, I was running an air charter company in Toronto, and I met a guy who wrote Victor Sperendio his book, a trading book, which is, technical analysis book. And he said, here, I Ghost wrote this book, have a copy. I was like, oh, this is really cool. And I was like, holy cow, I could do this. So I'd made a bit of money by then, and I had some aside. So I really just, instead of just investing, I thought, well, I'll try trading, FX. I started it with FX, like a lot of people do, because I don't know, the marketing makes you think it's quite easy or whatever. So it wasn't. But so I was still running my company, and I would get up at 2 a.m. and trade the London Open, and then, do a full day's work. And I really didn't have much other life, and not much sleep. But I really got the bug big time, to the point where a year later, I said, right, I'm going to sell my company and do this full time and move back to the UK. So
excellent. Okay, well, that's an awesome overview, Nicola. So let's pull this apart a little bit. I want to find out more and dive a little deeper. So, as you mentioned, you were an Air Force traffic controller for a couple of years there. Do you feel as though there were any skills from your job which perhaps were helpful as you started trading?
I think, it's quite easy to say, oh yeah, I was really good at recognizing patterns and things moving. But I think that the major skill was, it's very uncomfortable when you're an air traffic controller, because you feel like the whole time, you're minutes, especially at a very busy airport, you're like minutes from disaster. And quite often that's that feeling that you have when you're trading, but you still have to make really good decisions, and you still have to stick to your rules or your plan, and not react to your gut or uncomfortableness, And I suppose that's probably the major skill, because, a lot of the time trading isn't comfortable or simple or makes you feel good until it stops, usually. So
yeah, and I think you kind of, as we were speaking, before we hit record, you kind of mentioned it as you need to be almost like comfortable with being uncomfortable, which I thought was a really interesting point you made. So once you did decide you were going to put some money towards this and you were going to start trading, put some money on the line and commit to it, what was your very first year like? Were there any great successes or failures that you experienced?
Yeah, I joined a live trading room, which I found really helpful, and I learned so much from people. And I don't think, people should trade alone, or at least have a mentor. And so that was really good. But, I blew my first real money. I thought, on demo, like everybody else, and I was the queen of trading, that I could do anything. And then as soon as, I put some real money on the line, it was very, very different. And I blew my first account, I think probably within a month. And I never did again. I never blew another account up again. But I think everybody has to go through that experience to learn how it feels. So it wasn't really funny. And, at the end of my first year, by then I got a mentor who really helped me with discipline. And I got to the end of my first year about flat, and he said, that's it, you're going to make it. He said, because most people don't get to the end of their first year flat. They lose much more. So I would say that's a good rule for people. If you can survive it without blowing up, you'll probably make it.
So that was kind of like a milestone for you to get to the point where you'd blown up past accounts and lost some money to actually getting to a point where you would just break even. Like that's a considerable milestone to reach. Is that what you're kind of saying there?
Yeah, it definitely was. So yeah, I blew up my first account, within a month, and then I got to the end of my first year and I was flat. And he said, "You know what? You're probably going to make it. You'll do all right." So when you said you blew up an account, how much money are we talking there? Was it a significant amount or just a few $1,000s? It was $10,000. So, I felt it. But, it was, it was enough to go, okay, stop being silly and get, wise up.
Yeah. So when you went from trading on sim to live trading, what were some of the challenges that you perhaps weren't expecting?
I really thought, I was older, wiser. I didn't need the money. So I really thought that the mistakes of like real money accounts and the thing that does to your head wouldn't happen to me. And it did happen to me anyway. And it happened to me. So even though I could afford to lose the money and it wasn't like the end of the world, it still messed with my head. So, and I learned that, and I learned with the help of a mentor, I learned an awful lot of skills. So even that I still use today to minimize using mental capital. So I will be very careful timing an entry because I don't want to spend days and days offside in a position if it's a long-term position. I will do everything to make myself feel more comfortable when I'm trading to minimize that feeling. So I still make good decisions trading wise. And he would make me do things like if I had a really bad day, if I had a bad day or a losing day, but I stuck to every one of my rules, I will go and do something really nice to cheer myself up, like eat sushi, have a pedicure, be really nice to myself. Because if you stick to all your trading rules and you still lose money, there's nothing you could have done. That's just how it is. But if you make a load of money and you break all your rules, you open a tin of beans and go to bed early.
Yeah.
So,
no, that's excellent. Now, you've mentioned a mentor there a couple times. How did you, I know a lot of people listening probably wish that they had someone who was like a mentor figure in their trading journey. How did you meet this person and what sort of ways did they help you? I know you've mentioned discipline there, but what was most beneficial about the experience of having a mentor?
I met him. He's actually a friend of Tom Dante's. I met him on a trading forum. There was a small group of us that used to share ideas, and like any trading forum, nobody really knew who anybody else was. We kept it. There wasn't any chat or banter. It was quite, just market stuff. And yeah, he just sent me a message one day and just gave me a bit of advice, and I was like, oh wow, thanks so much. And it just kind of grew from there. And I had no idea who he was, and turns out he was a trader at a fund, and he really helped me. He really helped me with things that you don't know about how the market works. He really helped me with discipline and mental attitude, like to literally get rid of all emotion from trading, because it's got no place in it at all. and to, you don't go whoop whoop when you have a big winner, and it's not the end of the world when you have a loser. It's just another day at the coalface. That's just how it is, I suppose. And I think new traders struggle with that, or don't really, sometimes they can, I don't know, maybe it's a male thing. Sometimes there's a lot of testosterone around. I'm quite introvert as well, so I could go to an office every day with a bunch of other people, but I don't do very well with people who shout at the markets and screams when things aren't going well and that kind of thing. I like it to really quiet and cool. So,
excellent. So it allows you to think straight.
And he taught me. That is very important. Yeah, he taught me a lot about preserving mental capital, sticking to rules. It's just another trade. Doesn't matter. Risk management, those kind of things.
The important things.
The really important things, yeah. And he told me I was trading the same setups. He never, ever gave me a single trade idea or taught me a setup. He literally only kicked me into shape mentally, but it made the difference between making money and not making money.
It's really interesting, actually, how, to hear that he never showed you a setup or showed you what to trade. Yeah.
Never showed me a single setup, never suggested a single market or a trade idea ever.
Okay.
It was all about helping me make my trading system better, which was really cool.
So to continue on that, are there any tips or pointers that you might be able to share with listeners on how they could potentially find someone who could provide some sort of similar mentoring?
I think that you need to join communities and meet like-minded people and who trade like you, or who've been around and done it for a while. And I think if you show yourself to be sort of really motivated and respectful, that somebody may well come along and help you. I've helped a couple of people, not full time really. I've really struggled. I think, I feel like I don't even like saying, oh, I've made it, even though it feels like I should say that because I'm trading professionally. But I just feel like it's always one long journey, even if you've been doing it for 15 and 20 years, you're always learning, so. But yeah, I think that really in communities of other traders, don't trade alone. Trade with other people, join a trading room, a live trading room. There will always be people there who know more than you, who will help you and who will give you advice about other things that will help you. Because I've learned things from so many places, and I suppose my strategy is a combination of so many different little things that I've learned that I've put together, and most people, when they start learning, they think, oh, there isn't that much to this. And then once you get going, you realize there's so much more, you're always learning something, even if your strategy itself is really simple. So. No doubt.
I agree with you 100% on that one. Can you tell us a little bit more about your time living in Toronto? I mean, you briefly touched on it earlier, but I really want listeners to hear this because I think it shows an incredible amount of determination and hustle, and it's probably going to put most of us to shame. So what was your time like living in Toronto? Because I know you were getting up extremely early to trade the markets. Like, walk us through like your typical day.
Oh yeah, no, I would get up sort of 1:30, 1:45, and I would start trading at the London Open, which was 7 a.m. in London, 2 a.m. my time, and I would do that until sort of probably midday or late morning London time, and then it would be wake up time. I would go out, walk my dogs, make something to eat, and run my business through the day, take a look at the markets at lunchtime. I would stop, for the US Open for an hour or two. And then, I would literally walk my dogs again, have something to eat, and I'd be in bed by 6:30. I literally had no social life at all for 2 years. But I was so determined that I could do this. And my weekends I would pour over charts and catch up business and do accounts, and it it was worth it, but it was really, it was 2 years of not very much sleep.
Yeah. No, I mean, it's really impressive, and it's obviously paying off now. So, yeah, I mean, props to you for that. That's awesome. So when did you arrive at a point where you felt comfortable to leave the business behind and rely solely on your trading for income?
I think that if I was waiting for that point where I felt comfortable, I would never have done it. So I really did take a bit of a leap of faith. I just felt like I had to do it. So I was, making a small amount of money. I probably did it too soon, but that was okay. I think, everybody's journey in the market has a few knocks and bumps. That it's what keeps you from getting too full of yourself, I think. So I probably did it too soon, but I really wanted to. I was so passionate about the markets. And, I'd been trading for a couple of years, and then 2008 happened, and I couldn't do both. And there was a lot of money to be made, So I think, I'm not going to say, I only ever got profitable because of that, because I have been since then. But that was really, what did it for me, Plus, when that happened, people weren't lining up for air charter anymore. So I probably sold my business just in time. And so that was kind of a good decision, really. Great.
Okay. Well, Nicola, let's talk a little bit more about how you're actually trading, in today's market. So can you give us some insight to the type of trader you are today, and how would you describe your approach to markets?
I'm pretty much a swing trader. I use Fibonacci patterns for support and resistance, and to identify levels where I want to get involved with the market, either levels where I think the market will reverse or retrace back to where I can get an entry. And I use, believe it or not, because people think it's old-fashioned, I use lower time frame moving averages and a Heikin-Ashi system to get me in and out. That's like a trigger for entry.
Okay. So what markets do you mostly focus on? Like, what markets are you most active in? And what's your average holding time for your swing trades?
So I used to, I learned FX, and then for a couple of years I just traded oil. And now I look at 36 markets. So I look at, and I don't trade them all every day. I just swing trade them. So 9 stock indexes, 5 bonds, copper, gold, silver, then the major FX and oil, and then some agricultural, which scare me witless, the grains and stuff, but they're my best performing market on paper. So at the moment, so you can't ignore that. And I suppose in my mind's eye, in my head, like I know what I'm looking for. So I'll scan through the weekly and daily charts, and I'll identify what I think are the best opportunities or the ones I want to trade that week. And then I'll do that same thing on a daily basis. And then I probably look for hourly entries. I have held trades for 6 weeks. My average trade is a couple of days. Lately, the last couple of months, my holding time has been much shorter just because of volatility. But I would say in 2015, I would try and hold trades for 2 or 3 weeks.
Okay, that's really interesting. So you've described to me off air when we were talking beforehand that you were originally a complete discretionary trader, but today you take more of a systematic approach from what I understand. What led you in this direction? I really think, particularly in very volatile markets, that discretionary trading is very hard. It's very hard emotionally. And so I found it easier to, if you have a number of setups that you use, you can scan the markets and you can identify the ones you want to trade. I suppose my discretion now is limited to what I want to trade, but how I trade them now is all rules based. So I know what I want to see for an entry trigger. I know what will
get me out. I know what I need to see to move a stop, take profit, and so all of that now is systematic.
Okay, and how did you discover that strategy that you trade, or the few strategies you trade? Like, was there any quantitative analysis involved in that?
Yeah, no, oh yeah, no. I used to do a lot of back testing. Yeah, I used to do a lot of back testing. If I took this much profit here and did that, what difference would that make? And yeah, I did a lot of that. Thanks to my mentor. So he was very big on that.
Okay, and how were you doing the back testing? Like, was it just Excel spreadsheets, or did it involve
Excel spreadsheets? Yeah.
Okay, excellent. And how many strategies would you try and back test and that type of thing before you actually found something that was a viable trading strategy?
I probably that back then I think I had 3 or 4 strategies, and I probably only have 2 now.
Okay.
So I've narrowed them down, but I suppose that I've used aspects of them in my rule application. So I will say, well, if that happens, then that's a no-no, time to watch out for a reversal or that kind of thing. Yeah.
Okay.
So
excellent. Now, I don't expect you, obviously, to give away all your secrets, but can you share can you share an example for some of the types of rules in your system?
Yeah, I like, I won't move a stop until it's made a new high or a low. So because I like to give a market time to bounce around, or those kind of rules. I will look at closing prices, so either hourly or daily, relative to the moving averages that I follow. So a close below a 50 moving average will get me out always. That kind of thing I look at, yeah.
Okay, and are there any time of day rules that you have incorporated in your strategy?
Yeah, definitely have time of day rules. I wouldn't, for example, I'm talking to you in the evening, I wouldn't take a trade now unless it was an Asia market, like, Japanese or Australian, or I've got limits for the Hang Seng. I don't trade that very much, but yeah, I don't trade. I try to trade as close to the market open as possible, if I have a setup, because that's when the market has the most momentum. So, for example, if I'm trading the London session, I probably won't put a trade on past 10:30 in the morning. I'll wait for the US Open, just because I like to see them work. I don't like being offside. Everything has to line up, and then I want to see it work. And if it doesn't, I don't want to be sitting chopping around in an offside position for too long, just because, not because it's that bothers me, but it's mental capital that you don't need to spend, really. So save it for something else.
For sure. I like that. I like how you describe mental capital. I think that's a really valuable term.
It's just as important as your money. You don't want to get to the end of the day and be completely washed out, because you've spent a load of mental capital you didn't need to, doing stupid stuff and waiting for it to work again. And I sometimes people message me and they'll say, I'm in this position and what do you think of it? And I say, well, it kind of depends where you enter. And, they'll be like massively offside. And I think that's probably you have to know where you're wrong and take your hit and your stop. If your setup hasn't worked, get out, and I see far too many people, endlessly patient with losers. Don't be. It's just like it will eat you up. That's all you'll think about is your one trade that's not working, and you want to be looking at all the good things that are setting up. So cut your losers.
Great advice. What areas of your trading still have some discretion? I think you may have touched on this a little bit earlier, but I want to know how you sort of work discretion into trading a systematic approach. And just to add on to that, is there any reason why you haven't actually automated your strategy?
I have thought about automating it. I'm now at a place where we have the people that would do that for us, and there have been some discussions. I would say, if I have 6 markets that all have the same setup, my risk rules say that I can only risk 3% of my account at any one time. So I then have to, decide, am I going to split my risk between all of them, or which are the best ones I'm going to do? So my discretion, I suppose, would be refining what I want to trade. But sometimes, there isn't anything, or lately, there's less and less. So I would say that's the major discretion. Or I'll have a setup in something, and if there's a big news event, that will keep me out or make me wait. So that's how my discretion mainly applies now.
Okay, so just so I understand that clearly, so the main discretion is in actually selecting which markets you're going to trade, and then the system is for how you actually enter, manage, and exit those trades, essentially.
Exactly.
Cool.
Yes.
Excellent. So what impact, if any, does fundamentals have on your analysis?
I avoid news events if I can, which is quite hard because I'm half of a trading team now, which has been quite a revelation for me. And it hasn't all been, easy, especially as he's someone who trades very differently to me. And there have been some, quite good rows, very good rows. And he's a bit of an, he doesn't mind a news event or two, whereas I avoid them like the plague. So I would say I'm aware of news events and fundamental and what's moving the market, but I still take decisions purely technically, and that's because I look at sentiment a lot, and I look at market positioning. So to me, it doesn't matter if every fundamental says we should be buying something. If the whole world is long, it's only going to come off, and you want to be selling it. So that's, I would say, I pay more attention to positioning and sentiment than I do to fundamentals. Those are my fundamentals.
Okay, sure.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved. Now, so has the way traders operate within them. Trade the Pool.
So can you tell us a little bit about your scanning routine and how you actually select which markets you'd like to trade for, that week or that day?
So like top down, I like the start of the month. I look at monthly charts, then I look at a weekly chart, and then I look at a daily chart. And I select my trades without looking below a daily chart, and then I'll look for entries lower rather than... I see people that will just I think this really bad habit, and I did it a little bit in the start. You just flick through lower time frame charts looking for something to trade. That's not, I just don't think that, planning is everything, and that's not how you do it. So, well, unless that's your system, and if you're a very short term trader, obviously, and people who only trade one market, that's different. But if you, like me, if you have a number of them, then I think, trade selection is quite important. So I do spend a lot of time on it. Even though it doesn't always work that well. Sometimes you think, how did that happen? But that's what you try to do.
Yeah, you're always going to get those curveballs. So when you are looking at those higher time frames, though, what are some of the things you're actually looking for on the chart? I notice you use... from just scrolling through your Twitter feed, that you use Fibonacci levels quite a lot and moving averages.
I do Fibonacci harmonic patterns and moving averages. So I'm looking for levels where I think it reversed, and I look for measured moves. So each swing that a market makes, I usually has a mathematical relationship to the previous one and to the next one. So I look at those relationships. I like to see symmetry, equal measured moves, or Fibonacci relationships between them. So if the first swing higher in a market went X amount, then the next one, I like to see it either equal or 1.618 of the previous swing, and I'll mark all those levels and see where they line up. So I'm looking for confluence. So I would say that I look at Fibonacci retracements. I look at Fibonacci extensions. So that's extensions of corrective swings. And I look at expansion. So relationship between the swings. So three things. So if I get three areas, those three things lining up at a level, that's confluence for me. So that's three things that all agree. And so that for me is a high probability area for either a reversal, or if it continues, then you've got a support level that you can lean against or put your stop against.
Okay. Now this might be a little bit of a tricky question, but I'm gonna ask it anyway. With the Fibonacci levels, why do you think the market reacts at certain Fibonacci levels? Like, why are Fibonacci levels relevant to the actual price?
I think it's just mathematics. Okay. And if you think about it, like, look what, even in FX, look what percentage of the market is now traded by computers. Well, some quant guy did not program his computer to be random. He programmed it using mathematical ratios or events. So I would say, people who say, technical analysis is rubbish and whatever, I would say it's actually becoming more and more relevant, because these algorithms and these trend following systems, this is what they're using. And so that is why it works. And that is why it is maths based, which is really, that's what Fibonacci is. So
yeah. Okay. No, that's an interesting point you raise, actually. All right, Nicola. Well, let's move on to. I've got a few more general trading questions here. So just kind of moving off your systematic approach a little bit. In your view, what qualities make for a good trader?
People who plan and who are disciplined. So I think people who can make a plan and stick to it. The ability to make good decisions even when you feel uncomfortable. In other words, for me, that's stick to your plan. I think are the most important qualities. And I think it's really hard work. And I don't think that people should underestimate how hard work it is. All these adverts that tell you can learn in an hour a day, you can learn in an hour a day and then you can make money, 5 minutes a day before you go to your other job, is rubbish. It's a lot of work, and but it's very rewarding. So
absolutely. And when I had Tom Dante on the podcast, he did a great job of reminding us how competitive trading really is. And another quote, which is one of my favorites from a past interview, is too many people treat trading like a hobby. So I thought that was also really valid as well.
Yeah, no, it's not a hobby. Actually, he is quite competitive. He might be one of the most competitive people I know. So, apart from the guy I have to trade with. So, I would say that I'm not competitive, though, and I don't think that that is important. Like, you're not, I see people get really depressed, when other people, it looks like other people are doing really well and they had a bad day, you're not competing with any of those other traders. Like, it's just you and your profit and loss, and you're only accountable to yourself. Like, I think it's really important that you don't compete with anybody except yourself. And the only thing you're trying to do is be better than you were yesterday or last week or last month. And so this idea that you're competing, I know Tom sees the market as very much him and them, and they're on the other side, and he's not going to let him damn well beat him, I suppose it is a good way to think of that. When I sometimes think about it like if I feel like I'm being squeezed in a position, if I've put a trade on and I see the market trying to squeeze people out and I don't want to get squeezed out, I want to stay on, then I sometimes get that feeling. I know how he feels. But at the end of the day, it is just you and your P&L, and it's just about you getting better. And so, compete with yourself, cooperate with others.
Right. Okay. I like it. I guess we could maybe just reverse that question and you could reverse that answer. But what's the reason you believe why the majority of traders never succeed?
I think that they are not able to overcome the mental obstacles about money and losing money and making money. And it's why do most people who gamble losers, and yet there are some people who are professional gamblers who do really well. You need a certain mindset. You need to be very disciplined. You need to not take it personally. It's and I think it's much hard. That aspect of it is much harder than most people realize. So not everyone's cut out to do it. It's like the hardest simple thing to do, because it is simple ultimately what we do. We're either buying or selling, or we're sitting on our hands. But it's the hardest simple thing there is to do.
Yeah. No, that's you summed that up really nicely, actually. Okay, so are there any resources that you would recommend to other traders, either books, blogs, something that you find helpful on sort of an ongoing basis, or maybe even any other traders that you follow on Twitter, or anyone whose views and opinions that you value?
Do you know, I have a really long list of really awesome traders that I really do look up to. Every single one of them I either follow on Twitter or I tweet their stuff if I see something good all the time. So there are a number of technical analysts I've learned from, right from classical chart patterns, because I look at all of classical chart patterns. I don't think there's anyone better than Peter Brandt, but there's so many people. So I would say, everyone that I try to retweet. I don't know how honestly people learned to trade before the internet, because I remember the first guy that taught me, he used to ring up every day and get the prices, and he used to plot them on a graph, like they weren't even on a computer, And I remember when I first started with stocks, I would get the prices out of the newspaper and late. So that's how I plotted how my trades were doing when I was a teenager. So then now there's so much you can learn on the internet for almost nothing if you're determined to look for it. So
Absolutely.
Yeah, we're really lucky.
Yeah, for sure. Now, I want to ask you this question. I've been getting a few emails lately of people asking me this, so I thought I'd perhaps put it to some of the guests that I have on the podcast. What platform do you use to trade with? And perhaps just to add on that, what type of trader is that platform best suited to?
I chart at the moment on CQG, which is really expensive. It's a very powerful tool. And it's quite amazing because it doesn't even draw harmonic patterns, which is mostly what I look for. I draw them myself. But it is very expensive. I think we pay over £1,000 a month for it. And so we use that for charting, and then we use TTX Trader for our trades. So that's what I use as a professional. I really like Trading View charts from Saxo Bank. I really like pro real-time charts for my UK stock trades. And they're quite inexpensive and good for anyone. And they have really good stock screeners as well. So you can screen for moving average crosses and stuff that's close to support and resistance and that kind of thing. So I like pro real-time as well. Before that, I originally learnt on MT4, I think, like everyone else. And I really missed it when I left it because it was so simple. You could just do anything, I felt like.
Okay. Excellent. Well, I'll make sure to include all of those links in the show notes. They'll be at chatwithtraders.com/63. Now, Nicola, where can listeners go to find out more about you?
Oh, I don't tell people very much, but I'm on Twitter at Nick Trades, so @ NICTRADES. Yeah, and I usually post what I'm up to or looking at there.
Excellent. So go follow Nicola on Twitter at Nick Trades. Now, one day I'm going to remember to ask this question before I hit the record button, but would you be open to answering any questions that listeners may have in the comments area of this interview?
Definitely. I will remember to look in and I will answer any questions.
Awesome. So guys listening, go to chatwithtraders.com/63, scroll to the bottom of the page and leave any questions in the comments area that you'd like Nicola to answer. And Nicola, I'll give you the heads up on any questions that come through. So
okay, that's great.
Yeah, that's awesome. Thank you very much for doing that. And yeah, it's been really awesome to speak with you. So thank you so much for doing this. I really appreciate you taking the time. I know it's late evening for you, but it's been a great interview.
Great. No, thank you so much, Aaron. I really appreciate your interest.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations, this is the next level.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Hey guys, what is up? Welcome back to another week of the Chat with Traders podcast. For this episode, I spoke with returning guest Nick Raj, who was originally on episode number 4. But in case you missed that episode, Nick is a systematic trend follower and momentum trader. He's most active in Australian and US equity markets. This time around, we discussed mean reversion strategies and why they may appeal to certain traders, the importance of trade frequency when developing a system, which then leads us into the characteristics of a robust system. And probably one of the big takeaways for myself from this conversation was hearing about Nick's emphasis on really trying to break and stress test systems, rather than simply trying to find the quote-unquote best system. And like the last few guests, Nick has also offered to answer any trading questions you might have. So if there's something you want to know more about, just go to chatwithtraders.com/64 and leave your question in the comments area at the bottom of the page. Okay, that's all for now. Let's jump to the interview. I'm your host, Aaron Fifield, and here is my guest for the second time, Nick Raj. Hey Nick, welcome back to the podcast. How's things?
Yeah, all good. Thanks, Aaron. Thanks for having me back again.
No trouble whatsoever. So for those who don't know, you were originally on episode number 4, and on that episode we covered plenty of really great topics. But this time around, we're going to talk more of the specifics about taking a systematic approach to trading. So we're just going to jump straight into it. Guys, if you want to hear more about Nick's personal story, then do check out episode number 4, and you can find that at chatwithtraders.com/4. That'll take you directly to the episode. All right, Nick, so let's set the scene here. I'm going to ask you, what type of trader are you? And could you give us just the quick overview of your trading approach?
Sure. Well, I have an extensive background in technical analysis, and usually technical analysis is associated with discretionary trading, but really there's two sides to that. You've got your discretionary side where you're looking at chart patterns and drawing trend lines and that kind of stuff on your chart. And then you've also got the quantitative side where you're using mathematical formulas, if you like. They're all based on technical analysis traits. So, we use price, derivatives of price, we use volatility, volume, those kinds of things. So I am a 100% systematic trader. I trade trend following systems for the majority of my funds, and also a selection of mean reversion systems as well, but purely 100% systematic.
Okay, and you focus on both Australian and US equities, I believe. Do you trade any futures as well?
The only futures I now trade, I traded futures for the first 15 years of my life, but really the only futures I use now are to hedge my US exposure when required.
Okay, and are those hedge positions, are they still a systematic trade, or are they somewhat discretionary?
Somewhat discretionary. It's rule-based discretionary though, so I have specific triggers that tell me to put a hedge on and take a hedge off, but it's not systemized per se.
Okay, now you said right at the beginning there that you take, for the most part, a trend following approach to trading. Could you just elaborate on how do you define a trend following approach, and maybe how would you differentiate that from momentum trading?
Yeah, it's a pretty good question, and they are slightly different, although based on the same principles. Obviously, the foundation principles of both trend following and momentum is to cut the losses and let the winners ride. That's the founding principle on both of them. The difference between the two of them, however, is that trend following references symbols, whatever a symbol may be, so a stock or a futures contract or a foreign exchange pair, in isolation. So we would be, say, looking at Microsoft on its own. Is it trending up or trending down on its own, and do I put a position on based on the trend of Microsoft itself? Momentum is slightly different in that it references individual symbols against each other. So, for example, let's use the S&P 500 constituent list, and we will say, right, out of these 500 stocks, which are the 20 strongest and which are the 20 weakest? And you would rank them, and then you would buy the strong ones, and if you were trading on the short side, you would sell the weak ones.
Okay, and when you rank stocks in this particular way, what time frames are you looking at? Like, are they, when you say they're the top 20 strongest, the top 20 strongest over sort of what period of time?
Well, personally, I use 200 days. Really anything from 30 days outwards, pretty robust. Generally speaking, under 30 days, you tend to get more of a mean reverting principle with stocks, but 3 months is pretty common, 6 months is common, and all the way out to 1 year all works very, very well.
Right. Okay. Now, as a systematic trader, I guess the goal is to repeat the exact same types of trades over and over again, and having strict rules for buying and selling. So
Absolutely.
why is that idea so important to you?
Well, it's very important to me because, well, at the end of the day, there's no point in having a systematic approach if you're not going to follow the rules and place the trades. Let's get that straight. And certain people struggle with that whole concept. They want to think they're in charge. Now, I need confidence in what I'm doing. I need to know what I'm doing has a positive expectancy over the longer term. And if I know that, then I can trade with complete confidence. I have no fear. I have no reason to listen to anybody else's input. Noise just has no impact. I've tested the system robustly, which I believe we're going to get into shortly. But if I have a validated system that's proven, then I have complete confidence in every trade I place Whether it's a winner or a loser, it doesn't really matter. So long as I understand that the strategy has a positive expectancy over the longer term, I completely remove most of the emotion.
Right. I like that answer, Nick. I think you explained that really well. And we definitely are going to get into how to test for robustness and all that good stuff very shortly. One of the things you mentioned as we were speaking beforehand that may be beneficial to talk about is actually sort of digging in a little bit to the mean reversion systems. First of all, can you explain what is a mean reversion system and why would someone trade this type of strategy?
Yeah, so in its simplest form, mean reversion is buying weakness, if you like, and selling strength. Let's think, Warren Buffett is a mean reversion trader. Essentially, that's what he is doing. He is buying value and waiting for those companies or that value to then come forward. So he is essentially a mean reverting trader, albeit on the long side. Why would someone trade this type of strategy? Well, there's a number of reasons. First of all, diversification. And I think if you have a look at some of the top trend followers around the place, you will see that they have slowly over the years instigated other types of systems to offer diversification. Trend following can be a little bit lumpy at times, and mean reversion tends to be a little bit more consistent. So a mean reversion strategy can offer diversification with other strategies, which is one of the reasons why I do it. Second of all, mean reversion offers high trade frequency, and trade frequency is a very, very important part of profitability because you get to exploit your edge more and more and more. If you have a strategy that makes 50 trades a year, well, there's only so much P&L you can pull out of that strategy in the year. But if you have another strategy that does, say, 500 trades a year, well, you can exploit your edge a lot more. And the classic example of this is a casino. Casinos have a very small edge. The goal of the casino is not actually gambling. The goal of a casino is to get people into the casino in order for them to gamble, which is why they offer low-priced meals, they offer free alcohol when you're actually in there, they offer all the big glamorous shows, the big shopping malls. The goal is to get people into the casino and then get them gambling. And that's why they're open 24/7. So people are open to gambling and therefore the casino can exploit their edge as often as possible. In fact, in Sydney, it's a very good example, in Sydney Casino, they don't actually have croupiers now at the roulette table, or they certainly didn't the last time I was there, not that I go there all the time, but a croupier slows the game down. The croupier has to collect the money, spin the wheel, move the chips around, do all that kind of stuff. And that slows the game. So to speed the game up, they actually remove the croupier. Instead, the player just puts a credit card straight into a machine and it's all automated. And it speeds the game up and it speeds their edge up as well, or they get to exploit their edge that many times in any given hour of play. So mean reversion tends to be shorter term in nature. For example, my strategies, even though they're end of day strategies, they have an average hold time of 3 to 4 days, and they'll produce anywhere from 200 to 1,000 trades a year. A couple of other very good reasons why to trade mean reversions. They tend towards a higher win rate, and they can therefore be a little bit more comfortable for people to trade. You know, obviously, and I've explained this many times before, we are brought up in a society where being right more often than not is rewarded. And it's very difficult for people to run a trend following system that has a win rate of 40% or 45%. Because it's, you have a lot more losing trades, and that can be quite difficult. So mean reverting systems tend towards win rates in excess of 60%, 65%, somewhere in that area. And that in turn also allows a faster drawdown recovery because you're exploiting your edge a lot more. I'm not saying the drawdowns is necessarily smaller, but you can tend to recover them a lot quicker. And again, with a trend following strategy, you can be in drawdown, well, some of the great traders, they can be in drawdown for a couple of years. And for the average man in the street, well, that's not really acceptable. So mean reversion can be a lot easier to trade. And let me also say something else that's just come into my mind now is, again, in society, at least today, society is very reactionary. We want action all the time. We want instant feedback, instant gratification. Sitting on a trend for 6 months, 8 months is a pretty slow kind of laborious and boring thing, which is good, don't get me wrong. But for a certain type of person who does require more gratification, more feedback, then a mean reversion system will provide that, because there'll be a lot more trades, you'll be in and out, you've got to do a little bit more work, etc. So that's something else that may appeal to a certain kind of person.
Okay, that's an awesome answer there, Nick. Couple questions just off your answer there. And this might be a bit of a newbie question, but so essentially what you're doing is you're trading the price back towards the mean, okay? How do you know where the mean is, or how do you have some idea of where the mean price actually is?
Yeah, I guess I'm a little bit different, and maybe the term mean reversion is not that applicable, but what I'm looking to do is find points where you have a stock that is severely oversold or overstretched, if you like. There's no real mean per se. It's stretched like a rubber band. It's pulled to its maximum breaking point, and at that point, the probabilities suggest it's going to snap back the other way. So that's what I would define the way I trade mean reverting. So there's no actual mean. It's not like, it's not like what Warren Buffett does. I mean, his mean, for example, would be fair value of the company, correct? So he will be buying a company that is well under fair value and selling a company that he considers well over fair value. But all I'm kind of doing is looking for price points that are stretched to a maximum, and looking for that to snap back by some degree and generate some kind of a profit.
Okay, got it. Yeah, that makes sense. Now, are there certain market conditions where a mean reverting strategy may be more effective than other strategies?
Oh, absolutely. Every strategy, regardless of the kind of strategy, whether it be technical or even fundamental, will have periods of time where it works better than others. Every strategy goes in and out of sync with the market. Okay, Warren Buffett's strategy is in and sync and out of sync of the market at different points of time. Doesn't matter what you do, that's a fact of life. The unfortunate truth for a lot of people is they try and find a strategy that works well all the time in all market conditions, and it just doesn't happen. So once you can overcome that and understand that your strategy doesn't have to be perfect all of the time and you can make very good money regardless, then that's a big step for people moving in the right direction. It's a big step for people to overcome that fact. So mean reverting systems, first of all, I only trade them on the long side. Okay, so in the US market, I will actually stand aside when the market is trending down. So for the last few months, for example, I've actually been in cash just waiting for the market to turn around. In the Australian market, I do trade the mean reversion systems regardless of market direction, up or down. So ideally, the ideal situation for a mean reversion system is a market moving sideways or slowly moving up. A market that moves fast on the upside doesn't allow me to actually get in, and I will underperform. But a slow creep higher is probably the ideal situation, or a sideways market would be ideal. So, for example, last year, 2015, my US mean reversion system produced a return, I think net return of about 14.5 or 15%. And what was the S&P? I think it was pretty well flat or down a little bit last year. So it can work in a sideways market, but I think a slow creep higher is the best.
Right, okay. Now, you made an interesting comment there in your answer about how you will trade both directions on the Australian markets, but only long on the US markets. So is there any reason behind why you don't go short US equities?
Oh, sorry, I didn't make myself clear. I only trade the Australian and US markets on the long side. I don't trade short, and I'll explain why I don't in a second. But what I do in the Australian market is I trade long when the market is trending both up and down, if that makes sense.
Okay, yeah.
So in the last 2 or 3 months, for example, I haven't been trading the US market because it's been trending down, but I have been trading the Australian market because it's been trending down.
Okay.
So just to clarify why I don't trade on the short side, I used to, and I stopped in 2009. There's a couple of reasons. First of all, I've never really come across a strategy that I'm 100% not confident with, but happy with, if you like. I can find strategies that make a profit trading on the short side, but the risk-adjusted return is such that it really doesn't appeal to me. The second reason, and probably the most important reason, is back in 2008, the Australian regulators banned short selling. Now, what's the point of having a strategy to trade on the short side when you need it the most, you're not allowed to trade it? So I just focus on the long side. And another reason why we also trade majority on the long side is because it's easy for people to conceptualize. My clients may not be that sophisticated to trade on the short side. They may not be able to do it. They may not be able to facilitate it. So we just try and keep it as simple as possible. And when there's no trading, we sit in cash.
Okay, fair enough. Now, another one of the things you'd mentioned to me is those who attempt to trade these types of systems, still talking about mean reversion systems, of course, they often lack robustness. So in your mind, what defines a robust system?
Yeah, this is very, very important. And I can't stress this enough. You need to have a robust system. What is a robust system? Well, the first question is, why does your strategy make money? Okay, that's a very important question. If you don't understand why your strategy makes money, you're going to find it very, very difficult to stay with your strategy when it goes a little bit pear-shaped, which every strategy will at times. So if we go back to the easy version of the momentum or trend following strategy, the foundation is cut your losses, let your winners run. Okay, you create a positive expectancy because you make a lot more money when you win than what you lose when you have a losing trade. Mean reversion, again, I guess the analogy of the rubber band, for example, if prices stretch a certain distance and then stretch a little further, they're going to tend to snap back. You can't really look at any price chart in any instrument and see it continuously moving without some minor pullback at some stage. And that's the basis of mean reversion. The market noise tends to move it around a bit more. So that's the first reason to understand why. If I was to ask someone a question, why does your strategy make money? And they said, oh, well, when the 3-day moving average goes across the 10-day moving average and the Bollinger Band is here and the RSI is there and volume is big and the moon is up, that's not a reason why your strategy is making money. So a robust strategy is a strategy that works reasonably well most of the time. Remember, strategies will go in and out of sync with the market. That does not mean it's broken. It will go in and out of sync with the market. A robust strategy is one that will work across a large variety of stocks or instruments. So, for example, I trade the exact same strategy in both the top 500 US stocks, so the S&P 500, and also in the top 500 Australian stocks. I use the exact same rules for every single stock in both those markets. Every single parameter setting is exactly the same. Now, that's a robust system. There's 1,000 different stocks there, and we use historical constituent data, meaning we completely remove survivorship bias. And we can go back 20 years and we can see that that strategy works perfectly well. There's no optimization on any individual stock. There's no optimization on any particular market. It's the same rules. So that tells me the strategy is very, very robust. To give you an idea of a non-robust strategy, and this is the trap a lot of people fall into, and again, they tend to fall into this trap because they want something to work exceptionally well all the time, so they will tend to optimize or curve fit. So a good example, there's a gold ETF strategy that I've written about that's on the internet, and basically it buys the gold ETF if it rallies more than 1.5% on a day, it'll buy on the close, and the next morning it will exit the long and sell short, and then get out of that position at the end of the day. Pretty simple kind of rules, and it works exceptionally well on this ETF. However, if you then take that rule, if that was a robust rule, then we should be able to apply it to the S&P 500 constituent list, and it should give us some kind of positive outcome. And it doesn't. It's a terrible system. So that's not a robust pattern. It might be a pattern consistent with that particular stock or a particular stock, and that's fine. I'm not really disputing that, but I would never trade it because it's not robust. If it's not robust, it will tend to fail in the future. So the more likely success over the longer term is to find a robust system. The other important piece of information with a robust or defining a robust system is it must operate over a very large sample of trades. So for example, one of the mean reversion systems that I trade across Australia and the US, I can trade it on the Russell 2000 and it still shows the same profitability. It does about 600, 700 trades a year. So going back, 15, 20 years, you get a lot of trades in there and you still get the same kind of equity slope growth that you have with a robust system. So as opposed to a strategy that's curve fitted and you might only get 20 trades in 20 years, that's just not robust at all, because at the moment it's just luck that that pattern is profitable.
Okay, now in your answer there, you brought up survivorship bias. Now, can we just expand on that for listeners who may not be familiar with that term?
Yeah, so survivorship bias refers to stocks that have survived. So for example, Microsoft is in the S&P 500 these days, and it was in the S&P 500, say, back in 1998. Enron is not in the S&P 500 these days because it's now bankrupt, but it was back in the S&P 500 back in 1998. So Enron has not survived. Microsoft has survived. Now, obviously, you can think of the price patterns of Microsoft versus that of Enron will be completely different. One has gone up and one has gone down to the point it's bankrupt. So what we want to do when we test our strategies, we want to do two things. We want to test those stocks that are delisted to make sure our strategy has worked on those, because those stocks are now gone. But we also want to ensure that we're trading the same universe today as what we would have traded back in 1998. So for example, using a historical constituent list, we can see what stocks were in the S&P 500 back in 1998 and make sure we're trading those stocks. So if I have a universe that I trade, which I do, the S&P 500, I want to know that the S&P 500 I'm testing on back in 1998 was the actual 500 stocks in that list back then, including all the ones that are delisted. So survivorship bias will tend to dramatically, in certain circumstances, overstate your simulated performance. And you want to get very accurate performance data as much as you can. And the only way to do that is remove survivorship bias.
Okay. So
does that make sense?
Yeah, no, that definitely makes sense. This may begin a little bit technical, but so as companies are introduced to, let's say, the S&P 500, how do you actually build that into your data? Like, you need to know the date that they came into that index. Is that right?
That's correct. And out and back in again. Some stocks come in and out of an index a number of times. For example, Regis Resources is one such stock that came into the top 100 in the Australian market and then has gone out again as it fell away. So if we're trading a specific universe, then that is important. If you're trading any stock for the heck of it, then it's not really important. But we want to ensure that we have that information, and it is available. We use a data provider that makes that available, and it's very beneficial, absolutely very beneficial. And there's only certain software packages that can cope with that as well. And it does become quite technical because there's a few other bits and pieces in the programming code that you actually have to put into place to ensure that those stocks are removed for whatever reason at the right time.
Yeah, so I mean, that was going to be my next question. Do you actually have to put these companies in and out of the data as the dates line up, or is that something that your data provider actually does for you?
That's what the data provider does for us.
Okay, sure. And just adding on to this, do you double check that data? Is that something that's required, or I guess it comes down to the quality of the data provider?
Yeah, look, we use a very good quality data provider. We've used them for a long, long time. They're excellent. If any of your listeners want to drop me an email later on and ask, I'm happy to point them in the right direction. It's not overly expensive. There's numbers of data suppliers out there, but the people that we use are exceptional. We use them and have used them constantly, and we constantly track our real-time trading against our simulated performance literally on a week-to-week basis, so we have no hesitation in knowing that the data is doing what it's supposed to do.
Excellent. Okay, so it's fair to say that you do need to be a little bit selective on who you choose as a data provider.
Look, it's if you're going to take this seriously, then you really can't skimp on things like data. It's an old saying that I have: do you want to make money or you want to save money? If you want to make money, well, you've got to make a conscious decision to choose quality data, quality systems, quality software. If you want to save money, okay, maybe you can get away with using free Yahoo data, but you have a bad data point in that, or you have some incorrect data, non-adjusted data, whatever it may be, then the cost in having a trading error is extensive. It can be significantly more than the cost of buying or acquiring good quality data.
Mm-hmm. Yeah, no, those are really great points. Now, I want to pick up on something that you mentioned just a couple questions back, and that was the number of trades that a strategy produces. And you said that it's very important that it has enough trades to have a large enough data sample. Do you have a personal preference about what may be too few or too many trades in a strategy?
Well, I certainly don't think there can be too many. The more data that you have, the more likely the strategy is going to be robust. Okay, so the fact that the strategy does 800 trades a year is good. It might produce 2,000 trades a year, which is good, but the more is better. The less, how can I explain this? Robustness is a function of how often, or the occurrence of a particular setup or a pattern, if you like. The more it occurs, the more robust it is. Think about the sun rising and setting. Okay, I mean, effectively, that is a pattern at the end of the day. We know it happens at the same kind of time of day, and it's been happening for a long, long time, so we can be fairly certain that it's going to happen again tomorrow, right? So the more of the occurrences we have in history, then the greater the evidence that the pattern will continue to reoccur and most likely continue to occur the same way as it has in the past. Without that frequency, or without that evidence, then we can start erring on the side of maybe, just maybe, it was a fluke. Okay, maybe there's just a fluke pattern. So one of the biggest lessons I ever learned, and it's a little bit of a sad story, I knew a guy, this is going back 15 years now, and he had this trading strategy that had generated about 250 trades in, I think, a 10 or 15 year period. And the results looked a little too good to be true, which is always a bit of a red flag. I didn't know the ins and outs of the strategy itself, but it looked okay. Well, he went and started trading that, and in one night he had a $50,000 account and he lost $60,000 in one night, and he has never traded since. And it turns out that strategy was in fact about 20 different patterns in the S&P 500 futures, all of which had only ever happened a handful of times, and he put them all in together. And so basically what he had done is he had data mined the S&P 500 futures and found all these patterns with 90% win rates, but they were basically random patterns. And as soon as one of those disproved itself, it blew his system up. Now, obviously, in his testing, he would have removed any patterns that blew themselves up in the past, and that's part of the curve fitting and the data mining that takes place. It's very difficult to have that same occurrence if you've got 10,000 trades of sample. It's going to be a lot more robust. So whenever I see a system that's firstly based on a single market, that's a red flag right there. A single market system tends to be, not all the time, but tends to be optimized. And then if the performance metrics are through the roof, then that is a major red flag. And performance metrics would be percentage winning trades. If that really starts to move above 75%, I'd really start to question. If the system is only got 25 trades in a 10-year period, well, that's also a big red flag. And other metrics like the profit factor, for example, if that's in excess of 3, then again, you've really got to ask a serious question. When you see a profit factor of 16, you know it's just an absolute curve fit data mining thing. And the only thing with those systems are they sell well to the public. That's what they're basically used for. I understand there are people out there that trade single market systems, and that's fine, but it's not something that I would do because I don't think that'd be robust enough to actually trade that. Unless, of course, they've got, thousands of trades in their sample, then yes, but usually that's not the case.
Sure. Okay. No, that's an awesome answer again, Nick. Thank you very much. Now, continuing on the path of robustness here, I'd like to ask you about Monte Carlo simulations. How does this help with your analysis? So what is a Monte Carlo simulation? What role does it play in your analysis?
Sure. So a Monte Carlo simulation is basically the question, what if? What if the past was slightly different to what is shown? Okay? And a Monte Carlo allows us to go and get an idea of the variance of what may have happened in the past if it had slightly been different. So, for example, we do a lot of stress testing on our trading strategies, and some of this includes Monte Carlo. So, for example, one of the things we do is trade skipping. Let's say you've got a strategy that produces, so for example, a classic problem with a mean reversion strategy is clustering of trades. You might get a big cluster of trades at certain points of time. And if you've got a big cluster of trades, then you can't take every trade because you don't have enough capital. So with trade skipping Monte Carlo simulations, what we do is we say, what happens if we take these 10 trades instead of those 10 trades? So it will give us an output of a different number of scenarios. And the tighter that output is, the more robust the system is going to be. So trade skipping is not so much of an important issue with mean reversion strategies or higher frequency strategies. It is with trend following strategies, because if you miss the one big trend, it can make or break your year. With mean reversion, where we're looking to take small bites at the cherry all the time, it's not so much important, but it still has to be tested. So, for example, let's say my mean reversion strategy does 500 trades a year, but there are 3,000 signals. I need to know if I'd taken those 500 trades instead of these 500 trades, what would the outcome be? And that's what we're looking at when we're doing trade skipping in the Monte Carlos. So that's basically what Monte Carlo is saying, is what if the past is slightly different to what you've got there?
Mm-hmm. Yeah, absolutely.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved, now so has the way traders operate within them. Trade the Pool.
All right, Nick, well, let's move on a little bit and start to talk some more about actually live trading some of these systems. So to what extent is your systematic trading approach automated?
So to give you an example, our US mean reversion strategy. So where we start is it's fully programmed, and we literally push a button and it will generate the buy and sell signals. But we can put our account balance. Well, here's the process I use. I put my account balance in my software, and I push the button, and it will generate the orders for me, do all the position sizing, generate the orders for me. Then what we do is upload that into an API, and the API is connected to my broker. So again, another push of another button, and it will place those orders. It doesn't matter if there's one order or 100 orders, it will place those orders instantly at the push of a button. And then that API will manage the positions during the night. So I'm asleep, I've got exposure to the market, and the API will manage that exposure for me. So I say to the API, right, I only want to have 20 positions. I've just placed 100 orders, but I only want to be filled on 20. So when I'm filled on 20, cancel any other pending orders, so I'm only exposed to those 20. Now, the API also has the functionality to exit any additional fills that might occur. So say, for example, I place 100 orders and I only want 20 filled, but on the open, the market gaps down 2%. In that situation, you might get, say, 30 fills and you only want 20. So automatically and instantly, the API will cancel all remaining orders, and then those 10 additional fills that you've got that you don't want, it will automatically, and I'm talking within 1 second, turn around and exit those positions immediately. So it will always ensure that my exposure is managed through the night, even though I'm sleeping. So that's about as automated as I am. I can actually manage the positions direct from my initial software, but I don't choose to do that. I manage it with the API.
Okay, awesome. That's really cool to know. Now, in a live trading scenario, is there ever a time when fundamentals or macro events would cause you to step in and override your systems?
I would say that if I was to override a system, it's not because of any macro or fundamental view, it's because of an emotional input. Have I done it? Yeah, look, of course I have. Even though I've been trading for 30 years, there's always that time where you think, oh, this is not going to be good. But that rarely happens. Very rarely happens. But it certainly does happen to less experienced traders, probably quite regularly. It will tend to happen more to people who doubt their strategy. But if you have a complete 100% confidence in your strategy, then you just got to stand up to the plate and swing that bat and put your trades in. That's the bottom line. I mean, I've had situations where, I've seen China down 6% and Japan down 6% or something, and US futures are down 2% in the night market, and I've got 100 buy orders to put in the market. There's certainly lingering down in my head, oh gosh, this is going to hurt. But 999 times out of 1,000, I will go ahead and place those trades, because usually that one time when I don't, it's going to be a stonker of a night and I've missed it. So you're going to be damned if you do and damned if you don't. So you may as well follow the system. That's what it's designed for. Okay,
I like that answer. That's really good. When you go live with a system, how long do you actually expect it to last for? Like, continue to give you an edge, a trading edge? Like, do you anticipate that it may only be good for a certain amount of time, whether that's, a couple years, or if it's truly robust, should it continue to work for, I don't know, maybe 10 or more years?
If you have a truly robust system, it should continue to work extensively. Now, that's not to say that you can't learn more things about the market. You can't learn more things about your system. You can't learn more things about yourself, and therefore you can make adjustments to that system. I think every strategy is a work in progress. We rarely make adjustments, but we certainly have made adjustments in the past to our systems because we've learnt new things or technology has changed, which has enabled us to test our systems in different ways. So for a very good example of that, I can now strip out resource stocks from industrial stocks as an example, and I can test those different segments of the market because they're very, very different kinds of stocks. Most resource stocks, they act very, very differently from industrial stocks. We even see that in the fundamental world. There's a lot of fundamental investors, Warren Buffett being one, who will not touch resource stocks as an example. They will only touch industrial stocks. So with the technology and data that we now have, which we didn't have 10 years ago, we can now test that, and we may be able to draw conclusions that, oh, you know what, I really shouldn't be trading resource stocks with my trend following strategy because, they act very, very differently to industrial stocks. Now, to some extent, that is a little bit of curve fitting, if you like. But again, I stress that so long as we have a significant sample of trades across all sorts of different stocks and we're using a robust system, then that should be okay. The more you curve fit, the more you optimize, the more likely that the system is going to fail. You tend to hear people saying that all trading systems will break. That's generally because they've optimized it to start with. It's a work of art. It's an ongoing process, if you like, of maybe making a slight adjustment here or a slight adjustment there. But you've got to look at the evidence of what's out there. I mean, you've got people like Salem Abraham, you've got Eckhart, you've got Dunn, you've got all these guys that have been trading trend-based systems. Jerry Parker, I think you've had him on your show, I'm not quite sure, but he's been trading the same style system, albeit slightly adjusted here and there, for 30 years. So there's no reason why a good, solid, robust system cannot last a whole lifetime.
Yeah, Jerry Parker hasn't been on the podcast just yet. I know he's been on Better System Trader podcast, right. But I've actually got an interview locked in with Jerry later this week. So by the time this comes out, it'll be a few weeks out. So I'm really looking forward to that one. It should be good.
I think an important thing here is that too many people are trying to find the best system, and that's the wrong way to approach it all. What you've got to do is try and break your system. And the more stress you can place on your system when you're testing it, and try and break it, you'll get a lot more out of it. So, for example, testing your parameter stability. Let's use an example. In my book, Unholy Grails, we use an index filter which defines the broader market. Now, let's say that index filter is 100 days. Well, what we want to test is what's the result if we change that by a certain amount? What if we change that to 90 or make it 110 or make it 150? How much would that change the result? So you can increase the signal variance, so changing all the inputs in your signal and seeing what impact that has. So you might say, right, what if I move my signal's input parameters by 15%? What if I move them by 20%? What kind of an impact is that going to have on the bottom line? The other thing you can do to try and break your system is increase the data variance, as an example. So let's say you've got a system that, so some of my systems, for example, uses the opening price to exit a position. What happens if I randomize that open price by 10% and test back for 20 years? On each single day, the opening price is adjusted up or down randomly by 10%. What impact's that going to have? And that's the whole idea of trying to break the system, trying to disprove it rather than prove it. And if you can't break it, if you can't disprove it, chances are you're probably onto something that's reasonably good and reasonably robust and will continue to work reasonably well into the future.
Yeah, that's an excellent point you bring up there, Nick. I think that's very, very important. So thanks so much for sharing that with us. How long does it take you how long does it take for you to realize that a system you're trading is not performing as expected from your back testing and analysis?
Yeah, it's a great question. One thing that we do constantly, well, the first thing to understand is that a system will move in and out of sync with the market. Okay, I've said this before. The fact that your system is out of sync with the market does not mean it's broken. Let's use a simple analogy for that, right? Let's say you've got a long-only trend-following system. A long-only trend-following system is not going to do particularly well in a sideways market or a downwards market. Okay, that's a fact of life. It is designed specifically to profit extensively when the market is trending up. And again, this comes back to why your system works. And it won't work if the market is going sideways or the market is going down, but that does not mean it's broken. It's like buying a Porsche, driving it up the beach, and then taking it back to the guy at the dealership and saying, mate, this Porsche doesn't work on the beach. I mean, you just wouldn't do that. It's not designed to go on the beach. And same with a long-only trend-following system. It is designed to make money when the market is trending higher, which most stock markets tend to trend over the longer term to the upside. But there are certainly periods of time where it won't. That does not mean the system is broken. It means you'll go into drawdown. So when your system is out of sync at the market, you go into drawdown. That's the payoff. Simple as that. So that's the first thing to understand. If you can't ask or answer the question why my system is not making money, then you have a problem. So if I'm trading a trend-following system and I'm in drawdown, but I can see that the market is moving sideways, then I have nothing to worry about. That's just a fact of life. But if the market is trending up and I'm using a trend-following system and I'm losing money, well, then you've got a serious question right there. And if you can't answer that question, well, you've got a problem and you probably should stop trading it. So that's a philosophical way to look at it. Technically, what we do is we're always constantly running simulations side by side with our real-time trading. I literally do it weekly. I want to see that I'm getting the same number of trades, the same kind of general return that I'm getting every single week from the simulation and from my real-time trading. And I'll give you an example of where this has helped me in the past. Back in it was about 2011, I was trading a shorter-term momentum style strategy. And my simulated results or my real-time results were diverging from my simulated results. And I did all the calculations. I went all the way back and had a look at about 3 years' worth of trading. And I realized that slippage had started to increase so much so it was costing me 11% per annum. And that 11% basically meant the system was not viable anymore. So, and that was a liquidity issue rather than a system issue. Now, I worked hard to try and find a solution, and I couldn't. And basically, one of the things we've seen in the Australian market over the last, since the GFC really, is a significant drop in liquidity. And that increased slippage, so much so it invalidated my strategy. So that's an example, a real-time example of where the strategy basically fell over or was not tradable. Now, I could have taken that and put it into the US market, where there's a lot more liquidity. So we're always running simulations along the real-time. If there is a divergence, you've got to try and figure out why. If you can figure out why, then you are in a better decision. If it was a one-off event, such as the 1987 stock market crash, well, there's probably nothing intrinsically wrong with the strategy. It's just one of those one-off events that will impact everybody. What you don't want to see is a slow divergence away from the simulated results over time. So you will have set benchmarks using your historical performance metrics. And when you start to deviate away from those, then you've probably got a problem.
Excellent. Okay. Brilliant answer there, Nick. Thank you very much. Now, I know listeners are going to want to know what software are you using for all this. So can you share some insight on that?
Sure. We use AmiBroker. I have a programmer on staff, and we together will develop systems and whatever. But AmiBroker, it's inexpensive. It can pretty well do absolutely anything you want. It can automate processes. It can do explorations. It can do almost anything. As I said to you before, we are able to do position sizing inside AmiBroker. It is able to format our orders so they can be sent straight to the broker platform. We had a corporate client, as an example, who wanted their own trend following strategy built, which we did. And they were managing money for clients. Now, one of their requests was that they had their dealer running the system on a day-to-day basis, but their compliance department wanted to do an audit of the orders the system was generating and the orders that the dealer was placing for his clients. So AmiBroker enabled us to do a CSV file dump straight into the compliance department's Dropbox, and that way they had, every time the dealer pushed the order button, they were sent the orders, and then they could go back and see what orders the dealer had actually placed for the client. So there's quite a lot of things you can do with it. I'm sure we haven't touched half of what it can do. It's a very powerful piece of software, and it can pretty well do anything you want.
Okay. Now, you mentioned you've got a programmer on staff there.
Mm-hmm.
What language is he working in? Is it the proprietary language of AmiBroker?
Yeah, that's correct, which is kind of similar to C++.
Okay. So is it, for someone who hasn't touched that sort of thing before, is it difficult to learn? Like, what would the learning curve of that be like?
Well, we run, it's a good question. It certainly can be a little bit daunting. Okay, but all good things are a little bit daunting to start with. And if you want to progress, if you make the choice that you want to become a good systems trader, then you will automatically make the choice to learn how to do it. If you don't think you want to learn how to do it, then you haven't committed yourself to making that choice of becoming a good systems trader. So as an example on how long it takes, we run a high-end mentoring course, which is a 6-month, one-to-one trading system mentor course. And the first part of that course is learning everything about AmiBroker, learning not only how to use it, but also how to program it. Now, we've got students in that course who have never even owned AmiBroker, never programmed computers before, and within 2 months, they're pretty well able to do it. So it certainly can be done. For some people who are a little bit more IT savvy, a little bit techie minded, well, it won't take that long. But we've got guys there who've come straight from the mines. They've never played with computers before per se, and they're up and running and programming that in 2 months.
Okay. Now, with AmiBroker, we sort of spoke about data providers earlier. Does AmiBroker have their own data, or do you use a third-party broker source?
I don't use a broker source. I use a data provider.
Yeah, that's what I meant to say.
Well, a lot of people do use a broker source. I mean, you can source data out of your broker, but we don't do that. We use a data provider. So yeah, it plugs straight into AmiBroker, and we use premium data. They're based here in Australia, but their clients are worldwide, and they have a lot of hedge funds and a lot of institutional clients use their data as well around the world. So that's premiumdata.net. Very, very good product. As I said, we've used them for a long time and highly recommend them.
Excellent. Okay. And with the API management, do you use any other software for that side of things?
We had our own API built. It was built in Europe. And yeah, so that's proprietary to us. We do sell turnkey trading strategies. We have one mean reversion system, which I'll give you a link to shortly, and people can look at that system. But you can use an API for that as an example, and we can provide our proprietary API as part of that purchase to trade that if anyone wanted to. So we had it built. We can have it built to do whatever we want to do. There's some pretty smart people out there, but this one was built in Europe.
Okay, excellent. All right, Nick, well, last question. Now, I've had this come through on email a couple of times in the last few weeks. I think you might be a good person to ask this question to. What do you do for your retirement accounts? And is this separate from your, active day-to-day trading?
Yeah, good question. The answer is yes. So our retirement account, we use a trend following strategy. and that accounts for about 85% of the value of my retirement account. And that's just in the Australian market. So pretty straightforward, long only, trend following, trades about 50 times a year. Then in our family trust, we operate a couple of different accounts which operate about 4 different other strategies, both mean reversion and momentum. And the reason why we do that in the family trust is generally because it's more income orientated, it's more active. One of the mean reversion systems I trade does about 800 trades a year. I don't think the Australian Tax Office would be overly happy to see that happen in my retirement account. So yes, we have 2 different kinds of setups across multiple different accounts.
Okay, excellent. And just to be clear, that trend following approach is something that you developed yourself?
Yeah, that's correct. So the trend following approach that I use, we offer it within our service. It's called the Growth Portfolio. And if anyone has read my book, Unholy Grails, there is a strategy in there called the Bollinger Band Breakout. Now, the Growth Portfolio is loosely based on that exact same strategy. We use the same principles as in the book, and people can actually follow the signals within our service. So you can trade right alongside me. We disclose our positions to our clients. You can see exactly what I've got, and you can see exactly the kinds of trades I'm taking. So, we're trying to be as transparent as possible with that.
Right, okay. All right, Nick, well, let's bring this to a close. So where can listeners go to find out more about you? Well,
seeing we've been talking about mean reversion today, I do have an ebook on mean reversion, which has been downloaded 4,000 or 5,000 times. So if people are interested in taking a look at that ebook, it has a fully disclosed strategy at the end of that ebook, and that strategy is very similar to the one I trade. You can go to thechartist.com.au/chat, C-H-A-T, thechartist.com.au/chat. You can download that ebook and you can take a look at that trading system. And as I said, very, very similar to the one that I personally trade both here in Australia and the US.
Great. And you're also on Twitter?
Also on Twitter at The Chartist. And that's a good place to contact me. So, yeah.
Excellent. Good stuff. Well, last question. Nick, would you be open to answering questions that any listeners may have in the comments on the website?
Definitely, by all means. Any questions you have, by all means, happy to answer them. A lot of the time with this kind of stuff, there does require a little bit more clarification. So more than happy to answer any questions anyone has.
Good stuff. Well, I really appreciate that, Nick. And guys listening, if you want to ask Nick any questions, go to chatwithtraders.com/64, scroll to the bottom of the page and leave a comment, leave a question in the comments area. All right, Nick, well, awesome to have you back on. It's been a lot of fun. Thank you very much for doing this, and let's talk again soon.
All right, that's great. Thanks, Aaron.
You've reached the end of this episode of Chat with Traders, but rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations, this is the next level.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
All right, what's up, traders? Aaron Fifield here, host of the Chat with Traders podcast. Thank you very much for tuning in to this week's episode. And for this episode, I interviewed Dr. Brett Steenbarger after many requests from listeners. Brett is a very well-known trading psychology coach and has consulted to some of the biggest names in the industry. He's also a respected author who has now published 4 books, some which have been recommended reading by previous guests on this podcast. During our conversation, I asked Brett how to break bad trading habits and introduce new best practices, to explain why traders need to be adaptable in markets, plus how we should think about goal setting and measure progress. And of course, much more about how to enhance your performance as a trader. Now, if you do enjoy the interview, please go ahead and leave an iTunes review. Like I've said in the past, it literally takes you 2 minutes. You can do it while you're listening, and it really helps to boost our rankings in iTunes and attract more listeners. So if you'd like to support the podcast, please go to chatwithtraders.com/iTunes. Okay, folks, let's skip to the interview. You're listening to the Chat with Traders podcast, and here is a very special guest for episode 65, Dr. Brett Steenbarger. Brett, many people have been asking for this, so I have to say straight off the bat, thanks a million for being here. I appreciate it, and I know listeners will also. How's your day been? What's going on?
The day's been good. Thank you very much, Aaron, and I appreciate the opportunity to be here and to share some ideas with the listeners.
Sure thing. The pleasure is mine. So, as most traders already know, you are the go-to guy for all things related to trading psychology. So, of course, that will be the ultimate focus for our chat today. But starting from the get-go, Brett, if you could, give us a little insight to your background. Like, how did you get into the psychology field, and where did you initially start out after getting your PhD?
Okay, yes, the initial impetus for my entering psychology was an unconventional one. I came to psychology via philosophy. As a sophomore in college, I was interested in psychology and indeed had declared psychology as my major, but I never really considered it a career field until I read a novel called The Fountainhead by Ayn Rand. And that novel illustrated something that I hadn't encountered before, and that is the vision of people as heroic, as reaching their ideals, their potential. And the thought came to me, it was during a winter break in my sophomore year, the thought came to me that this was a proper role for psychology to not just treat mental illness, but to expand the best of people's potentials. And that's what has interested me in psychology ever since. And what I do now in working with traders and portfolio managers, and earlier, before that, working with medical students and residents in the medical field, it really has been working with healthy people, people who are bright and creative and energetic, and helping them make the most out of what they do.
Okay, great answer, and very interesting to get your backstory there. So where did the interest in trading come from? Like, when did that creep into the picture?
You know, the trading thing is something that I first expressed an interest in a project when I was in grade school, and later became more interested in a formal way during my graduate school education at the University of Kansas. And I actually opened a trading account and began trading individual stocks. And that was in the late 1970s. But that was completely separate from my interest in psychology. My degree was in clinical psychology, and my interest was in becoming a psychologist. The trading was a side interest, a challenge, and something I found stimulating and interesting. And those two proceeded in parallel for a number of years. I pursued trading as an avocation, and I pursued psychology as my vocation. And it wasn't until around the year 2000 that I seriously contemplated putting the two of them together and began writing a book. It was my first book in the area, called The Psychology of Trading, which was later published by Wiley. And that was encouraged by my good friend and mentor, Victor Niederhofer. So that's how the two came together. But up to that point, for a number of years, they were completely parallel interests. The book became popular and was discovered by a trading firm in Chicago. And they began asking me to work with their traders and then made me a full-time offer. So I left the academic setting that I was in. I was teaching at that time in a medical school in Syracuse and also running a counseling program, and went full-time to working with traders in Chicago. And that's when the psychology and the trading interest truly came together.
Okay, excellent. So let's talk a little bit about your time in Chicago. Like, what were you doing? Like, how were you actually helping these traders with the mental aspect, the psychology, and everything that goes on that side of the field?
Well, in Chicago, I was working primarily with market makers in electronic futures. These were people placing dozens, if not more, trades per day. So trading on a very short time frame. The average holding period for many of the traders was around 3 minutes. So they are very actively engaged in markets. And it fascinated me because they were trading in ways that were completely different from what I had read in the textbooks. The books on trading talked about technical analysis, fundamental analysis, and these traders who I was encountering in Chicago did none of it. Obviously, they did no fundamental analysis because the fundamentals don't change in 3 minutes. But technical analysis in terms of chart patterns and indicator readings, those were much too slow for these traders. These traders were entering positions and exiting positions very quickly, and they were working off a depth of market screen. They were working off the order flow, not backward-looking technical information. So that was an education in itself and sensitized me to the psychological challenges that they faced in making decisions so rapidly. It was easy for them to become frustrated, to become overconfident, and for all of those emotional factors to slant their decision-making. And so my work as a trading coach was to help them keep a level head, keep focused, and make good decisions in real time. And the fact that I was full-time working with them, and so on site, watching them trade and standing with them and helping them really helped the psychology become part of the trading.
Right. Yeah, that's very interesting, Brett. And we're going to dig deeper into that in just a moment. A question I have for you is, like, over the years, you've been in the field for a long time now. You've worked with many, top traders, like some very, very hard-hitting heavyweight traders, asset managers, fund managers, a pretty broad spectrum of market participants. Now, these aren't all guys who are struggling. Some of these guys are extremely profitable and make huge amounts of money. Why do they come to you for your help on the psychology side?
It's a great question, Aaron, and it's the same reason that successful professional athletes work with coaches as well. At that point, they're not struggling. They would have never gotten to that point for the in a large majority of cases if they were marginal participants. So these are people with real experience, real strengths. But what happens is that markets are always changing. And even the most talented participants have to evolve with the markets. And that need to evolve itself brings its own psychological challenges. The need to be creative, the need to be resilient in the face of frustrations, and also the need to identify and build upon strengths. So many times, the portfolio managers are seeking me out when they are doing very well because they want to stay grounded in their strengths. They want to make sure they understand what they're doing well so that they can be more consistent going forward in making use of those strengths. And so that's the difference with working with someone who is struggling and wants to work on their weaknesses or vulnerabilities.
Okay, that's a great answer, and it makes total sense. I really like how you explained that. So, Brett, let's bring this up to speed now. What are you doing today? Like, what's your work involve, in current times?
Well, I work with several hedge funds and other financial firms. So I'm not full-time at any one place. I consult with a variety of funds. And what that's done is expose me to a variety of trading strategies. Some of those strategies are discretionary, some are more systematic. Some of the strategies are more directional, some are more based on relative value movement. Some are in macro markets, the big liquid markets, and some of them are very specialized in individual markets, such as commodity markets or rates markets. So I've been exposed to a variety of trading strategies and trading settings. It's been a great education as a result. But in all cases, my main work is to help the traders, the money managers, with their performance, help them build on their strengths and help them learn from their mistakes so that they keep improving. A secondary focus has been at most of the places where I've worked, we've conducted internal research about what makes traders successful. And so I've been able to help the trading firms with their hiring processes and help them make better decisions about who to bring on board. So that's been a separate kind of work, but a very fulfilling area as well.
Sure, okay. Now that's really cool. Now that we're caught up on your background, let's really hone in on the subject of trader psychology. So one of the things many traders will admit and are well aware of is that they take profits too soon and they cut losses too late. That's mostly due to psychological reasons, I'd imagine. What advice would you give to those traders in that situation?
Well, it's a good question, Aaron. And as Iran would say, I would encourage you and listeners to check your premises with respect to the question, because I think that it can be a psychological issue, but is not always a psychological issue. I mentioned that markets are always changing, and one of the ways that they change is in their volatility. And so the market, as we are talking right now, the market is trading with a VIX of, which is implied volatility, of 14 and change. It wasn't so long ago that we were seeing VIX readings well into the 20s. So markets were moving much more a few weeks ago than they are currently. What happens is that traders don't adapt to that, either in their trading or emotionally, and so they're likely to take profits too quickly or likely to allow things to move against them because they are operating from an old regime, from an old set of assumptions that don't apply to the current market. So a good example, when volatility comes down, traders will start to make some money, and then when they try to let the position go, it eventually just reverses against them because the volatility isn't there, and you get much more mean reversion on a short time frame, and so they end up scratching the trade. Whereas in a higher volatility regime, that might have been profitable. So sometimes a problem that trader might have is logical, not psychological. It's a function of not adapting to markets. It's a function of not trading well. But you're right. There are other times where traders respond emotionally to making money, losing money. And as we know from the behavioral finance research, people are much more sensitive to losing money than they are making money. And so they're likely to be threatened by losses and not want to take those. They're likely to be afraid of losing whatever they gain and exiting trades early and so forth. So a huge issue in trading psychology is identifying when is a trading problem a logical problem, a problem with one's trading methods, and when is it the result of a psychological problem, the result of being in a wrong mindset that biases your information processing.
Okay, that's an awesome answer. That was really, really good. So, I mean, I guess that is an example of a lack of adaptability, and in some cases, possibly even a bad habit. But in general, when we recognize bad habits in our trading, what's the best way to break these habits?
The first step in breaking any habit, whether it's a trading habit or a personal habit, is to become exquisitely aware of its presence. So we want to become mindful. We want to be self-aware. We want to realize that a habit pattern is playing out as it is starting. So let's say my habit pattern is overeating. The first step in change is to recognize when I'm starting to feel a craving for food or when I'm starting to reach for the refrigerator. If I can't identify it at the time it's happening, how can I possibly control it? So building awareness and self-awareness is the first step in the change process. Then, once you have that self-awareness, once you can become an observer to your habit patterns, rather than someone who is caught up in those patterns, then you want to make a conscious effort to rechannel yourself. So let's say, for argument's sake, I have this habit of overeating, and I tend to overeat most when I'm bored. So I catch myself reaching for the refrigerator, and then I calm myself down, I focus myself, and I purposely engage in an activity that I will find engaging, that will absorb my energy. Maybe it will be some physical exercise. Maybe I'll go play with one of my 4 cats. But the idea is I would address the boredom so that I no longer feel the need to compensate with food. The same principle is relevant with trading. So my habit with trading might be to place trades out of frustration after I've taken a loss. Revenge trading. And so that comes from frustration. I have a losing trade, I'm frustrated, and I want to make that money back. So I want to become self-aware about that frustration. I want to catch myself being frustrated and rechannel that emotion. So stepping away from the screen temporarily, calming myself down, and doing something that is gratifying, that's fulfilling, to counteract to the frustration will help put me in the right state of mind so that I can go back to the screen and make good decisions.
Okay, sure. And I like how you mentioned earlier in that answer about more being an observer to your bad habits than getting caught up in the middle of it. I think that was a really cool concept.
Yeah, the important one that shows up actually in Eastern philosophy as well as in the psychology research, that we can't change something if we're not aware of it. If the pattern controls us, if the habit controls us, then we're passive. We have no say in what happens. So the first element of control is being able to step apart from the habit pattern, whether it's a habit of drinking, a habit in trading, a habit in our relationships. We stand apart from it and we recognize that this is causing us pain, this is causing us losses, and then we're able to try and do something differently.
Right. Okay. Now, the intro to Trading Psychology 2.0, you mentioned that all the traders you've worked with varied greatly in how they actually traded, yet they had many commonalities in how they did what they did. So here you were, of course, referring to process and habits. Could you elaborate on these observations for us?
Yes, absolutely. Obviously, the traders I work with have very different strategies. Some are more short-term, some are more long-term. Some are long-short investors building very large portfolios among individual stocks. Some of them are trading macro assets globally and trading macroeconomic themes. So they're very, very different in their approach to markets and in their trading styles. But at a process level, there's some real similarity. And that's what I talk about in the Trading Psychology 2.0 book with those basic A, B, C, D themes. A being adapting to markets, B being building on strengths, C being cultivating creativity, and D being developing best practices. And so what the really successful traders are doing is studying themselves and figuring out what works, what they're good at, and where their vulnerabilities lie, where their weaknesses lie. And they do more of what works. They act in ways that make them more of who they actually are. And they may be different strengths in different markets, but all of them study themselves just as they study markets and stay grounded in what makes them successful.
Okay, so the A, B, C, D that you mentioned there, could you just walk us through each one of those in a little more detail, just so we can understand, get a better grasp of each point?
Yeah, absolutely. Yeah, so A, is adapting to changing markets. And this, as I point out in the book, is no different than it would be for any entrepreneur. You start a business and your marketplace is always changing. And so at one point in time, if you're starting a restaurant, your marketplace may have one set of tastes, and then something else will become popular. And so you have to adapt by changing your menu, by changing your decor, by changing how you deliver service. Successful businesses never stay static. We see this in the technology industry. New smartphones are coming out with regularity because the marketplace demands new features and functionality. So we're always having to adapt. Markets change in their trend. Markets change in their volatility, as I mentioned. Markets change in their patterns of participation. The people who dominate markets now are not the people who dominated 10 years ago or 20 years ago. And so we see different patterns in markets. To assume that markets are static and that our edge will last forever does not work any better in financial markets than it does in the business world. A great way to go out of business in the business world is to assume that what you're doing well will last forever and you never have to change. That's how to become a dinosaur. That's how to become obsolete. And that happens in financial markets as well. So the successful traders are always studying markets and always studying how markets are changing. And the interesting part, Aaron, is that many times our mistakes in trading, our losses, our setbacks, our drawdowns tell us about changing markets. because we do what we did do when we were making money, and suddenly it's not making money for us. And if we're reasonably disciplined in doing what we had been doing when we made money, then we have to ask ourselves, well, how come it's not working anymore? What has changed? And that helps us go back to the market, learn from our mistakes, and adapt. So we're using our drawdowns, we're using our losses as real information that helps us adapt to markets that have changed their correlation patterns or their trend patterns and so forth. So that's adapt. That's the A part, adapting to changing markets. The B part is building on strengths, and I alluded to this earlier. What I found in my research with successful traders and portfolio managers is that all of them have different strengths, but all of them have at least one distinctive strength. And it could be a personality strength, it could be a cognitive strength, but the really successful traders are really strong in some areas. As a rule, the high